I think we are live. Just confirm me with the audio and video. Guys, can you confirm me with the audio and video? Can you all confirm me with the audio and video? Are you the correct live stream? Yes, we are. Yes, sir. Audible. Good morning. Good morning. Seems fair. Audio video seems fair. Just give me a second now. Happy morning, sir. Okay. Okay, Ji. So, hello everybody. Welcome. Good morning and vanakkam to all of you present here. Today we have met for a very special, very special marathon series for entire DT, that too in full English. And this is part one of 3 day marathon series. How you all are, who all are live present here, please mention your name, your city in the comment box so that we can start off with today's session. Meanwhile, let me put down some basic protocols in this, to be followed in this marathon. What are the basics, what we are going to cover, and what is the PDF, how you are going to get the PDF, everything, just 2 or 3 minutes, and then we will start. First of all, sir, this is not a single marathon, this is a 3 day marathon. First day, we will be covering, we are covering actually international taxation. Entire international taxation will be covered, including NR taxation, transfer pricing, DTAA, advance ruling, base erosion, profit shifting, model tax conventions, tax treaties, international development, whatever chapters are there in the international taxation, we shall cover it. This is day one. Tomorrow we shall take up the small topics of direct tax portion, which might have say appeals, BRC, GARS, miscellaneous provisions, tax audit, black money, clubbing, set off deductions. Tomorrow we shall cover that. And day after tomorrow, that is on 27th, so that is on 29th, we shall take up the entire direct taxation and we shall cover that. Okay? So if somebody is weak a bit, if somebody is dicey as to how to prepare, only these 3 marathons will cover your entire concepts. Entire concepts, with that, I really mean it. Entire concepts will be covered with these 3 marathons. So these are definitely meant for you. Even if you have studied, you should refer some of the chapters from this marathon so that you are not left out. You do not leave out any topic before exam. That's the first thing. Second thing, sir, which concept book, which notebooks, which notes I will be using? See, first of all, I will be using my concept book. This concept book, if you want to buy, you can buy from Telegram, you can buy from Fast website. It is in the description box. But I personally would recommend that if your attempt is in this May 26th, now you should not buy it. As of now, whatever material you have, you should stick to that. Most of the content, or I should say 95% of the content would remain same. Only some extra things that are there in my book now, you can copy it down by pausing the video. So there should be no change in material. Third thing, sir, I will be solving question answers along with the concepts. Some question answers I will be taking. So this marathon is not just about concept, it is questions and question answers with concept. So from where I will be solving question answers, I will be solving from Super 150 PDF. That Super 150 PDF has been shared in my Telegram channel. If you have downloaded that, well and good. If you have not downloaded that, get that downloaded, take a print out of that and solve it along with me. Entire video for that Super 150 marathon has already been uploaded yesterday. If you just want to solve question answers, marathon for question answers has already been uploaded. You can take refer that as well. Fourth thing, sir, marathons are always faster. Marathons are always energetic. One promise I want from you all is sit with me, study with me, Whatever questions I ask, continue responding to me, and always hit that like button that is in front of you. Always hit that subscribe button that is in front of you, so that other people can get to know about this marathon as much as possible. That's all from my side today. Then we have with us Swathya. Okay, Swath. Then we have Falguni. Then we have Jairaj. Then we have Archana. Then we have Never Give Up. Never Give Up, I forgot. Is it Ria? I guess I don't know. I forgot. Gayatri, we have Kishore and many other people joining silently. Right away, starting from non-resident taxation. Whenever you study non-resident taxation, there are three steps as to how you should study the chapter and how you should understand the concept. First step is always the identification of a non-resident. Who is a non-resident? How will you identify, sir? You will identify that with the residential status. Once you identify the non-resident, you will identify the scope of total income, that is, which income of such non-resident would be taxed in India. Third step that would imply is applying tax rate on such non-resident. These are the basic areas of the chapter. If you are comforted with these areas, now your entire chapter would be done. Remember, I will be covering almost the entire chapter, and you just have to study only that portion which I will be telling you, not more than that. Take it. Right away, starting from residential status. Always understand residential status is determined for every SSC differently. Individuals' residential status can be assessed differently, companies, firms differently. And it is arrived after, it is arrived on the basis of every year. Every year, residential status might change. How do we arrive the residential status of an individual? An individual is said to be resident of India if he stays in India for 182 days or more in previous year, that is previous year 25-26, or he stays in India for 60 days or more in previous year, but 365 days or more in preceding four previous year. So 182 days in previous year or 60/365 days in last 4 years. This is how we are going to arrive. If any of the condition is fulfilled, he shall become a resident of India. Done, sir, done, sir, done, sir. The second condition of 6365 days is not applicable in three cases. In three cases, now we don't have to check the second condition. What are the three cases? First thing, if any person leaves India for employment basis, if I got job in Google, if I leave India, second condition is not to be checked. Only first condition is to be checked. Second thing, if I am a crew member of Indian ship, what is a crew member of Indian ship? For example, ship is in India, it carries cargo from India to other countries. If I am a crew member of that ship, then I don't have to check for second condition. I just have to check for first condition only. Third thing, third situation, if there is an Indian citizen or person of Indian origin who visits India, okay, person of Indian origin, Indian citizen visits India, and his total Indian income is up to 15 lakh rupees. Then we don't have to check the second condition. Only the first condition is enough to make him a resident. Remember, who is a person of Indian origin? Person whose parents or grandparents were born in undivided India. That's it. We understood first condition 182 days, second condition 60/365 days. Once he becomes a resident, once SSC becomes resident, we have to check for additional condition. What are the additional conditions? Sir, lawmaker says if SSC fulfills both the conditions under section 66 na, then he shall be considered as ROR. If he fulfills either condition or neither condition, then he shall be considered as RNOR. That means resident, not ordinary resident. What are those conditions? Lawmaker says out of 10 preceding previous years, that means preceding to previous year 25-26, out of 10 preceding previous years, if SSC is resident for 2 years, if SSC is resident as for 2 years, resident means as per section 6(1), resident for 2 years. Okay, that means stay in India is for 182 days or 60/365 days. If he is resident for 2 years, this condition is fulfilled. Then we say out of 7 preceding previous year, if he stays in India for 730 days at least, then he is deemed to be fulfilling both the conditions. If he fulfill both the condition, he shall be ROR. If he misses out any of them or he misses out both of them, in that case, he shall be RNOR. Sir, very simple. Nothing can be simpler than this. But sir, we have a special pointer. Right now, you rightly said that if we have any Indian citizen or person of Indian origin who visit India and whose total Indian income is up to 15 lakh rupees, then we don't have to check 60/365 days. Correct, sir. Correct, sir. Correct, sir. We don't have to check. But what if total Indian income is more than 15 lakh rupees? Then what we have to check? Sir, in this we have to check 60/365 days. But remember, in this case, instead of 60, we shall take 120 days. Instead of 60, we shall take 120 days. And importantly, if assessee becomes resident because of this second condition, if assessee becomes resident because of the second condition, he will be by default RNOR. We are not going to check the additional conditions. Simple, sir. Simple, sir. Simple, sir. That's it. That's it. That's it. Another small pointer. For example, we have with us Gayatri. Gayatri comes to India on 1st April and leaves India on 10th April. Lawmaker says entry into India and exit from India. Entry into India and exit from India shall be considered as a stay in India only. Whereas if you are a crew member of Indian ship, now for whereas you are if you are a crew member of Indian ship, in that case, entry and exit date are to be excluded. The date you receive continuous discharge certificate or mean you leave India, in that case, it is considered outside India only. This is entire residential status for you all. There is a small concept called a deemed resident. Very small concept, Anna. Very small concept. Lawmakers say that if you are Indian citizen, if you are Indian citizen, not the person of Indian origin. Okay? If you're Indian citizen whose total Indian income is more than 15 lakh rupees. Sir, please don't use this accent. Okay. If you are an Indian citizen whose total Indian income is more than 15 lakh rupees and you are not a resident anywhere. Why you are not resident? Because you are not fulfilling any conditions of any country. In that case, you are not resident of anywhere. In that case, what would happen? India would make you a resident of India, but you shall be RNOR. Okay? You will become a resident of India, but only RNOR you will become. Okay? That's it. That's it. That's it. That's it, sir. Enough. 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 Enough for a residential status of individual. Nothing more than that. Nothing less than that. We are done with it. Hindu undivided family. Okay. What about residential status of HUF? How do we arrive at? See, if controls and management of the affairs of HUF are being done wholly or partly from India, then it is resident. But if it's done wholly outside India, then HUF becomes non-resident. Fair enough. Once HUF becomes resident, we have to check the additional conditions of HUF. What are the additional conditions? Sir, the same conditions that are applicable above for an individual. If Karta satisfies both the conditions, na, in that case, HUF shall become ROR. If Karta misses out on either of the condition or both of the conditions, in that case, na, he shall become RNOR. HUF shall become RNOR. Very simple, very less likely to be asked HUF. If there is a partnership firm, AOP, BOI, local authority, and artificial juridical person, in that case, what would happen? If their affairs are controlled partly from India or wholly from India, it shall become resident. But if affairs are absolutely controlled outside India, then this shall become non-resident. Very fair enough. Under HUF, AOP, sorry, in the under firm AOP, BOI, AJP, we do not have concept of ROR or RNOR. We simply have resident and non-resident. Very simple. At last, we have residential status of a company. Residential status of a company. Now, once residential status of company is determined, now we need to understand two concepts. Always remember, two concepts are important here. First concept is, sir, are we talking about domestic or foreign company? Right answer is no. Whenever we are referring domestic and foreign company, now domestic and foreign company is the bifurcation given under law for tax purposes, for tax rate purposes. Domestic companies tax at 25/30% or 22% in some cases, but a foreign company is taxed at 37%. So whenever you see difference between domestic and foreign company, now it is only for the tax purpose. But if you say resident and non-resident company, now resident and non-resident demarcation is made for the purpose of determining the total income. So total income determination differs. Okay? So here we are studying for the total income purpose. Perfect, sir. Perfect. See, if there is any Indian company registered, incorporated in India, it will always be resident. But if there is a foreign company, if there is a foreign company which has absolute offices outside India, it is a foreign company, of course, then in that case, it shall become only resident if it has POEM in India. If foreign company has place of effective management in India, then only such foreign company shall become resident. Otherwise, this foreign company shall not become resident, shall become non-resident. How do we determine the place of effective management of a foreign company? Lawmaker says place of effective management is nothing but, place where key management, commercial decisions that are necessary for the conduct of the business are done in substance. That is the poem. Perfect, sir. How do we test for poem? How do we identify where does the poem lies? Where does the company's actual decision making lies? In that case, we have two methods. Okay, two methods. First of all is ABOI test, active business outside India test. If company fulfills five conditions now, if company fulfills five conditions, then we can say that company has active business outside India. Therefore, company is a non-resident. See, everybody who is live now will mention the things that I am saying. Active business outside India test, five conditions. If all the five conditions are fulfilled now, then you have to assume that company is a non-resident. What are those five conditions? See, first condition is less than 50% of the total assets are in India. Less than 50% of the total employees are resident of India. Less than 50% of the payroll expenditure is on the Indian employees. Passive income is up to 50%, and majority board meetings happen outside India. What did I say? Everybody mention these five pointers in the comment box. Otherwise you will miss the exemption by 1 mark. I am saying now. What did I say? What did I say? Less than 50% of the assets are in India. Less than 50% of the employees are resident of India. Less than 50% of the total payroll cost is on Indian employees. Passive income is up to 50%, and majority of the board meetings happen outside India. All the five pointers, everybody has to mention in the comment box. Sir, again. Less than 50% of the assets are in India. Less than 50% of the employees are resident of India. Less than 50% of the payroll cost is on Indian employees. Majority board meeting happen outside India, and passive income is up to 50%. Everybody mention in the comment box. Done, sir. Done, sir. Done, sir. If company if company, okay. What Shubham says, sir, because of you, I could score exemption. Oh, Shubham. Can I say I love you? Very nice, very nice. Because of you, I was able to score exemption, but in IBS with chapters amendments, I will tell you personally. Okay? Perfect. I will tell you personally. Okay? I will tell you in the Telegram group or some other video. Now, whenever you check for ABOI test, we have, as I have said, there are five conditions. There are five conditions. Yes, sir, there are five conditions. What under in these conditions, now what we have to check? Listen. See, whenever you check for passive income, what is passive income? Under these five conditions, now we set certain terms. What terms we have to study? First of all, what is passive income? Passive income, passive income is nothing but any income from royalty, any income from dividend, any income from capital gain, any income from interest, any rental income. These are the incomes. These are the incomes that are passive incomes. You can understand now, you don't have to do anything and you are earning. That is passive income. Apart from that, there is an extra thing called passive income, that is income from associate enterprise, where you buy goods from associate and sell to associate. Buy goods from associate and sell to associate. This is also called passive income. So, five or six things are passive income: interest, dividend, royalty, capital gain, house property. Plus, buying goods from associates and selling goods to associates. Both the things, if it is done, it is called passive. What is income? So income is nothing but the income as per tax laws of the country. Whatever the tax law says is income is income. How do we determine the value of the assets? See, if we have depreciable assets, now we shall take the average of WDV. If there are other assets like inventory, like data, we shall take the book value as per accounts. How we are going to calculate the number of employees? See, whenever we have number of employees, now we shall take opening number of employees, we shall take closing number of employees, and we shall divide it by. Whenever we are going to take the number of employees, we are going to take every employee, that is a contract employee, full-time employee, part-time employee, intern, stipend, whatever employee that you have, you are going to take. Then we have payroll. What employee costs you are going to consider? See, every kind of employee benefit cost that is a part of your P&L that shall become part of the ABOI test. Sometimes data for 3 years can be given. Lawmaker says that if 3-year data is given, you just have to do what you have to do. You just have to average the data out and find out the ABOI test. So, What we are studying, sir, we are studying the residential status of a company. In that, we understood first step is ABOI test. If company fulfills ABOI test, then such company will become non-resident and only Indian income can be taxed in India. What are the five conditions? Sir, less than 50% of the assets are located in India. Less than 50% employees are resident of India. Less than 50% of the payroll cost is on Indian employees. Passive income is up to 50% and majority board meeting happen outside India. Okay, sir. Okay. Let's do one question. Let's do one question from this topic. Let's come on. Super 150. In evening, this marathon will go till evening, okay? Come on to page number 153 of Super 150. Question number 97, Singtel Limited. Singtel Limited is a company incorporated in Singapore and 55% of the shares are held by Godavari. Everybody, see, I have uploaded Super 150 question answers where I have solved this question. I know how to solve the questions. I am solving because I want you all to understand how to solve the questions. Sir, we will solve with you. We will solve with you. We will solve with you again. So Singtel is a Singaporean company. And we have Godavari, which is an Indian company. Godavari holds 55% in Singtel. Always understand shareholding is irrelevant for POEM determination. We never check shareholding for POEM determination. Only thing that is to be checked is decision making, who is the decision maker, and ABOI test. Two things are to be checked. POEM determination is only relevant for decision. I mean, only relevant thing in POEM is decision making, and second thing is ABOI test. Shareholding is irrelevant. Singtel has presence in India. Also, details of Singtel has been given. Okay, sir. Okay. Fixed assets at depreciated value. In India, we have assets of 120 crore, whereas in Singapore, we have assets of 80 crores. Intangible assets, India 50 crore, Singapore 200 crore. Other assets, 40 crore, 120 crore. If you check out the total assets of India, it is 210. If you check out the total assets of Singapore, it is 400. So total assets are nothing but 610. Out of that, how much is Indian assets? Out of 610 worth of total assets, sir, 210 are Indian assets. Can I say less than 50% of the assets are located in India? Out of the total assets, less than 50% are located in India. Yes, sir, assets condition is fulfilled. Then second condition was employees. Sir, employees details have been given below. Total number of employees have been given. 70 are Indian and 90 are Singaporean. Singaporean. That means out of 160 employees, 70 are resident of India. Can I simply say that less than 50% of the employees are resident in India? Yes, sir, employees condition is also fulfilling. Third case, sir, expenses, payroll expenses. Sir, 8 employees are Indian, 12 employees are Singaporean. What is the Singaporean? I mean, whatever we can make up, it's up to us. Out of 20 crore of income, 8 crore are Indian is the expense on Indian employees. So payroll is also less than 50%. Sir, three conditions fulfilled. Three conditions fulfilled. Now only two conditions. Passive income up to 50% of the total income. Okay. Fingers crossed, fingers crossed. Let's check for it. Income from trading operations, Indian income is 25, Singaporean income is 50 crore. The above figure include these three figures have been included in above. So we are not going to take that. Interest and dividend from investment, this is 25 and 15. So adding up the all the highlighted ones will give us the total income of the entity. 25 plus 50 plus 20 plus 15. Total income would be 25 plus 50 plus 20 plus 15. So total income is 110 lakh. Out of this, how much would be the Indian income, sir? First of all, interest and dividend, this would be passive income. Sorry, this would be passive income. Apart from that, sir, income with from their purchases and sale, both are to associate enterprise. That shall become passive. So third part, income where transaction where both purchase and sale have been done to associate enterprise. This is passive income. If you carefully add now, if you carefully add the red ones, 5 plus 10 plus 20 plus 15, that means 50. Can I say 50% of the total income is passive income? Can I say right answer is no? Up to 50% is the passive income. That means this condition is also fulfilling. All the conditions are fulfilling. Only thing is to be checked now is, sir, board meeting. Determine the residential status of Singtel assessment at 26-27. During 25-26, 8 board meetings were held. Out of which 3 were in India and 5 were in Singapore. That means majority board of meeting are also outside India. Then this company is absolute non-resident. ABI test is fulfilled. Company becomes non-resident. Company becomes non-resident. Done, sir. Done, sir. Done, another done, sir. Now, what is the other company test? See, once ABY test is checked for, and even if it is fulfilled, company becomes non-resident. Company becomes non-resident. Then you have to check other company test as well. What does other company test imply? Okay. What Archana says 25 includes purchase and sale from associate. Archana, that is total income. Total income. Okay. Total income is separate. How much is the passive income? Out of the total income, how much is the passive income? We have to check. We are not adding this again. We are just finding out the passive income out of this total income. That is why we have taken it separately. Now, other companies, sir, once ABY test is fulfilled, company has become non-resident. We are not going to leave the company. We are going to check for other company test. What is this other company test? Lawmaker says identify the key person who takes the decision. Whether board of director take the decision, whether executive committee, whether senior person who take decision in the company, and sir, where they sit and take the decision. What did I say? Who take the decision and where do they take the decision? We have to check both the things. That is important where they take the decision. Sir, for example, if board of directors take the decision, then place where board of directors are situated, we shall take the poem. For example, board of director do not take the decision. They have given this power to some senior management. Then you have to check the place of senior management. If board of director have delegated this power to executive committee, that means board of director are not taking decision. They have given the power to some executive committee. Then you have to check the location of the executive committee. If board of director take decision on circular resolution, that means everybody is voting out of postal ballot. Then you have to check where the decision to take authority has been decided, where this has been decided that postal ballot is going to take place. Sir, if company functions in decentralized manner, then where senior management is located, and at last, if senior management is working remotely, then check out for the most senior, most personnel. That place shall become poem. In this entire process, it is possible that company has outsourced its works to some small countries. For example, there is a company in USA. It has outsourced some of its work in India. For example, routine work like payroll, accounting, HR, IT, supply chain, routine banking, operation. These tucha small work can be outsourced in India. Lawmaker says that if this tucha small work is outsourced now, then this does not changes the poem at all. Last thing, sometimes what happens is USA has board of director. Okay, there is a company in USA which has board of director, but the board of director works on the decision taken by a Bengali Baba. Bengali Baba sitting in Himalaya helps in deciding what decisions to be taken for the company. Lawmaker says then poem will be set to in India. Sometimes board of director work upon the directions of a person. Then you have to check the place of that person, and that place shall become poem. So board of director not exercising their powers, and their powers is being exercised by holding company or some other person resident of India, then poem shall become resident of India. So ultimately you have to check who takes the decision and ultimately where does he stay. That is important. Now, very important conclusion, ji, very important conclusion. Sometimes this happen that there is a company in India and it incorporates wholly owned subsidiary, for example, USA, Germany, wherever. In any of the country, Indian company incorporates a wholly owned subsidiary. So just because this wholly owned subsidiary, this will not become resident of India just because it is wholly owned subsidiary. Why? Sir, because shareholding is irrelevant. Shareholding is irrelevant for OEM determination. Even if it is wholly owned subsidiary, it shall not become resident of India. Always understand, even if it is wholly owned subsidiary, it shall not become resident of India. You have to check who decides. If Indian people decides for this wholly owned subsidiary, then it shall become resident. If Indian people do not decide, then we shall not make him resident at all. We shall not make this entity resident at all. Oh dear God. Oh dear God. Oh dear God. That means with this step now, you are in a position to identify who is a resident person and who is a non-resident person. Oi, look into my eyes. Okay? Now you know who is a resident, who is a non-resident. Now you don't need, now you want to know how do we determine his total income, which income we are going to tax. Always understand. For individual HUF or for any other SSC who is a non-resident now, only Indian income can be taxed. For any SSC who is a non-resident, only Indian income can be taxed. Residents, entire world income can be taxed. But non-resident, only Indian income can be taxed. So you need to understand Indian income will be very big. For that matter, we have section number. We have definition. We have entire definition of Indian income, which says income received in India, income deemed received in India, income accrued or arising or deemed to accrue arise in India. This is the entire definition of Indian income. In this, some portions are very easy. What is Indian income? Indian income, sorry, received in India. If I pay any money to you in India, then it is received in India. If you have a bank account in India, you receive any money in that bank account, it is received in India. Whenever money is received in India, it is considered as Indian income only. Received in India means Indian income only. Simple thing. Second thing, sir, what is deemed received in India? See, deemed received in India is not much relevant to be precise, but if it is us, you must be aware. What is deemed received in India? Try understanding this. There are certain incomes that you might receive at some other places. I mean, maybe outside India. Lawmakers want them to be received in India. For example, if you contribute to some pension money, if your employer contributes to some of your pension money, employer contributes to pension fund. Now, if he contributes, it is exempt in your hands because it is added to your income. You get deductions. So ultimately, you do not pay actually taxes on pension fund, pension money. Okay? But once you retire, and for example, you are settled in USA, so you will be receiving this pension money in USA only. So you might argue that I have not earned in India, I am receiving in USA, so it should not be taxed. Lawmakers are very clear. If you contribute to pension fund now at retirement, wherever you receive it, it is deemed received in India. Similarly, if you contribute to unrecognized provident fund, it is not taxable as of now. But at the time of retirement, when you receive, if you receive it anywhere in the world, it shall become deemed received in India. Third thing. So sometimes now you contribute to recognized provident fund. Okay, contribute to recognized provident fund. Lawmaker says up to 12% it is exempt. What if you contribute more than 12%? Lawmaker says it is taxable at the time of retirement. So if you stay outside India at the time of retirement, if you are staying outside India at the time of retirement, then it should be taxed now. Lawmaker says yes, we will call it deemed received. Last point, sir, if your interest on RPF is more than 9% received anywhere in the world, we shall consider it deemed received in India. Not relevant, less, very, very, very less relevant. Remember, income does not imply remittances. Income does not imply remittances. For example, somebody earned outside India and he has remitted the money to India does not mean that it is his income, okay? Or it is the income of the parents. It is just a remittances. Remittances are not taxed under income tax. Okay, sir. Okay, sir. Okay, perfect. Now, we understood what is income received or income deemed received in India. Income received in India, income deemed received in India. We understood that. Okay, we understood that. Now we need to understand what is income accrued or deemed to accrue arise in India. Income accrued or deemed to accrue arise in India. What does that mean? Sir, Section 9 clearly states out what incomes are accruing in India or what income are deemed to accrue arise in India. Section 9. What Section 9 says? Section 9 says multiple things. Let us go one by one. First thing, if you have any business in India, if any non-resident has a business in India, then income from such business is always Indian income. If somebody does business in India, then income from business is Indian income only. First thing. Second thing, if somebody is doing business from outside, but if he has an agent in India, if somebody is doing business from outside, for example, there is a person called Donald Trump. There is a person called Donald Trump. He is actually not in India. He is not in India. Not in India. But he has an agent called Rahul in India. And sir, agent exclusively works for this Donald Trump. And this agent, what he does, sir, he concludes the contract. He maintains the stock. He habitually secures the order. If this agent does these three things now, lawmaker says that this non-resident working through the agent shall also constitute business connection, and whatever income via agent is there, that shall be Indian income. What did I say? Business in India is always Indian income. Non-resident doing business via an agent, via a dependent agent, shall also constitute Indian income. In this case, three conditions are to be fulfilled. First of all, contract conclusion by the agent, then order secure and maintain stock. These three things, if agent does not, then whatever the income the agent earns for such non-resident shall become Indian income only. Very simple, very simple, very simple. Sir, what if there is a person called Rahul in India who works for Donald Trump? Of course, sir, he will become agent, and whatever income Rahul earns, it will be income for Donald Trump in India. But sir, what if Rahul works for, say, Warren Buffett as well? Rahul works for, say, Pete Hegseth as well. Rahul works for Mustafa Khamenei as well. Rahul works for Vladimir Putin as well. Rahul also works for Benjamin Netanyahu. Lawmaker says if somebody works for all of them, that means he is an independent agent, and independent agent are not covered under this provisions. Okay? Dependent agent who does three things, that means securing contract, concluding contract, securing orders, and maintaining the inventory. Dependent agent would be considered only business connection. Independent agent would not constitute business connection. Now, significant economic presence. Now, what does the significant economic presence mean? By understanding one more thing. See, if somebody is doing business in India, it is always Indian income. For sure, it is Indian income. But there are companies like Spotify. Have you heard of this name, Spotify? Oi, chich. Have you heard of this name, Spotify? So Spotify is a Swedish company. It I mean, you can hear songs in Spotify. Whatever songs you want to hear, you can hear in that song, you in that app. Now, Spotify has a very strange business model. I mean, it never has come to India. It has never come to India, but it operates digitally. It earns revenue from Indian people. It earns subscription from Indian people. It earns advertisement revenue from Indian people. So they are earning too much. Lawmaker says that if there is a non-resident foreign if there is a non-resident foreign company or any of the person outside India who has significant economic presence in India, then some income would be Indian income. What is significant economic presence? Lawmaker says if any non-resident transacts in goods where aggregate transaction in a year exceeds 2 crore rupees. That means Spotify is taking more than 2 crore rupees from India. Or Spotify has more than 3 lakh downloads. More than 3 lakh downloads. In this case, now Spotify is considered as having significant economic presence. Spotify is deemed to be considered as having significant economic presence. Significant economic presence. Perfect, sir. Perfect. Once Spotify has significant economic presence now, there are certain incomes that will be taxed in India. What are those certain incomes? Lawmaker says, for example, this is Rahul. I am hearing songs at Spotify. Okay. And there is a company called Boat. Okay, this is Rahul. This is Spotify. There is a company called Boat. Boat has paid 50 lakh rupees to Spotify to show ads in India. When you hear ads now, when you hear songs now, there are ads coming. So whatever money that has been paid to Spotify to show the ads to resident of India, na, in that case, this income would be Indian income. Okay, first thing. Second thing, sir, for example, this is Spotify and this is Rahul. Spotify collected the data of the Rahul as to what my preferences are. I am very partyholic person kind of. So Spotify got to know about this. And sooner or later, ads of parties came on my Instagram feeds. Spotify sold my data. Okay. So this is also considered as the This is also considered as Indian income. If my data is being sold now, if data of resident of India is being sold now, it is also called Indian income. Third thing, if Spotify sells me the subscription, its own subscription, in that case, that shall also become Indian income. So three things. First of all, whatever the ad revenue the Spotify is earning by showing ads, by showing ads to resident of India or IP address user of India. Second thing, whatever the data sales income this Spotify is earning by a resident of India or from IP address user of India. At last, sir, if Spotify is earning via subscription sales, that should also be Indian income. All these three things would become Indian income. Perfect, sir. Perfect, sir. Perfect. So what did I say? I said three things would become Indian income as of now. First of all, business in India is Indian income. Second, if somebody is having an agent in India and that agent is concluding contract, maintaining order, securing contracts, he shall contribute in business connection and Indian income. And if foreign company is having significant economic presence, in that case, that company is deemed to have Indian income. There are four transactions which are not considered as business connection. Important, now very important. I mean, I don't know how many times this point has been asked. See, first of all, if there is a news agency, if there is a news agency in India, not in India, but somebody outside, for example, Al Jazeera. Al Jazeera has reporters in India. If these reporters collect some spicy news from India and earn very much of TRP, earn good TRP, and earn a lot of profit outside India, in that case, now this news reporters would never be considered as agent, and this would never constitute business connection. Okay. Second thing, if any non-resident, non-citizen crew come to India for shooting, for example, Avengers came to India for shooting purposes, Nimota is never going to ask taxes from this, okay, from them, because just because they are shooting in India, can we say that entire Avengers would be taxed in India? Right answer is no. Okay, non-resident, non-citizen crew coming to India for shooting movies will not constitute business connection. Third thing, for example, Donald Trump has an agent called Rahul in India. Donald Trump has an agent called Rahul in India. Donald Trump is not selling anything. Donald Trump is not selling anything via Rahul. Donald Trump is buying things via Rahul. So agent is there for export purposes, now then he shall not constitute business connection. At last, sir, if there is a foreign company, remember there is a foreign company who comes to India in special notified zones for display of uncut and unassorted diamonds. Display of uncut and unassorted diamonds. If any foreign company comes to India, this shall become Indian income. This shall not become Indian income. These four are exceptions to business connections. Oi, are you understanding? Are you understanding? If you are understanding, just mention right, sir, clear, sir. I mean, see, every time now you have to mention this word clear. Killiar. This clear word is to be continuously pressed by you. Just to keep this word typed and just send it multiple number of times clear so that I am aware that you are understanding. So these are this is the exceptions to business connection. These four things are not Indian income. Next thing, what is considered as Indian income, that is income from property located in India. For example, there is a person called Ross. He is a non-resident. He has a property in Coimbatore. He has a property in Coimbatore. Okay. And that Coimbatore property is yielding some rental income. Lawmaker says that if you have any rental income or if you have any income on the asset which is in India. If the asset is in India, now then any rental income would be Indian income. If the asset is in India, then any income on this would be Indian income only. Done, sir. Second Indian income also done. Third thing, sir, for example, there is a person called Ross. There is a person called Ross. He has a flat in Coimbatore. This Ross sells this asset to Rachel. She is also non-resident. Ross is also non-resident. Ross sold the house to Rachel. Lawmaker says that if asset is located in India, then any transfer of such capital asset shall be taxable in India only. If asset is located in India, then transfer of such would be taxed in India only. So capital gain will also be taxed in India. Up to now, five things we understood: business in India, business connection via significant economic presence, rental income, and at last we understood capital gain income. These are the incomes, Indian incomes. Next, very, very, very important case. Very, very important case. I want your 100% attention for at least the next 10 minutes. At least next 10 minutes, 100% attention. Sir, for example, there is a company. Okay, examples, try understanding the examples. For example, there is a company called Hutchison SR, which is an Indian company. 67% of the Hutchison SR are held by CGP, which is a Mauritius based company. There is another company which is HTIL, which is a Hong Kong based company, which holds 100% shares in CGP. And there is another company called Vodafone PLC, which is Singapore based company. Now, if this Hutchison SR, that is an Indian company, if it is sold, then any capital gain would be Indian income for sure because asset is located in India. But sir, very logically, HTIL and Vodafone decided that instead of Hutchison SR, now CGP can be transferred from HTIL to Vodafone. Now, in this transaction, the seller is non-resident, buyer is also non-resident, and asset transferred is also outside India. So ideally, this should not constitute transfer in India. No transfer in India, no capital gain in India. Ideally, this was the case, but we have important provision for this. Lawmaker says that if this foreign company that is CGP, if this foreign company derives a substantial value from assets located in India, that means this foreign company doesn't have any own existence. It is only existing because it has assets located in India. Then in that case, this foreign company is nothing but asset located in India. Any transfer of the shares of this foreign company would be taxed in India. Very important thing I'm saying. Asset is not in India. But if it derives value from assets located in India, then this asset will be deemed to be located in India. Any transfer on this would be taxed in India. Very, very, very simple point, sir. Very simple point. How do we solve the questions? Always do a pinky promise to me. You are going to follow three steps. Everybody who is watching this video, give a pinky promise to me that you are going to follow three steps. First of all, first step. Always, always, always like the video that you are watching. First step is always liking the video that you are watching. If you don't like the video, now you will not have interest in the topic. Okay? Always like the video. Okay? Second thing. Okay, okay. This was not the first step. First step, let me complete now. Clear, sir, clear. First step is always finding out the valuation date. Okay? Valuation date. What is valuation date? Always understand. On what date we are going to value? See, valuation will be done of this foreign company only. Entire information, entire details will be of this foreign company only. Everything will be done of this foreign company. So exactly on which date we are going to value, we need to calculate that. On which date we are going to value, we need to calculate that. Perfect, sir. Perfect, sir. Perfect, sir. Now, what is the date of valuation? The date of valuation is two of. Either it is balance sheet date or either it is transfer date. Either it is balance sheet date or either it is transfer date. It has to be either of two. Perfect. In both the case, you have to check book value of assets, book value of the total assets, book value of total assets. Without liabilities, okay? Without liabilities. You don't have to reduce liability without reducing liability, without reducing liability. If increase is more than 15% now, then you shall take transfer date. If not, then take the balance sheet date. That's it. As simple as it can be. You have to check the last balance sheet date. You have to check the transfer date. If book value of the total asset increase is more than 15%, then in that case, you are going to take the transfer date. Else, you are going to take the balance sheet date. Can you all help me out as to how do we calculate the valuation date? The same example that I have given you now is given here as well. Try helping me out with the valuation date. CGP Mauritius balance sheet date has been given, where investment in Hutchison SR 5,000 crore, current assets 3,000 crore. That means total assets are 8,000 crore. This is given to us. Then on transfer date 30th September 2025, it has been given to us that investment is still 8,000, current assets are 4,500 crore. That means total assets are 9,500 crore rupees. If you carefully check whether increase is more than 15% or not, whether increase is more than 15% or not, right answer is yes, sir, increase is more than 15%. If you add 15% to this, it is nothing but 9,200 crore. I think that is what somewhere it comes out to. Increase is more than 15% now. So our entire valuation will be done on transfer date. Always first step is valuation date. Second step that you have to do is finding out the golden ratio. What is this golden ratio? So golden ratio is nothing but such foreign company only. Foreign company, who is the foreign company? Again, the CGP. Foreign company. You have to find out the FMV of total assets. Whatever the total assets this CGP has, na FMV of total assets without reducing liabilities. Without reducing liability, you shall take in denominator, and on numerator you shall take, sir, FMV of Indian assets. Again, without reducing liability. What does that mean? Understand. Of this foreign company, you are taking out whatever the total assets are. And out of the total assets, how much are the Indian assets? This would tell you how much percentage this value derives. If this golden ratio is more than 50%, 51%, if it is more than equal to 51%, in that case, so this foreign company is deriving value from Indian assets. Remember, in addition to that, Indian assets, this Indian assets should be more than 10 crore. Huh? This Indian assets should be more than 10 crore. Then only we will say that it is deriving value from Indian assets. What did I say? FMV of the total assets multiplied by FMV of Indian assets. FMV of the total assets multiplied by FMV of Indian assets. If this is more than 50%, if this is more than 50% and Indian assets are more than 10 crore rupees, in that case, this company is deemed to be deriving value from Indian assets, deemed to be deriving from value of Indian assets. Perfect, sir. Third step. Acha, can you help me calculating this golden ratio in this question? In this question, sir, what do we have to check, sir? On the valuation date, whatever the balance sheet we have now, we have to find out the FMV of the total assets. FMV of the total CGP is given 10,000. Okay, nice. FMV of the Indian assets are being given 8,000. So Indian assets are 8,000, and out of that 8,000, only 67% is held by the Indian company. Sorry, this foreign company, 67% are being held. So we shall take 67%. 8,000 into 67%. So Indian assets are 5,360. That means 53.6% is Indian assets. Just think of it. Out of 1,000 crore assets or 10,000 crore assets, 53% are Indian assets. That means you have no existence of your own. Whatever you are earning is because of this Indian company only. So provision says we can say that foreign company derives substantial value from asset located in India. Now it comes capital gain. Sir, whatever capital gain is computed, multiply that capital gain with the golden ratio. Whatever the golden ratio that we have arrived above, multiply it with the golden ratio. Because since not all the assets are located in India, so entire capital gain would not be taxed in India. Only that percentage of Indian assets we have, now that percentage will be taxed in India only. So that is how things go. FMV of Indian assets in proportion to shareholding of CGP Mauritius, that is 5,300. We have calculated that. Now, whatever the capital gain we arrived, capital gain was 11,000 crore. In this now, we shall multiply the golden ratio, 53 divided by 100, that is 5896 crore would be taxed in India. Very simple provisions. These are very simple provisions. These are not technical, not difficult at all. Let us once do a question so that we understand this provision well. I said now 3 steps you have to follow. 3 steps you have to follow. Always follow the 3 steps. Okay. Question number 98. If you are able to follow these 3 steps, now there is nobody who can wrong your answer. Who can ignore your answer? Who can cut your answer? Nobody. 3 steps. First step is finding out the valuation date. Second, finding out the golden ratio. And third thing, finding out the capital gain into golden ratio. Okay? This golden ratio is the word coined by me. It is not mentioned in law. So you are not going to write the golden ratio. You are just going to write the ratio. XYZ is an Indian company engaged in business of manufacturing and packaging materials. So we have XYZ. It is business of manufacturing and packing material having its manufacturing facility in India. Okay. XYZ is the wholly owned subsidiary of Flix. ठीक है, so there is a company called Flix. It has 100% shares in XYZ. Okay, perfect, sir, perfect. A company incorporated in country M. So companies incorporated in country M. Angelo and James, a citizen and resident of country N. So Angelo and James. James. Wow. Holds 50%. So Angelo holds 50% and James holds 50% of the Flix. Angelo and James have invested 10 crore or 100 crore. The cost of acquisition for Angelo is 100 and cost of acquisition for James is also 100. Wow. Wow, sir. On 1st June 2025, Angelo and James received an offer which they believe is fair and sold their entire stake to of the Flix to Ishan, the resident, at an equivalent value of 350 crore rupees. So Angelo sold entire shareholding at 350. James also sold, and this entire shares were sold to Ishan. Ishan is also non-resident. Now just think of it. Seller is non-resident, buyer is non-resident, asset transferred is also non-resident. This foreign company is also non-resident. Will this be taxed in India? Ideally not. But if this foreign company derives value from the asset located in India, if this foreign company derives value from asset located in India, then this will be taxed. How do we calculate? How do we determine? So 3 steps again. Always understand 3 steps. First step is finding out the valuation date. We are being given 3 dates: 31st December 2024, 1st June 2025, and 31st December 2025. Balance sheet date is this, transfer date is this. Post transfer, any date is not relevant. After transfer, any date is not relevant. It is irrelevant, absolutely irrelevant. But before transfer, it is relevant. Perfect, sir. Before transfer, we have 2 dates. We have balance sheet date and we have transfer date. I have told you the formula. I have told you the trick. Find out the book value of the total assets. Find out the book value of the total asset. Check out the increase, whether increase is more than 15% or not. Here, in the Flix, in the foreign company, book value of the assets are 1000 and now book value are 1300. From balance sheet to transfer, can I say increase is more than 15%? Right answer is yes, increase is more than 15%. In that case, what will happen? Sir, we shall do valuation on transfer date. Entire valuation will be done on transfer date. Now here, we are done with finding out valuation date, step number 1. Step number 2, find out the golden ratio. What is the golden ratio? FMV of total assets or FMV of Indian assets without reducing liability. Can we check liability is given FMV of the total assets? Oh wow! FMV has been given 1100. FMV of the Indian assets, how do we arrive? See, Flix holds 100% and details regarding XYZ have been given. FMV of the total assets, so FMV of the Indian assets have been given. FMV of the total Indian assets have been given, that is 600 crore. Wow! Sir, can we say 600 divided by 1100? Sir, what is the golden ratio? 54.54%. 54.54%. And Indian assets are more than 10 crore rupees. Can I simply say that this foreign company is having no existence of its own? This foreign company has no existence of its own. This foreign company is only existing because it has Indian assets. Therefore, since Flix derives value from assets in India, transfer of 250 would attract a capital gain in India. And how much capital gain? 250 into 54.54%, because that is what the Indian assets are. That is how we are going to solve the question. If it is clear, just mention the word clear, Killiar. If it is clear, just mention the word clear. Some small tichu pointers. Some small tichu pointers. What is tichu? Very small pointers. Okay? Very small tichu pointers. Listen up. Listen. This is again Hutchison SR. This is Indian. This is foreign company CGP, and there is company called HTIL. There is company called Vodafone. See, if Indian company distributes dividend, it is always Indian income. Clear, sir. Clear, sir. Perfect. If Indian company distributes a dividend, it is always it is always Indian income. If Indian company distributes dividend, it is always Indian income. But there is a catch. If this foreign company who derives value from Indian assets, if this foreign company distributes dividend, will it be considered as Indian income? Right answer is no. Only Indian company distributing dividend is Indian income. But yeah, this foreign company will, even if it derives value from Indian assets, it is only for capital gain purpose. No Indian income at all. Okay, sir. Okay. Now, second thing, if this foreign company is being sold, this CGP was sold in our case. If this CGP is sold, who is going to report to government of India? Who is going to report to government of India? Sir, government of India will be reported by this Indian entity. This Indian entity has to report to government, and if it does not report, then what are the consequences? Ideally 5 lakh rupees of penalty. But sir, if entire management of this foreign company has been changed, oblique ownership of this foreign company has been changed, in that case, if this Indian company does not report now, then 2% of the transaction value is the amount of penalty. Till when this Indian company has to report? This Indian company has to report within 90 days from end of the financial year of the year of transfer. The year in which transfer took place, let that year end within 90 days. This Indian company has to report. Sir, in Form 49D. Sir, perfect, perfect, perfect. Also, last point. This is a bit technical. If you understand it well, well and good. If you don't understand, you can skip this point out. Sir, for example, this is Hutchison SR. This is CGP. CGP holds 67%. Any transfer of CGP would be taxed in India. Simple. Any transfer of the shares of the CGP would be taxed in India. So there is a small company called Archana Limited. Archana Limited outside India. Archana INC, not Indian Limited, but INC. This holds 5% in Indian assets. Archana INC holds 5% in Hutchison SR because see 67% is held by CGP. So other 33% would be held by somebody else. Now, for example, Archana holds up to 5%. Total assets are 100 crore and Indian assets are 90 crore. Lawmaker says still Archana Limited would not be taxed in India because if somebody is holding only less than 5% or up to 5% in Indian assets, now in that case, we are not going to tax. If a non-resident holds only up to 5% in Indian company, now we are not going to tax that in India. There are many people who must be holding crores in Reliance, but they are less than 1% also, so they are not taxed. Somebody holding more than 5% will only be taxed in India. Gotcha, sir, gotcha, sir, gotcha. Gotcha. So coming on to next Indian income. I hope this entire indirect transfer was clear to you all. Entire indirect transfer was clear to you. Now, second thing, I mean, second clause of section 9(1), what this says. If there is anybody who provides services in India, who provide employment services in India, lawmaker says that salary income would be Indian income always. If services have been rendered in India now, then this income would be Indian income always. If employment services are provided in India, rendered in India, then it is always Indian income. So if services rendered in India, then salary income shall be Indian income. Simple, very simple. Sir, there are many Indian diplomats, Indian consulates who work outside in other countries. Now, in that case, what happens, sir? They become non-resident after 1 or 2 years. They become non-resident. Once they become non-resident now, how can we tax them? Government of India pays the salary. So received outside India, non-resident, how can we tax that? So lawmakers clearly said that if salary has been received by the Indian citizen who are working for government services outside India, in that case, whatever the salary government pays to them now is always Indian income. We are clearly stating that whatever salary that they are receiving is Indian income. But we have to make sure two things. Whatever the perquisites, whatever the allowances that they are receiving is as exempt. Some government employees receive houses at their respective countries. They receive they receive educational allowance for their children. Whatever they receive is absolutely exempt. Absolutely exempt. Then the dividend paid by Indian company. See, Indian company distributing dividend anywhere outside India, inside India, it is always Indian income. No questions, no strings attached. It is an Indian income. Perfect, sir. Perfect, sir. Perfect. बिल्कुल perfect. Now, interest payable. Interest payable. Interest payable. 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 Interest payable. Okay. Now, what about interest payable? Listen, very carefully listen. If non-resident has given any money to Indian, maybe be it government, if non-resident has given money to government of India and government of India pays interest on that, lawmaker says that it is always Indian income. Any interest paid by government of India is always Indian income. No questions, no strings, nothing attached. Always Indian income. Second thing, sir, it is possible that non-resident has given money to resident person. Wow, wow. Resident person pays interest. It is always Indian income, but there are two exceptions to this. What are those two exceptions? If a resident person has utilized this money to do business outside India or to do investment outside India, for example, investing in South African securities, investing in Chinese securities. So, what did I say? Ideally, whenever a resident person pays interest, it is Indian income. But if such money has been used to do business outside India or to do investment outside India, it is not Indian income. Now, next we have income via non-resident. Understand this very carefully. If a non-resident pays any interest to non-resident, can I call it Indian income? Right answer is how can you, sir? How can you? How can you? Take it. But sir, if this loan money has been sent to India to do business, okay? If that loan money has been came to India to do business in India, then interest income shall become Indian income. Very simple, very fair, very clear. What about royalties? Sir, same thing will go for royalties. If somebody a royalty and FTS, if if non-resident has provided services to government of India and government is paying royalty FTS payment, lawmaker says it is always Indian income. Similarly, if non-resident has provided any royalty FTS services to resident person, it is always Indian income. But if this royalty services have been taken to do business outside India or to do investment outside India, if royalty FTS services have been provided to do business outside India, to do investment outside India to a resident now, in that case, this is not Indian income. Otherwise, normally Indian income only. If non-resident pays any sum to non-resident for royalty FTS, ideally it is not Indian income. But if payment is being done to do business in India or to do investment in India, then this shall become Indian income. Okay. So very clear. Three things very common, very, very common. Government of India paying any interest, royalty, FTS to any non-resident, it is always Indian income. Resident paying any royalty, FTS, interest, it is always Indian income. But if resident uses this asset to do business outside India, to do investment outside India, it will not be Indian income. Any non-resident paying any non-resident paying any non-resident interest, royalty, FTS to do business in India, this is Indian income. Any royalty FTS, not interest, but any royalty FTS paid by one non-resident to non-resident to do investment in India, this is always Indian income. What exception did we miss out? If NR paying NR interest to do investment in India, this is not Indian income. Okay? This has been left out to promote investment in India. We don't have to get into depth of that. Okay? Important, sir. Very, 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 very super duper important thing. Very, very important thing. What is actually the royalty? What do we actually say royalty is? Lawmakers say that if you have any patent, invention, secret design, for which you have transferred all the rights, that is royalty. Whatever money you receive, that is royalty. Sir, if you have patent, invention, secret design, and you have let somebody use it and you are receiving money, that is also royalty. Transferring all rights or letting somebody use that shall also constitute royalty. Sir, if you are telling how to use that formula, secret design, imparting knowledge, income would also constitute royalty. Okay, transferring all rights, letting somebody use that asset, imparting knowledge. Okay, these are about intangible assets. Very, very, very important, sir. Very, very important, sir. If you have any commercial equipment, and that commercial equipment has been given to somebody for usage purpose, sir, commercial equipment shall also constitute royalty as per section 9. Normally till now, whatever basics you have understood since your class, since your small classes now, normally tangible asset rental is not royalty, but section 9 clearly states that if it is a commercial equipment, as per section 9, it shall constitute royalty. It shall constitute royalty. Any kind of imparting of information regarding technical, industrial and commercial skills, ठीक है, knowledge and all, and services in connection with above. For example, secret design has been sent to India, money is paid, but to teach secret design, some extra expenses to store that secret design, some assets have been given. So extra ancillary expenses that you do now, your ancillary income they earn, and that shall also be a part of royalty. Three important considerations. Sometimes now you buy a hardware and a software under a lump sum consideration. For example, I have a laptop in front of me. Laptop is bought for 60,000 rupees. Out of that, 40,000 would go for hardware and 20,000 would go to Microsoft for royalty basis. Lawmaker says na, even half of some of the portion goes for software, some of the portion goes for hardware. Entire single money has been paid to buy the laptop now. Lawmakers clearly say that it is not royalty. It is not considered as royalty. Second thing, payment for downlinking news channel shall constitute royalty. For example, I don't know what TV shows you watch, but when I was young now, my mother used to I used to sit with my mother and she used to watch Khatron ke Khiladi. ठीक है, खतरों के खिलाड़ी she used to watch. I don't know what shows you watch right now, but my mother used to watch खतरों के खिलाड़ी. Now खतरों के खिलाड़ी we used to appear on Colors. Colors is was appearing on my TV. Colors TV was appearing on my TV. It's not simple. It's not as simple. Colors TV channel producers now had to pay at least 10 lakh rupees, 20 lakh rupees to Tata Sky to downlink this channel on their satellite. See, Tata Sky, Dish TV, Airtel, these used to have their these used to have their Dish TVs on our rooftops. Okay? Any channel that we want in our Tata Sky now, the Tata Sky used to downlink this channel from their satellite to our rooftop. So this downlinking payment, if any production house, if any TV channel used to pay any downlinking fees to get that channel downlinked to the Dish TVs, in that case, it constitutes royalty. Third thing, sir, if there is any film and that film is either sold, distributed, or exhibit, whatever the consideration received is royalty. Filming is very clear. Any kind of distribution, any kind of exhibition, any kind of uh, distribution, exhibition, and sale shall constitute royalty. So this all implies royalty. What is fees for technical services? Can you all utter TMC? Which party is ruling as of now in Bengal? I don't know when you will be watching. Maybe party would change. As of now, there is a party in there is a party in Bengal called TMC, Trinamool Congress. I hope you all are aware of that party. That Didi wali Trinamool Congress is in Bengal. Now, this is how you are going to learn technical managerial consultancy. Technical managerial consultancy. These three words are important. These three words are important. Okay, technical managerial consultancy. You have to mention technical managerial consultancy. These three words are very important. Whenever you provide technical services, managerial services, and consultancy services, these are a part of FTS. But remember, whenever there is a construction services, it is not FTS. If you provide any assembly services, this is not technical services. If somebody provides you mining services, this is not technical services. And any income which is chargeable under the salary head is not technical services. Done with FTS? Done with FTS? Yes, sir. Absolutely done with FTS. Last, last Indian income. Last Indian income. Just a second. Just a second. Am I audible? I'm audible now. This was Indian income. Last Indian income that we are going to discuss. If any resident person gives money to non-resident, to RNOR, to foreign company which exceeds 50,000 rupees now, then this is a gift to the non-resident and this is covered as Indian income. Movable assets, immovable assets are not covered. Of course, you cannot give movable assets to non-resident, property to non-resident. Movable assets are not covered here. Now, these are the Indian incomes. What are the Indian incomes? Did just say? What are the Indian incomes that we just say? Line say. First Indian income was business in India is always Indian income. Second thing, business connection is Indian income. Business connection via significant economic presence is Indian income. Then we came on to asset is in India, then income received from that asset is also Indian income. Asset in India, transfer of that asset is also Indian income. Asset outside India, substantial value deriving from Indian assets is also Indian income. Then we have salary income, Indian income. Salary of a diplomat, foreign consulate is also Indian income. Then we came on to dividend from Indian company, that is also Indian income. Then we came on to interest, royalty, FTS, this is also Indian income. At last, gift is also Indian income. These are the Indian incomes as per section number 9. Take a long breath. Where do we stand right now? We started with NR taxation with a aim, understand who is a non-resident. I think we are very much clear with who is a non-resident. Then we came on to which income of a non-resident we can tax. First thing that we can tax is only his Indian income. Only thing we can tax is Indian income. What is Indian income? Income received in India, deemed received in India, and income accrue arise in India. You understood everything. Now we know which income to tax. Now we know which income to tax. Now we have to tax that income. Now we have to tax that income. What will be the tax rate applicable to that? Should we start? Everybody just mention this word clear so that we can start off with tax rates because I am super excited. I mean, I'm really enjoying this session in English, to be honest. If things are clear, just mention the word clear so that we can move on to tax rates. Now, sir, clear, 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 clear. I have done some homework for you all. Okay? I have made some handwritten notes for tax rates. These handwritten notes have already been circulated to Telegram channel. In Telegram channel, once you go to file section, there would be a PDF with the name non-resident taxation tax rates. It would be mentioned there. Whatever thing that I am speaking out now have already been shared. Perfect, sir. Let us first of all understand presumptive taxation. Presumptive taxation. We have to study tax rates, but later on. First of all, let us understand presumptive taxation. What is presumptive taxation? See, these are the percentages where you have to offer the income. These are not tax rates. First thumb rule is it is not tax rates. These are uh, PGBP declaration methods. These are not tax rates. Okay? Always understand. In NR taxation chapter, we have 7 presumptive taxation methods. What did we say? 7. 3 were in PGBP, 44 AD, ADA, and A. 3 were in PGBP. 7 are in NR taxation. Okay? 7 are in NR taxation. What are the 7? What 7 do we have in NR taxation? Let me tell you one by one. First of all is 44 AB. B for boat. A for apple, B for boat. Yes, A for apple, B for boat. So 44B, what this 44B says? 44C says you are into boat business, shipping business. Okay? You are into shipping business. If you are a non-resident foreign company, you are into shipping business now. Then you have to offer 7.5% of the specified sum. What is 7.5%? What is a specified sum? Let me tell you now. Sir, what is a specified sum? Specified sum is very I mean, simple. Try understanding. Very simple. If there is a foreign company which is into shipping business, if that ship comes to India, whatever freight received in India, freight received in India has to be taken. Whatever freight is received in India, income received in India is always Indian income. Now, likewise, freight received in India always Indian income. Always take the specified sum. Okay, freight received in India. That's it. First step. Second thing, if ship goes outside India, if ship goes outside India, If ship goes outside India, in that case, whatever freight is received anywhere in the world, that shall be taken. Two things: received in India, first thing. Second thing, if ship goes outside India from Indian port, freight received anywhere in the world, that shall be Indian income. Did we understand what is the specified sum? If it is understood now, just you have to multiply 7.5% of that. Similarly, big aircraft, 44 big aircraft, BBA, okay. In this case, if non-resident foreign company is into aircraft business, okay, then 5% of the specified sum is to be taken. What is specified sum? The specified sum is nothing but if a aircraft receives any money in India, then we have to take. If aircraft goes out of India, whatever the money is received in, we shall take. Wherever money is received, we shall take. So if it is received in India, first thing. If cargo goes out of India, then wherever the cargo is received, whatever the money is received, we shall take that. Both the things we shall take. On that, we shall multiply 7.5% and 5%. Perfect, sir. Perfect, sir. Perfect, sir. In both the cases, are we allowed any expenditure? No, sir. Already presumptive taxation, if we are given with, every expenditure is already taken care of. Sir, can you declare lower in these cases? In both the cases, sir, you cannot declare lower. Below 7.5%, below other, you cannot declare lower. You cannot. Oh my God. Sir, can you maintain books of accounts? Can you get yourself audited and declare lower? Right answer is no. Absolutely no. You cannot declare books. You cannot maintain books of accounts. You cannot declare lower than this. Sir, since we cannot declare lower, loss is not possible. Loss is absolutely not possible. But sir, but sir, loss anyway not possible, sir. How? If you cannot declare lower, you do not have any option of declaring lower. So how loss will be possible? No loss possible. Perfect, sir. Perfect. Let's do one question to understand. Sir, in marathon, you are solving three questions in exam. We are really, I mean, surprised. People don't solve question in their regular batches, but you are solving question in a marathon. Arey, all for you, all for you. Only one thing I'm asking, just to subscribe to the channel and share with your friends and like the video and hype the video. That's it. That's only I want. Did I ask anything extra? Robert is a non-resident, operates ship for goods, passenger, livestock from Dubai, Mumbai, Chennai. He provides you the following information. Received 20 lakh rupees in India. In India received, oh my God, sir, 20 lakh in India received. So 200 lakh will be added to the specified sum. 50 lakh in India, nothing to be read further, just 50 lakh rupees add here. Received 65 lakh rupees in India, received 65 lakh rupees in India. Sir, 65 lakh, 65 lakh, 65 lakh, 65 lakh, received in Dubai. Whether to be taken or not, whether to be taken or not. Sir, cargo goes from Chennai to Dubai. So cargo is going from India to anywhere now. Anywhere freight is received, we shall take. If cargo goes out of India, anywhere in the world, if freight is received, we shall take that. 65 lakh, we will be taking that. Expenses not allowed. What are the total income? 200 plus 50 plus 65. So 315 lakh is the specified sum. On that, we are into shipping business. So 7.5% we shall declare. So it is 23.625 lakh is the income. Gross winning from horse races is 25 lakhs. See, this will be taxed at the rate of slab. This will be taxed at the rate of 30%. If you check out winning from horse races, 7.5 lakh tax at 30%. Other thing tax at slab rate, and this will give you the gross tax liability at 4% cess, and this will give you the final tax liability. Oh wow, sir, wow, wow. These two presumptive taxation very simple. B for boat and BBA for big aircraft. Okay, 7.5% or 5%. Now next two. 44 BB and triple B. What this says? See, if there is a foreign company who has big plant and machineries, and these big plant and machineries now have been let out to India. These plant and machinery are for extraction of mineral oil. Okay, they have let out this machinery to India and they are earning rental income. Lawmaker says whatever the rental income they are earning, they shall offer 10% of the specific 10% of the specified sum. What is specified sum is nothing but if machine has come to India, then whatever rental received. If machine goes outside India, then in that case, whatever the rental the Indian pays. All in all, rental received. Okay, all in all, rental received. Whatever the rental is being paid to them, the 10% of that has to be offered as income. 10% has to be offered as PGBP. Similarly, 44 triple B. Can a loss from other business and Chapter 6 deduction can be set off in non-resident presumptive income? First of all, under these presumptive taxation, no loss can be set off. Okay? No loss can be set off under these 7 presumptive taxation. No loss can be set off. Second thing, can Chapter 6 deduction be allowed? Right answer is Chapter 6 deductions can be allowed. Chapter 6 deductions can be allowed. Chapter 6 deduction, there is no restriction as to whether you can claim or not. There is no restriction. You can get that. Sir, if 44 triple V, this implies if a foreign company is into turnkey project, sir, you have to offer 10% of your specified sum. 10% of your specified sum. Sir, what is the specified sum? Sir, if foreign company is undertaking turnkey project now, whatever the money that has been guaranteed to this foreign company, we shall take that. Amount guaranteed to be paid to this foreign company of that 10% we shall take. So if machinery has been given for prospective extraction of mineral oil, whatever rental that has been paid, first thing, if foreign company has come to India for turnkey project, whatever the amount that has been guaranteed, 10% of both of them we shall take. In both the cases, sir, can these companies declare lower? Right answer is yes, they can declare lower. 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 But sir, they have to maintain books of accounts. They have to get themselves audited. Sir, in this case, it is possible that they might have losses. Because 1 year you might have books of accounts audited and you have loss. Next year you have profits. Okay, next year you have profits. It is possible next year you might have profits. You might declare income as per presumptive taxation. It is possible. In that case, this losses cannot be set off against presumptive incomes. Losses under these 7 tax regimes cannot be set off against presumptive incomes. Not at all. Sir, under 44 ADA can be set off under those 3 sections. It is allowed. 44 ADA, if we have income from presumptive taxation and we have losses, we can set off these losses. Losses are allowed under those 3 presumptive taxation, but under these 5, we cannot set off. Okay? So loss is possible but cannot be set off, not allowed. Clearly the provision states loss is not allowed. Then 44 BBC and BBD. BBC and BBD. BBC and BBD. What is this BBC and BBD? See, big cruise. Okay, big cruise. If non-resident foreign company is into cruise shipping business, lawmaker says that whatever the amount received is now, on that you shall offer 20% as a specified sum. You cannot declare lower, so therefore loss is not possible here. Whereas 44 BBD as an amendment, what this talks about, 44 BBD says if any non-resident foreign company provides technological support to set up electronic facility in India. For example, Huawei from China provides technological support to Indian company to so that Indian company can set up electronic manufacturing facility. Technological support they are providing, a technological support, not any mechanical support, not any support, not any other things. They are providing tech support so that Indians can open more and more electronic facilities. Okay? Then in that case, now 25% of the specified sum has to be offered as their income. What is the specified sum? Amount guaranteed to be paid. In this, you can declare lower, books of accounts can be maintained, but loss is not possible. Loss cannot be set off against this presumptive income. At last, section 172. 172, what this speaks out, if any non-resident foreign company is into shipping business. Which shipping business? The occasional shipping business. 44B also talks about shipping business, but 170 talks about occasional shipping business. What is occasional shipping business? See, there would be ships now that would come only India once in a lifetime. There are some ships which come to India only once. They might not ever come back to India. It is possible. They might never come back to India. Yes, sir, it is possible. If any shipping business is there who occasionally comes to India, lawmaker says that they have to just offer 7.5% of their freight receipt. Freight receipt is given, 7.5% of that is to be offered. Can they declare lower? No, lower cannot be declared. No loss is not possible because they have to offer 7.5% as their income. Common pointers. Section 172, if any non-resident or foreign company which offers under section 172, that means a Occasional shipping company. In this case, now they have to file ROI in previous year only, because once in a lifetime they are coming. So government would not wait for them to file ROI in next year. Government would force them to file ROI in previous year only. Second thing, what is a cruise shipping business? Lawmaker says that any business which is only for leisure, only for leisure. Leisure means time pass, which has minimum 200 passenger capacity and which operates in at least two ports, now then only it is called cruise shipping business. And at last, so these are the presumptive incomes and not the tax rates. Whatever percentage we have told is not the tax rates, these are the incomes. Now, my personal doubt, I'm thinking that you will forget this 44 BBD and you will confuse with it with PBC. Okay? Let me simplify that for you. 44B, boat, 7.5%. 44 BBA, big aircraft, 5%. 44 BBB, rental of plant and machinery, turnkey project, 10%. BBC, C comes first, D comes later. That is how ABCD works. C comes first, D comes later. So C shall be smaller, D shall be bigger. First comes is a smaller, then bigger comes the bigger. In that case, now C will be having 20% and then D coming 25%. So as soon as you go further, rates will increase. C 20%, D 25%. Always remember. In exam, I cannot afford this thing that you are forgetting the presumptive tax rate, presumptive rates. It should not be the case that you are remembering 20% for BBD. No, 25% for BBD and 20% for BBC. Always remember this thing. And at last 7.5% for 172. Come on to tax rates. Let us understand slowly and steadily what tax rates do we actually have. Do we actually have? Let me tell you. You will understand every bit of it. Under direct tax, we have understood that if there is any listed securities and then there is any long-term capital gain, it is taxed under 1128. Tax rate is 12.5% over 1.25 lakh. That is how the tax rates are. Is it anywhere mentioned in that section that tax rate is only for resident and not for non-resident? Anywhere mentioned? Sir, it is nowhere mentioned. That means that rate is applicable to non-residents as well. Moving further. 111A. If you have short-term capital gain on listed securities, rate is 20%. Anywhere mentioned that it is only for residents? Sir, no, it is for non-residents as well. 112. Other than long-term capital gain on other assets. 12.5% for resident and non-resident. Both the category feel the same thing. Other STCG, such slab rates, sir, same shall apply for resident and non-resident. Under these four sections, we have not differentiated between resident and non-resident. Strange. Lottery. 30% tax for resident and non-resident as well. No differentiation at all. Wow. Online gaming, even though prohibited now, but for your attempt for some period, it was valid. So online gaming, 30% for resident and non-resident as well. Wow. Virtual digital asset, 30% for resident and non-resident. Wow, sir, everything is for resident as well as non-resident. I will tell you why I'm telling this. Okay? 115 BAC, if you remember, up to 4 lakh no tax, 4 lakh to 8 lakh 5%, 8 lakh to 10 lakh 10%, 10 lakh of 12 lakh to 16 lakh 15%, 16 to 20 20%, 20 to 24 25%, more than 25 30%. This is the slab rate. So this was also applicable for resident and non-resident as well. This was also applicable to non-resident as well. Strange. Very strange. Surcharge, sir, up to 50 lakh, no surcharge. 50 lakh to 1 crore of income, 10 crore, 10% surcharge. 1 to 2 crore, 15%, or more than 2 crore, then 25, 37%, whatever the surcharge it is, 25, 15, 37, whatever it is. So this was also not limited to just resident. For non-resident also this is applicable. Foreign company, we have understood that any tax rate is 35% and surcharges 2%, 5%, we are aware. If any non-resident resident has any unexplained income, it is taxed at 60%, 25%, and 4%. We are aware of this thing as well. That means in the entire direct tax, we have whatever tax rates we have studied are applicable to resident and non-resident as well. The biggest mistake that students do in this chapter is they forget these old tax rates. You need to understand This NR taxation gives only limited number of tax rates. If a question is asked, question will not be limited to the given tax rates. It is possible that question might ask some tax rates that are given in your direct tax portion, not in this topic. It is possible now because there are only limited tax rates given in NR taxation. And if those limited tax rates are not applicable, you have to refer to direct tax. It is possible. That is why there has to be a holistic approach whenever you solve questions from tax rates. You need to understand that first process is to find out the tax rate in NR taxation. If you have tax rates applicable and available in this chapter, now you shall opt for that. If you do not have any tax rates, what will you do? You will go to regular provisions immediately. I will tell you how to proceed. For that matter, I have summarized things for you all. How we have summarized things? See, non-resident brings foreign currency in India. Okay? So we give benefit to non-resident. Now, there are two types of benefits we give to them. First of all, there are certain categories of non-resident who are as good as Maru Makkal. I don't know I am correctly pronouncing that word or not. Maru Makkal is something your son-in-law. Correct? If somebody please correct me. Maru Makkal is your son-in-law. There are some non-resident whom we call Maru Makkal. I mean, please correct me if I am correctly stating that. Some people are like our son-in-law, like a Damadji. We give special benefits to them. So there are 5 people who are specially given some benefits. Somebody please correct me. What we call son-in-law in Tamil, Telugu, Malayalam, whatever, son-in-law. Okay? Now, there are certain different kind of taxpayers. There are certain different kind of taxpayers whom we give special benefits. So if question is asked about these 5 people, now you just have to refer these provisions and then that's it. But if you are being asked from somebody else who are not these special person, you have to refer the different provisions. There are certain income-based benefits. For example, dividend, FTS, interest, GDR, cap gain. There are certain benefits to non-residents. Okay. So if you consider category-wise, there are 5 people which are very important to government. So concessional tax rates given to them. If not, then concessional tax rates given on certain specific incomes now. That is also given based on different incomes. So these are the different benefits. This is the demarcation I have made to make it easier for you. What did I say? 5 different people. If not people, then 5 or 6 incomes on which benefit is given to every non-resident. Simple. And just correct me. I am correctly speaking that word or not. Maru Makkal was something. Damadji means son-in-law. Okay? Correct me in the comment box now. First of all, FII. Who is the biggest, the best, the favorite of government of India? Favorite son-in-law of government of India? FIIs. Let me tell that to you. What the tax rates FIIs have been given with. First of all, FIIs are being charged to tax under section 115 AD. 115 AD. These are the mandatory provisions for FIIs. They don't have a choice to go for any other thing. They have mandatory provisions. FII can be in the form of a company. It can be in the form of AOP as well. Company, very simple. Incorporated as company, incorporated as AOP, whatever they want to. We need to understand FIIs cannot invest in anything other than securities. Whatever FIIs invest now, it will be only securities only. FII cannot invest in real estate. FII cannot buy gold. FII cannot invest in any other physical assets. They can only invest in securities. So if they have long-term capital gain under 112A, 12.5% over 1.25 lakh, as good as resident only. 111A, so 20%. LTCG 12.5% as good as to other people. Other STCG, sir, FIIs earning short-term capital gain on unlisted securities or any kind of other securities. Now, then 30%. And FII earning any interest or dividend is 20%. As of now, remember 20%. I will come on to this later on. Very simple. Any suspicious thing that you found? Sir, very simple thing na. Interest dividend 20%, other STCG 30%, LTCG 12.5%, 111A 20%, and this 112A 12.5% over 1.25 lakh. Perfect, sir. If FIIs earn any interest dividend, any expenditure allowed against this interest dividend? Right answer is clear, no. Clear, no. No section 57 deduction, no other expenditure allowed, no expenditure at all allowed. If they earn capital gain, any expenditure allowed. See, capital gain is computed the way it is. Full value of consideration minus transfer expenses will give you net consideration minus cost of acquisition. This will give you capital gain. So this is how you are going to compute. Like you do normally, you will compute here as well. Whether TDS is deducted of FIIs, for interest and dividend is deducted, but capital gain, how can you deduct by crores of money daily buying in shares, buying and selling? You cannot deduct TDS on capital gain, practically not possible. ROI mandatory for FII? Of course, of course. Chapter 6 deduction, not at all. No chapter 6 deduction is allowed on the income tax at special rate. Surcharge. See, if FII is in the form of foreign company, then 2%, 5%. If FIIs are in the form of AOP, then 10, 15, 25%, whatever it is. If Inc. is mentioned, LTD is mentioned, PT is mentioned, that means you have to assume it is a foreign company. Sir, FIIs might have some F&O income, future and options income. Lawmaker says that the regular provisions of income tax apply, whatever the slab rate. If it is a company, then 35%. If it is AOP, then slab rate shall apply. Done. Done with the FII. Done, 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 done. Done with the FII, bhaiya, or there is nothing extra. Done with the FII. That's it. This is the only FII taxation that is there in our syllabus. Coming on to next, Maru Makkal. I mean, please correct me if I am using that word correctly. Maru Makkal is the son-in-law only now. Second thing, overseas financial organization. Now, what are these overseas financial organization? They are being governed under 115 AB. What lawmakers say in this regard? Overseas financial organization can be a foreign company, can be AOP. These are nothing but people with too much money outside. They tie up with an Indian PSU bank. They take SEBI approval and they can invest in mutual funds only. So this has to be understood now. If you don't know they can invest in mutual fund only, you will always be confused. What if they sell any property? What if they sell any gold? Arey Baba, they cannot invest now. They are only allowed in mutual funds. So you need to understand what they do, what they can do. Okay? So they can only invest in mutual fund. They can have long-term capital gain in mutual fund. Sir, if they have long-term capital gain, flat 12.5% will be charged. No 1.25 lakh benefit. Even if listed mutual fund, no 1.25 lakh benefit. No 1.25 lakh benefit. If they have short-term capital gain now, see, short-term capital gain has not been mentioned under the section. It is not mentioned under 115 AB. So what you are going to do? Go to regular provisions. If mutual funds are short-term capital gain, these are listed, then 20%, unlisted, then slab rate. Interest and dividend will be taxed at the rate of 10%. Sir, if these OFOs having any interest dividend income, provision says no expenditures is allowed. Capital gain, the way you calculate, you shall calculate. TDS will be deducted on Indian income component, but not on capital gain component. ROI is mandatory. Chapter 6 deduction not allowed. If it is in the form of foreign company, then surcharge of foreign company shall apply. If it is AOP, then surcharge for AOP shall apply. Done with second FIIs, sorry, OFOs. I don't know how much difficult it was, but it was easy. I do think it was easy. Second son-in-law done. If you carefully see now, there are not too many benefits. This short-term capital gain of 30% in FII was a benefit. This 10% tax rate for interest dividend for OFOs was benefit. Otherwise, there were normal provisions only, nothing extra. Ah, yes, 1.25 lakh benefit is not given to OFOs. Sir, where 1.25 lakh benefit is not given, I will tell you that as well. Okay? I will tell you that as well. Third son-in-law is NRI. NRI. Third son-in-law is NRI. Who is an NRI? First of all, lawmaker says if there is any Indian citizen or person of Indian origin, plus he is a non-resident now, then he is called NRI. Government has given only one benefit to NRI, to be honest. Only one benefit to NRI. That too not actually a benefit, but you will understand that. If non-resident Indian has a forex asset, has a forex asset, has a forex asset. Sir, what is the forex asset? See, shares of Indian company are forex asset. Shares of Indian company are forex asset. Company can be private company, company can be public company. That's okay. Debentures of a public company are forex asset. Debentures of public company are forex asset, not a private company, public company. Deposits of public company are forex asset. Municipal securities are forex assets. So these are forex asset. We know that thing. We know that thing very well. If NRIs have forex asset now, then on these forex asset they have optionally special provisions. I mean, they have an option to go for special provisions. If they go, they will be governed in this manner. If they don't go, they will be governed with the normal provisions of Income Tax Act. What benefit do they have? If NRIs have forex asset now, on forex asset, long-term capital gain is taxed at 12.5% and income is taxed at 20%. When FIIs have forex asset and they have long-term capital gain, 1.25 lakh benefit is not given. Even in case of listed securities as well, 112A benefit is not given. Not allowed. Because, sir, we are already giving you many benefits now. So 112A benefit is not given. Flat 12.5% would be taxed. No 1.25 lakh benefit given to FII if they opt for special provisions. Remember, NRI should opt for special provision, then only this concessional rate would be given to them. Perfect, sir. Absolutely fine to us. Fine, fine, fine. If they have short-term capital gain, not mentioned in the provisions. Go to regular provisions. Sir, listed securities 20%, other securities slab rate. That's it. FII having any expenditure, not allowed against income. Any capital gain, the way it is calculated. But sir, FII get a special, very, very, very special benefit. If their capital gain is long-term capital gain, now they get an exemption under section 115F. This is an exemption that they get under 115F. How much exemption? Sir, whatever the long-term capital gain is there, multiplied by cost of new asset divided by net consideration. Cost of new asset divided by net consideration. This is how much exemption that they can get. If they sell forex asset and buy forex asset now, in that case they will get this exemption. So new asset should be bought within 6 months from the date of transfer and it should be held for at least 3 years. Then NRIs would get exemption. To be precise, now this is the benefit that they only get. If you carefully see, now there is no other benefit this NRIs would get. This is the only benefit that they get. To be precise, this is the benefit. The tax rate, concessional tax rate is not the benefit. Na interest dividend is always taxed to 20%. You will understand. LTCG is always taxed at 12.5%. So no benefit in rates to NRI, but this exemption is the major benefit given to NRIs. Sir, what if NRI don't opt for special provisions? So they will be governed with normal provisions, normal tax rates. Sir, what about NRI having other incomes? For example, NRI might be having rental income, NRI might be having some business income, NRI might be having some other income. Then it would go to regular provisions of Income Tax Act. If NRI is having other capital gain other than these cap forex asset, then what about regular provisions of income tax, Baba? Regular provisions of income tax. Sir, whether TDS of NRI would be deducted? Sir, bilkul deducted. Every TDS will be deducted. Income also TDS will be deducted. Wow. So Chapter 6 deduction allowed to NRI. See, Chapter 6 deduction is very clear in itself. Any income which is taxed at special rate, no deduction allowed. Any income not taxed at special rate, it will be allowed. So income taxed at special rate, not allowed. Income taxed at slab rate, it will be allowed. Sir, whether ROI mandatory for NRIs or not, important provision. Huh? Lawmaker says that if NRI has only LTCG income, LTCG or any income on forex asset, then TDS has been deducted. LTCG and income on forex asset and TDS has been deducted. Then ROI is not required. LTCG and income on forex asset, then ROI not required, but else ROI is mandatory. Surcharge, that same surcharge of an individual, 10%, 15%, 25%, 37%, normal surcharge. Last point, sir, sometimes what happens, NRI becomes resident. It is possible that they stay in India, they become resident. In that case, now they shall continue to be governed with the provisions of the Income Tax Act, these special provisions if they want to. That's it. That is it. That is it, sir. That is it. Third son-in-law done. Fourth son-in-law. Sports person, sports association. Again, 115 BBA. Big actor. Mandatory provision. See, try understanding. If there is any non-resident, non-citizen sports person, like Cristiano Ronaldo, Remember, commentators are not included, umpires, referees, analysts are not considered. Such sports person mean who actually play the sports. If they earn sports income, advertisement income, or article in a newspaper income, then their income would be taxed at the rate of 20% and no expenditure would be allowed. If there is a non-resident sports association like Sri Lankan Cricket Board, like Australian Cricket Board, in that case, what would happen? Whatever the amount that has been guaranteed to be paid to this sports board now, in that case, we are going to tax it at the rate of 20% plus surcharge plus education, plus no expenditure allowed. If we have any non-resident entertainer, non-citizen entertainer, for example, Taylor Swift, if she comes to India and does the concert, whatever the income she would earn, lawmaker says that is absolutely taxed at 20%. No expenditure allowed. Sir, can they opt to go for slab rate on these incomes? Right answer is no. They cannot opt for slab rates. Sir, their TDS would be deducted. Yes, 194E TDS on same incomes would be deducted at this rates only. Sir, what about they have other incomes as well? Are Baba, other incomes would be taxed at regular provisions. Assume it as a non-resident and tax as if whatever incomes they are earning. Sir, whether they require to file ROI if they have only these incomes, now 115 BAA only, BB only, and TDS has been deducted, then ROI not required. If they have other income as well, then ROI is required. So chapter 6 say allowed or not? Are Baba, it will be allowed only on the income which is taxed at slab rate. Any income which is taxed at special rates, no chapter 6 allowed. Very simple. Fourth son-in-law also done. Come on to last son-in-law, which has not been tested in exam from Adams, and I doubt when it will be asked, it will create havoc for many. Sir, 11580. What this 11580 speaks out? Listen very carefully. Specified fund. What this is specified fund speak out? See, specified fund is nothing but is a kind of alternate investment fund category 3, which is registered in the form of body corporate or LLP, which is registered and operates in IFSC, and 100% of the investors are non-resident. So we have to study the taxation of this fund as well and the taxation of unit holders as well. Just listen to this. Just listen to this. You will understand. Huh? AIF category 3, body corporate LLP, IFSC registered and 100% non-resident. Sometimes what happens, these non-resident become a resident. Non-resident love India so much that they become a resident. So in that case, now 5% of the non-resident can become resident, but as soon as they become resident within year end, now within 3 months after the year end, they have to sell their securities to the other non-resident ones. Okay. How the taxation of fund would go? How taxation of fund would go? Very carefully. Fund might have this bonds. Fund might have any rupee denominated bond. Fund might have alternate investment fund units. Fund might have ETFs. Fund might have GDR. Fund might have foreign company shares. Fund might have any other securities other than shares of Indian company. Fund might have any other securities other than shares of Indian company. Any securities other than Indian company. Lawmaker says any long-term capital gain, short-term capital gain is absolutely exempt. Specified fund having any long-term capital gain, any short-term capital gain is absolutely exempt. Absolutely exempt. Absolutely. So that means everything exempt. Yes, every capital gain exempt. Sir, what about shares of Indian company? Shares of Indian company as it is 12.5% over 1.25 lakh under 112A. 111A 20%, other LTCG 12.5%, and other STCG is 30%. Like we did for FII, same for specified fund as well. So that means Indian company ke alawa everything exempt. Yes, everything exempt, bhai. So don't you do overacting a lot? Yes, I do. Yes, I do. What about income and dividend? What about if these specified fund earn interest and dividend, then what happens? See, if this specified fund invests outside India, then any interest dividend is exempt. But if it invests in India, interest dividend is taxed at 10%. Interest dividend is taxed at 10%. So any expenditure allowed on this interest dividend? Right answer is no. Any capital gain expenditure allowed? Yes, the way capital gain is calculated, we shall calculate. TDS deducted, yes, on income component, but not on capital gain. Chapter 6 deduction not allowed. Surcharge, the way it is calculated now. If it is foreign company, then 2/5. For LLP, 12%. ROI mandatory for sure. What about the unit holders? Sir, these specified fund might have some unit holders as well. What unit holders this specified fund can have? So unit holders, if these unit holders are resident, then the normal provisions of income tax, every income would be taxed. If these unit holders are non-resident now, then in that case, every capital gain, short-term, long-term, every income is absolutely exempt. Dear God, that means everything is exempt. Only shares of Indian companies taxed. Interest, dividend from Indian securities is taxed at the rate of 10%. Interest, everything is exempt in this case of specified fund. Wow, sir. Wow. Like, wow. That means five son-in-laws we covered. Five son-in-laws. Five son-in-laws. You did not confirm whether we call son-in-law Maru Makkal or not. You did not confirm. Okay. Five specified person we covered. Now, if you are being asked question from these five people, I think I have given you sufficient answer, sufficient content. Based on this content only, you will be able to answer everything. Now, if you are being asked just foreign company or just a non-resident, ideally you have to go to regular provisions of Income Tax Act. But there are certain privileges to resident, to non-resident. These are some special income-based privileges to every non-resident allowed. Income-based privileges to every non-resident allowed. Okay. What are some income-based privileges? First of all is dividend. What about dividend? Lawmaker says that any dividend paid by Indian concern to a non-resident, it is flat tax at 12%. Sorry, 12%, I'm saying 20%. Any dividend paid by Indian concern to a non-resident is taxed 20% flat. Any question of NR taxation, you have to multiply 20% only to dividend, 20% only to the dividend. Always you have to apply 20% dividend. Perfect, sir. But this 20% shall become 10% in three cases. What are those three cases? Sir, for example, business trust distributes dividend. Sir, is this working be shared in Telegram? This has already been shared in Telegram. Indian concern, dividend distribution. Lawmaker says flat 20%, but this 20% shall become 10% if business trust distributes dividend to non-resident. If IFSC unit distributes dividend to non-resident, or if company distribute dividends on GDR, then in all the cases 10% dividend would apply, 10% rate would apply. Okay, ideally 20%, but GDR, IFSC, or any kind of a business trust, then in that case 10% shall apply. Simple. Second income which is taxed at special rate is royalty and FTS. What about royalty and FTS? Let me put things into perspective for you all. If non-resident has provided some technical services or has given some patent, an Indian person is paying royalty and FTS. How things would go? First of all, always understand, huh? If non-resident has permanent establishment in India, then Baba 44 DA shall apply. That means he has to consider it a part of P&L, any royalty received, FTS received, reduce any expenses, whatever the profits turn out to be, this profits will be taxed at 35% or slab rate, whatever the type of associate is, it will be taxed that way. 44 DA. If he has PE in India, if non-resident has no PE in India, and it is not a government approved transaction, it is not a government approved transaction, then in that case, again 44 DA, you are going to apply royalty, expenses minus net profit tax at 35%. But sir, if it is government approved transaction and non-resident does not have P in India, then entire royalty FTS will be taxed at 20% on gross basis. What is this gross basis? No deduction of any expenditure is allowed. Plus surcharge plus education cess shall also apply. If nothing is mentioned, sir, I assume it to be approved one. I assume it to be approved one, and I will mention as a student if what I would do if nothing is mentioned, whether it is government approved or not, unapproved, what we will assume it government approved, and we will mention that in notes. We will mention that in notes. ICI will correct it. Don't worry, ICI will correct it. ICAI has many ways taken an ambiguous stance in this. We are very clear that we are going to take approved ones, and based on that only we are going to answer. Perfect, sir. Third special income which is taxed especially for non-resident, sir, is interest taxation. Interest taxation is a bit tricky. Take a long breath. Come on to interest taxation, what it says. See, if non-resident borrow lends money to India to infrastructure debt fund, in that case, any interest paid by infrastructure debt fund is taxed at 5%. If non-resident gave money to business trust and interest is being paid, in that case, na tax rate is 5%. Interest mein tax rate is 5%. Then, if any non-resident, if any non-resident gives money in the form of loan, bonds, RDBs, deposits, debentures, any type of loan to Indian concern and interest is paid. Normally, by default, it is 20% only, but there is an inherent condition attached to it. Non-resident, NRI, anybody giving loan, bond, debenture, securities, RDBs, anything in India, money giving money in the form of in these forms in India. In that case, interest rate would be 20%. By default, 20%, but there is a catch. So there should be inflow of forex. That means non-resident should have given money in India. It's not the case that non-resident would have given technical services, and in return of the technical services, we are issuing debentures. In that case, now, if non-resident has given technical services and we are giving him interest on debentures based on technical services, then such interest would be taxed at 35 or slab rate. 20% will be only allowed if there is money inflow in India. Otherwise, there is no 20% benefit given. Then sometimes what happens is non-resident used to give money in the form of loan, bonds, rupee denominated bonds, and agreement was done before 30th June 2025. So if agreement was done before 30th June 2023, 30th June 2023, then loan was interest on loan, interest on bond, interest on RDB was taxed at the rate of 5%. Later on, it was increased to 20%. Okay. Loan agreement, bonds issued, RDBs issued before 30th June 2023, it was 5%, and later on it was increased to 5%. Remember, if these bonds or RDBs were listed on recognized stock exchange and IFSC now, then before 30th June 2023, it was 4%, and after that it increased to 9%. Earlier it was 4%, and later on it was increased to 9%. Okay, this is the entire interest taxation. Now, 2 or 3 important pointers. Ideally, 115A is not applicable to FIIs. I mean, this section is not applicable to FIIs. I mean, this loan agreement date, you don't have to check for FIIs. Remember, in case of loan, bond, RDB, any interest that FII received now is taxed at 20% only. These provisions are not applicable to FII. Loan agreement date, you don't have to check. Loan agreement date, you don't have to check. Literally, you don't have to check. Sorry. But sir, if infra debt fund or a business trust pays any interest to FII, then 5% tax rate. Okay? Otherwise, this portion is not to be checked for FIIs. Loan agreement date is irrelevant for FIIs. I hope I answered your interest component as well. Remember, no deduction of any expenditure is allowed. If interest is taxed, dividend is taxed, royalty is taxed at 20%, no expenditure is allowed. Also, one point, sir, if there is any interest, dividend, royalty, FTS, if non-resident has only these 4 incomes and their TDS has been deducted, now then ROI is also not mandatory. Dear God. I mean, sir, we had never thought that tax rates can be this simple. I mean, tax rates can be this simple. We had never thought this minutely detailed, beautiful tax rates and marathon we had never expected. We are really enjoying. So if you are enjoying, why are you not sharing with others? Okay. Then we have GDR. Last 2 things, and then we'll be done with tax rates, and almost we are done with chapter as well. Majority of the chapter has been done. We just have to study a few extra things. Only a few extra things. Section 115 AC. Taxation of GDR. Okay, taxation of GDR is covered under section 80, 115 AC. Also, there are a type of bond called foreign currency convertible bond, foreign currency exchangeable bonds. If this specifically is mentioned now, then you have to go for 115 AC only. But normally bonds are not covered. Bonds are covered as good as loan only. If FCCB or FCB is given, then you have to go for AC. Same as GDR, you have to treat them. But if they are never asked, I'm just referring this to you. See, if you have long-term capital gain on GDR now, then flat 12.5% tax rate is applicable. No 1.25 lakh benefit. STCG will be taxed at slab, and income on GDR is taxed at the rate of 10% only. Whenever there is GDR transfer happening, there are always two transfers happening. First of all, GDRs are converted into shares of Indian company and the shares are being sold. So there are two transfers that are happening. First transfer is at the time of date of request of conversion, and second time date of sale of shares. So there are two transfers. Based on that, you have to calculate. So there I told you three instances where 1.25 lakh benefit is not available. Three instances I have told you. First of all, ideally 1.25 lakh benefit is available to everybody. Everybody. But if OFO sells any securities under 115 AB, then 1.25 lakh not allowed. NRI opting for special provision selling listed securities, 1.25 lakh benefit not allowed. And GDR is being sold now, then 1.25 lakh benefit is not allowed. Ideally allowed everywhere, but in these three cases, you are not allowed 1.25 lakh benefit. Now, at last, capital gains, sir. Ideally speaking, so non-residents are taxed as good as resident only for capital gain purposes. Non-resident is treated as resident only for the capital gain purposes, but there are certain pointers that we need to consider. If there is a non-resident or foreign company who invest in unlisted securities, always unlisted securities, not the listed one, then in that case, the first proviso to section 48(1) would come into picture. What does that mean? Entire capital gain would be done in foreign currency, not in rupees. How they would do? Whatever the sales we have done in rupees, you shall convert it into dollars with the average conversion rate on the date of sale. So the date on which you are selling, you shall take the average conversion rate. Transfer expenses will also be converted. Cost of acquisition will be converted with the average rate on the date of acquisition. And whatever the capital gain that has come in dollar now, that will be converted with buying rate on the date of sale, and this will give you the final capital gain. This is how you have to do. Second important thing, if non-resident has any bonds, GDRs, RDBs or municipal securities, non-resident transfers this to non-resident. Now this is an exempt transfer. Always understand. Non-resident transfer any bond, GDR, RDBs and municipal securities, it is exempt. Non-resident having bonds, GDR, municipal securities, and he is transferring these securities on recognized stock exchange and IFSC. Now, lawmaker says that that is also an exempt transfer. That's it. That's it. Oh God, sir, done. Done. All tax rates done. Wow. Wow. Done with the tax rates. We are left with only two or three smaller tukur point. I mean, kutur point we are left with. We are done with the chapter. Huh? All tax rates have been done. Small provisions we have to do. And these are, of course, important ones. First of all is 44C. 44C. See, if a foreign company has a branch in India, if you liked it, do mention your experience in the comment box as well. When the video is over, then second thing, do like the video, subscribe to the channel and share it with your friends as well, so that it reaches out to the more people. Now, important now. 44C. Always understand, whenever a foreign company has a branch in India, branch office in India, then this branch office has can take too much of head office expenses and it would erode the profits. It would do now. Branch would do now. Head office would allocate too much of expenses to this branch. So branch of a foreign company is allowed only limited percentage of experience or limited percentage of expenditure. How much it is allowed? Lawmaker says that 5% of adjusted total income or the actual head office expenses, whichever is lower. 5% of actual head office expenses and 5% of the adjusted total income or actual, whichever is lower. 5% of ATI or actual, whichever is lower. How do we calculate the adjusted total income? See, if whatever the total income has been given now, in that you have to do 5 adjustment. 5 adjustment, okay? And 5 adjustment you have to speak after me. Buffalo was sitting in head office, taking deduction of family planning, and then it para kudu. Repeat it after me. Okay? Everybody repeat after me. Just mention this in comment box. Once if you write it now, you will learn it. Okay? Just write in the comment box. Buffalo was sitting in head office, taking deduction of family planning, and then it para kudu. What did I say? Buffalo was sitting in head office, taking direction of family planning, and then it para kudu. Everybody. Everybody mentioned this in the comment box. Buffalo was sitting in the head office taking direction of family planning and then it Parakodu. Again, this is important. See, if in exam you don't remember this mnemonic, na, there are chances that you will forget what to add, what not to add. Okay? So, again, Buffalo was sitting in head office. Buffalo. Okay, Buffalo. Buffalo was sitting. Buffalo was sitting in head office taking deduction of family planning and then it Parakudu. So Buffalo was sitting in head office taking deduction of family planning. Oh ho ho ho. And then it Parakudu. Oh ho 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 ho. I mean, literally no sense at all, but joyful to learn. Buffalo was sitting in head office taking deduction of family planning and then it Parakudu. Somebody will say, write down complete, huh? Buffalo was sitting in head office taking direction of family planning and then it Parakudu. Now, somebody would say that what type of the class you are taking, but this is what will make you learn. This is what will make you learn. Now, Buffalo was sitting head office taking direction of family planning and then it Parakudu. Okay, what you know Parakudu? Parakudu, you know? See, under the total income now you have to do 5 adjustment. First of all is Buffalo. Buffalo is nothing but brought forward losses. Okay, Buffalo brought forward losses. Okay, every brought forward losses is to be added. Okay, brought forward losses is to be added. So it is business loss, it is speculative loss. Only brought forwards are added. Okay, there is no current year losses added. Always brought forward losses. Buffalo was sitting in head office, so every head office expense debited to P&L will be added. Was sitting in head office taking deduction of family planning, taking deduction of deduction. Any chapter 6 deduction will be added. Oh wow. Oh wow. Oh wow. Okay. And at last, sir, taking direction of family planning, any expenditure on family planning would be added. And at last, sir, udu, unabsorbed depreciation. Parakudu means it flew. I mean, I don't know. South Indian people only told me Parakudu means it flew. Flew means buffalo fly. I mean, flew. Parakudu, udu means fly. So UD, unabsorbed depreciation. That is how lamest mnemonic I came up with. So Buffalo was sitting in head office taking direction of family planning and then it flew. Flew means Parakudu, Udu means UD, unabsorbed depreciation. Done, sir. Sometimes what happens is after doing all the 5 adjustments, Buffalo was sitting in head office taking direction of family planning and then it Parakudu, it flew. Okay. Sir, you enjoy speaking these type of things a lot. I really enjoy it. Okay. Sometimes after doing all the adjustments, now the ATI comes at a loss. In case ATI comes at a loss, then what you have to do? You have to take the average ATI of last 3 years. Average ATI of last 3 years and you will be done with that. Done and dusted. Now, some of the incomes of the non-resident is exempt. Let me point out some exempt incomes that are relevant for your syllabus. And believe me, if you check out my last marathon, same exemptions I had told you in last marathon as well. And you will see that was same repeated in exam as well. In Jan 26 exam, same adjustments were repeated. See, if any non-resident has NRE account, has NRE, non-resident external account in India, whatever interest received is on NRE account, it is absolutely exempt. Non-resident should be non-resident outside India, person resident outside India, plus that NRE account should be opened with the prior approval of the RBI, then only it is allowed. Second thing you can cut out, third thing, fourth thing cut out, fifth thing cut out, just come on to this. 10, 15, what this point says. If non-resident non-resident gives loan to IFSC unit on or after 1st September 2019, non-resident giving any loan to IFSC unit on or after 1st September, it is 1st September 2019, any interest paid is exempt. Any interest paid to the non-resident on or after 1st September 2019 by a IFSC unit is absolutely exempt. Triple star rated exemption, very important. Next, also very important. See, there are many foreign diplomats that come to India. See, for example, India has an embassy from all across the world. They have embassy of South Korea, Japan, China, every every country has embassy in India. Okay. Now, for example, USA, there is a person of USA who is into Indian embassy. He has been staying in India for entire years, so he will become a resident. So whatever the salary he is receiving, that will be taxed in India. Lawmaker says that we are not going to tax. We are not going to tax that salary provided our diplomats in your country are exempt. Whatever the diplomats we have in your country now, if their salary is exempt in that countries now, then we are going to exempt your salary. So if there are remuneration of foreign diplomats in India, if salary of our diplomats in their country is exempt, plus such diplomats do not engage any business profession, then such non-citizen diplomats, whatever salary they are earning is exempt. Then stay of employees for foreign enterprises. There are some foreign enterprise that would send their employees in India for understanding purpose. In that case, whatever salary they are receiving, that is absolutely exempt, provided they do not do any business profession and they stay for less than 90 days. This foreign ship you can cut down. This last two are important, and this you can cut down. What it is? If any royalty is paid or FTS is paid for security services of India. For example, government of India paid to French government for Rafale. Then it is for security services not guaranteed. Then tax is not applicable. Similarly, National Technical Research Organization (NTRO), National Technical, for example, for nuclear atomic generation, NTRO is paying some tech royalty to somebody outside India. Lawmaker says that is also exempt. That is also exempt. So these are the only exemptions you need to be careful of. What are the other topics? Very small topics. Very small topics I need to tell, and we are done. We are actually done with the chapter. We are done with the chapter. Only one or two small things I need to tell to you. So transition mechanism. What is this transition mechanism? See, for example, there is a company, for French company, which has operations in France as well, and which has operations in India as well. This company is a non-resident company. Okay? If this is a non-resident company, if you carefully see now, government can only tax the Indian income. If it is a non-resident company, government can only tax the Indian income. Right answer is yes, sir. They can only tax the Indian income. Perfect, sir. But you know what Nimotai does? Nimotai finds out the as a throat of the other person and tries to make that non-resident company resident. As a Nimotai used to do that. Okay? So Nimotai forcefully made this company resident. Forcefully, now this company is resident. Earlier, only Indian income was taxed. Now, Indian income will also be taxed in India, and French income would also be taxed in India. Now, okay. It is possible that this foreign company will become resident. Earlier, it was non-resident, so only Indian income was taxed. But if it becomes resident, then entire world's income would be taxed. What is the catch here? Catch here is it is possible that many incomes that these non-resident have now were earlier not taxed in India. Now we are taxing that. So we have to allow additional expenditures as well. Earlier only India related depreciation we used to allow. Now we have to apply world related depreciation. Earlier India related loss we used to allow. Now we have to allow world related losses. Earlier India related exemptions we used to give. Now we have to give world related exemptions here as well. Earlier India related salary we used to allow. Now world related salary we used to allow. Are you getting me? Are you getting me? In that case, we shall take the balance sheet of the foreign company and we shall find out the income. That is the simplest thing that you do. But sir, there are two or three important pointers that are to be understood. So tax rate for this foreign company shall remain 35% only. Foreign company becoming resident, foreign company being non-resident is irrelevant. If it is a foreign company, tax rate is 35% only. As I told you initially now, tax rate is only for the foreign company. Okay? Residents and non-resident is only for total income determination. Which income would be taxed that is determined by residential status. Otherwise, tax rate is 35% only for foreign company. This is the first thing. Second thing, for example, earlier when this was foreign company now, then Indian income, I'm telling you, Indian income was sales 100 crore. Direct expenses were 40 crore and Indian income was 60 crore. Okay? Indian income was 60 crore. Now, since this foreign company became a resident of India, so Indian income plus French income both to be taxed. Now, if you do the total, sales of total world is 300 crore. Direct expenses are 250 crore. And total income is 50 crore. Oh my God. Oh my God. See the irony. When this was a non-resident, where only Indian income was taxed, then this was paying taxes at the rate of 60 crore. Taxes on 60 crore. But as soon as this non-resident became resident, world income is taxed. Sales got increased, of course. Expenses got increased, of course. But income eventually reduced. Income eventually reduced. Are you understanding this point? Sorry. Are you understanding this issue? Lawmakers clearly say that if a non-resident company becomes resident, it should pay minimum, it should offer at least a minimum that much of income if this were a non-resident. Important concept from MCQ point of view. If a non-resident company becomes a resident now, in that case, what would happen? It should offer at least that much of income as if it were a resident only. Done, sir. Second thing, for example, this non-resident company, yeah, you bolu, this resident company. Now this has become resident because Poem becomes India. Poem is India now, and this company has become resident. Now, if this company has provided technical services to Archana, okay, technical services, professional services to Archana. Now, Archana wants to deduct TDS. If Archana checks out this thing, that 194J clearly states that if you pay to a resident person, I'm reiterating this thing. If you pay to a resident person, okay, if you pay to a resident person, in that case, 194J is applicable. 10% TDS rate would apply. But sir, if you pay to a foreign company, then 195 is applicable, which states 20% plus 4%, whatever it is. Okay, section 115A will tell. So it is possible if foreign company becomes resident, na, so multiple TDS section would apply. As a resident, different section would apply. As a foreign company, different section would apply. It is possible. It is possible. I'm saying that it is possible. In that case, which TDS section shall prevail? Lawmakers clearly say in case foreign company becomes resident, TDS with respect to foreign company shall only apply, not as a resident one. Wow, sir. These things we never understood in our regular batches as well. Arey, that's a pleasure to hear. That is pleasure to my ears. Now, some more provisions. Sometimes what happens is there is a bank. Say, okay, there are some banking companies or there are foreign companies who have branches in India. Okay, branches in India. Now, whenever these branches are there, see, branches are nothing but extension of your arm. Okay. So whatever the income of the branch is, it is considered as income of the foreign company. But sometimes what they do is they convert this branch into subsidiary. They convert this branch into subsidiary. So they tear down the branch and make a new baby that's like a subsidiary, converting branch into subsidiary. So earlier, Citibank Singapore used to have a branch in Mumbai. Now they want a subsidiary in Mumbai. Now what will happen? Assets of branch would go to subsidiary. Liabilities of branch would go to subsidiary. And in return, this foreign company would get shares of the subsidiary. This is what there is too many transfers happening now. Lawmaker says that we will exempt this transfer provided you fulfill certain conditions. What are those conditions? First of all, this should be approved scheme from shareholders. This should be approved scheme from the shareholders, Indian subsidiary and sanctioned by RBI. This should be approved. All assets and liabilities are transferred to Indian subsidiaries. Perfect, sir. This branch would transfer all the assets to Indian subsidiaries. All the assets and liabilities are transferred at book value. Done, sir. Foreign company shall hold at least 51% till the next 5 years. What does it say? See, this branch transferred into subsidiary. So this foreign company, what it is getting? Foreign company is giving away all the assets of the branch and returning, getting shares of the foreign company, shares of the subsidiary. Lawmaker says that whatever the shares this foreign company has received now, at least it should hold 100% shares till year end, first year end. And lawmaker says that this 100% shares shall be held 100% up to first year end. Plus, they shall hold at least 51%, up to 5 years from date of the transfer. And at last, so no other consideration shall be given except the shares. That's fine. If all the conditions are fulfilled, then transfer shall become exempt. So certain pointers, depreciation will be allocated based on number of days. Losses will be allowed in remaining of 8 years. Whatever the losses of the branches were will be given to subsidiary, but only for remaining number of years. WDV of the asset, sir, whatever the asset WDV was of the branches, that will go to subsidiary. Cost of asset, same as it is. Period of holding, if since it is an exempt transfer to old owner plus new owner, we shall take the period of holding. MAT credit will be remaining of 8 years. VRS expenditure, if something is remained, we will be carrying forward. Provision for doubtful debt, as it is same, we have to carry forward. Gift provisions will not apply to foreign company, and at last, if company fails, violates any condition, then within 4 years of violation, AO can recompute the income. Fair enough. Last topic for the chapter, which is the, third class topic to be honest, but it has undergone some amendments. So you shall just listen to it. Okay, don't need to learn anything, just listen to it. Within 5 minutes, we will be done with the chapter. Done and dusted with the chapter. Now, last topic, what this topic says. See, we have understood business connection. Okay, if there is an agent in India, then agent shall constitute business connection. For example, there is a fund called BlackRock. There is a fund called BlackRock. It is in USA. Now, fund BlackRock is looking at some investors. Okay, fund BlackRock is looking for some fund managers. Okay, fund managers across the world, they are looking. Now we have with us Gayatri. Gayatri. Gayatri is very nice at finance, and she applied for this BlackRock, and she became the fund manager. Wow! She became the fund manager. Okay, in India. She said, "Sir, I want to stay in India. I want to work from India. I want to work from India." Now just look at this transaction. Nemotai, having her beautiful eyes, looked at this transaction. What she said, you know what? She said, "This is the Kanun of the country." Not this is not just say she said one more thing. She said, since Gayatri is a Indian person, can we call she is an agent? Because for BlackRock, Gayatri is maintaining stock. She is concluding contract. She is making decision making. She is taking decisions as well. So can't we say that she has business? This BlackRock has business connection in India. There is an agent in India which works exclusively for this non-resident. Can we call it? Can we call business connection? Can we call this agent constituting business connection in India? Any decision that Gayatri would take and whatever profits this BlackRock earn, this would be taxed in India. Can government say? Right answer is government said this thing. Government said this thing. But this is a blunder now. BlackRock would never employ, therefore, Gayatri. BlackRock would never employ Gayatri. Therefore, lawmakers clearly stated that if there is eligible fund and there is eligible fund manager, fund is also eligible and fund manager is also eligible, then even if fund manager is located in India, this shall not constitute business connection. If there is eligible fund and there is eligible fund manager, this shall not constitute business connection. What is an eligible fund? That is, we have a 17 conditions. And who is an eligible fund manager? 5 conditions. We have to check. One by one, we are going through. You don't need to learn that. You just need to listen and ignore. See, this fund should be outside India. Fair enough. Fund should collect money from the members for investment purpose. Fair enough. Fund should not be resident of India. Fair enough. Fund should be located in the country where India has DTAA. That means India. It should not be from North Korea and all. That's enough. See, fund shall not have Indian participants more than 5%. This is an important condition. This eligible fund shall not have more than 5% of Indian participants. Otherwise, it would be Indian fund only now. Only 5% has to be Indian. And there is a catch. The fund manager Gayatri can invest 100 crore rupees, and for first 3 years now, this 100 crore will not be counted in 5% limit. Important thing here, sir. If a resident hold more than 5%, Indian resident hold more than 5%, then this has to be evaluated on every 1st April and 1st October of the previous year. If Indian holds more than 5%, now their securities have to be sold within 4 months. Within 4 months, they have to be sold. If they are not sold, then fund shall become resident of India. Whatever the fund is there now, such fund shall follow the investors' protection rules of that country. Fund shall have at least a 25 unconnected members. So unconnected members means me and my wife are connected person. So me and my wife is one person. Likewise, we have 25 unconnected person. Fund shall not, any member shall not hold more than 10% in the fund. See, me and my wife should not hold more than 10%. whatever the fund, I mean, whatever the members are there in the fund now, any 10 members collectively shall not hold more than 10 or 50%. Any 10 members shall not hold more than 50%. That means there should be no power concentration. Fund should not invest 20% or more in any of the fund, in any of the securities. Fund shall not invest in any associate. Associate means funds managers, any other fund or any other relative company of the directors manager. So it should not invest in that. Fund shall have corpus of 100 crore rupees from the 12 months from the end of the month of incorporation. Fund shall not have any business connection in India. Fund shall not do business in India. Fund's remuneration fees has to be prescribed. Fund manager shall not be connected person. Fund manager shall be registered person. Fund manager shall be working in ordinary course of business, and fund manager shall not get more than 10% of the profits as remuneration. That's it. Done with the chapter. And our taxation we are done with. Come on to question answers. Question answers are easy peasy in this question answers. Entire question answer marathon has been uploaded. I want you all to practice this one question, and this will help you in understanding how beautifully the questions are being asked in exam. One question we'll practice and we'll be done with the chapter. Mr. Manoj is a 47-year-old born in India, left for employment in United States. Oh my God, such a bad life. Since 2010, he has been staying in United States, and since then he has been staying, and his wife has been staying in Delhi. So sad life. Person staying in USA and wife is staying in Delhi for 15 years, 16 years. This much of separation. I painful separation. After 2010-11, Manoj never stayed for more than 30 days in India in any financial year. He remitted 40,000 rupees in joint bank account maintained with his wife at Punjab National Bank, Delhi on 10th April 2011. So 2011, he remitted money. His wife invested in the name of the Manoj. So wife invested money in the name of the Manoj. 13 lakh rupees in listed shares of domestic company. Consideration for the purchase of the sale was paid in USD. And value of these shares in the and were translated into INR. Okay. On 2nd March 2026, these shares were sold for 15 lakh rupees. So sale value is 15 lakh. Cost of acquisition is 13 lakh. Sir, you have told, sir, you have, we know that you have told that any non-resident investing in shares now, transaction would be done in dollar. I mean, it will be converted into foreign currency. But I have also told you that this is only applicable for unlisted shares. These are listed securities invested in the listed shares of domestic companies. So 2 lakh would be the capital gain. 112A. This is the amount of capital gain. Remember, these are not listed securities. This is an area of mistake. On 10th March 2026, Manoj acquired a vacant land from Tulsi Foundation at 30 lakh rupees, whereas guideline value, stamp duty value is 40 lakh rupees. Remember, property's value is 40 lakh, but we acquired at 30 lakh rupees. 10 lakh is the gift provision. But we know under IFOS that gift provisions are not applicable when it is received from trust. Gift provisions are not applicable. Not applicable, Anna, not applicable. Then dividend of 55,000 received from Indian companies. Sir, dividend received by Indian company is always taxable for non-resident, and we know that tax rate is applicable 20%. We know right now we studied now that tax rate applicable is 20%. Yes, sir. Interest at 20,000 rupees credited to NRE account. Any interest on NRE account is exempt. It is exempt, sir, perfect exempt. Royalty of 2 lakh rupees from literature and books. Royalty is taxed 2 lakh rupees. Sir, are we going to get 80 QQB? Oh dear, are we going to get 80 QQB? Sir, we are not going to get QQB because QQB is only available to residents. During financial year, he paid premium of 2 lakh rupees for policy in India. Sir, whether non-resident get 80C? Yes, non-resident get 80C. I will tell this in deductions chapter, what deductions resident get and what deductions non-resident get. I will tell you tomorrow. Tomorrow is our marathon for small topics. Okay, you shall cover that as well. That will, I mean, cover your small topics holistically. 1 lakh, 1.5 lakh. Okay. Compute the total income tax liability, assuming he opted out of default tax regime. Whatever given is extra unnecessary. Your total income is 2 lakh 55, 2 lakh. That means 4 lakh 55,000 is the total income. On this 1.5 lakh deduction, that means 3.05 lakh is the income. On this, we have to calculate taxes. So 2 lakh was the long-term capital gain. 112A. So minus 75,000 into 12.5%. On 55,000 of dividend, it is taxed at 20%. And other 2 lakh, whatever the other 2 lakh was, it was royalty. On this 1.5 lakh, deduction was allowed, so 50,000 would be taxed at slab. Sir, can I say this non-resident has some basic exemption limit unused? Can I say this non-resident has some unutilized basic exemption limit? Right answer is yes, but that is not relevant because non-resident basic exemption limit cannot be set off. This cannot be set off against regular income. Therefore, we just have to multiply 55% into 20%, that is 11,000. It would turn out to be maybe. And here, 75,000 into 12.5%, 9375. So 9375 plus 11,000, tax rate is 20,375 plus we will add how much? 4% education says 21190. This is the amount of tax. Wow! Amazing! 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 Done with the NR taxation. Sir, now we want some break. Now we want some break. Acha chalo. Let me give a spoiler alert before break. Then you can go for break. Did you enjoy NR taxation? Just mention this point in the comment box. Did you enjoy? Sir, we enjoyed. So we will start transfer pricing after break. It is 11:50. You can take break till 12:15. We have to sit very long. We have been studying for 2.5 hours. Let's take 25 minutes break and then we will study transfer pricing. And you will love transfer pricing. You will love transfer pricing. 25 minutes break I am giving so that I can also rejuvenate myself. You can also rejuvenate yourself. After break, we will start transfer pricing. And the way you loved NR taxation, you are going to love transfer pricing more than that. I can assure that. See you guys after the break. Love you all. And if you liked it, do ask your friends to come as well. We can start freshly from NR taxation. Sorry, we can start freshly from transfer pricing. Perfect, sir. Welcome back from break. Are you all back from break? Are you guys back from break? Yes, sir, we are back from break. We are back from break. Wow. So, guys, come on to very next chapter, which is not transfer pricing, but this is model tax conventions. Sir, this is cheating. This is cheating, cheating, cheating. Why not transfer pricing? Why model tax conventions? Are Baba, see, it is always a wise strategy to segregate the theory chapters and chip it in some practical chapters. Too much of practical would bore away your mind. Too much of theory would again force you not to study. So it is always advisable one practical, one theory, one practical, one theory, one practical, and one theory. And believe me, you will understand model tax conventions the way you have never understood. I mean, for the first time, you will understand it. Okay? Overview of model tax conventions. First of all, if there is double taxation avoidance agreement between the two countries, we'll be very fast, we'll be very quick. Hi, sir. Hi, Nikhil. How are you? See, first of all, whenever two countries make double taxation avoidance agreement, there has to be a standard format as to how they should make the DAA. For example, India makes DAA with France, India makes DAA with Germany, India makes DAA with any other country now. So format can vary now. Format can vary. Which article talks about interest, which article talks about royalty. So there has to be a format. Likewise, we have letter as well. Whenever you write a letter, do you remember in your childhood you were asked that you have to write a letter to your mother telling you are facing difficulty in hostel? You used to write the letters now. So there was a fixed letter. There was a fixed format to the letter. For formal letter it was different. For informal letter it was different. Similarly, while DTAA is being formed, now there is a fixed format, and that format is nothing but model. Model for tax convention. Tax convention is nothing but double taxation avoidance agreement. We are studying model for tax convention, that is format for DTAA. Basically, all across the world, three models are being followed. First of all is US model, which is not considered by world. It is just that when we enter transaction with United States, we enter with US model. Otherwise, US model is not followed. So we don't have to study this. There are two models followed across the world. First is OECD model and second is UN model. OECD model Organization for Economic Cooperation and Development. निखिल says, सर आपने दो मैराथन के लिए रिस्पेक्ट है सर, हमसे ज्यादा मेहनत आप कर रहे हैं. थैंक यू सो मच निखिल, इट मीन्स अ लॉट टू मी, इट रियली मीन्स अ लॉट टू मी. नाउ there are two models going on. Okay, there are two models going on across the world. If two developed countries make DTAA, then they follow OECD model, Organization for Economic Cooperation and Development. This is OECD. Big rich countries are the part of this group. India is also a part of this OECD group. Now, if two developed countries like France, Germany, France, Japan make DTAA, they shall follow OECD model. Whereas if one of them is developing or both of them are developing, then in that case they shall follow UN model. Simple point. Sir, UN model followed by developing countries or one of them is developing. In that case, UN model is followed. What is the difference between the two? See, difference between the two is who charges the taxes. See, worldwide now, there is a thumb rule that a resident person charges taxes. Resident person has the right to charge taxes. Okay? Resident person has right to charge taxes. But UN model says that some taxes shall be charged at source state as well. What do I say? See, if there is the agreement between France and India, France, there is French company. So taxation rights will be mostly with French company only. But if it is UN model, now then Indian can have also some rights to tax, or I should say majority taxing rights India can also have. So UN model will say more of source based taxation, whereas this OECD will say more of resident based taxation. So source is more given preference. In OECD model, residence is given more preference. Now, under UN model, we have 31 articles, and under OECD model, we have 32 articles. Always understand India, France, DTAA. This will help you to understand everything. Now, India will follow, mostly India will follow UN model only. India is not developed country yet, so India will not follow OECD model. India will follow UN model only. What is the title? See, every double taxation avoidance agreement will have a common title as to this DTAA is between the two countries for elimination of double taxation and prevention of tax evasion. This is a common article everybody will have. No need to learn that. Preamble, like we have preamble for India, which says that India is a secular country, democratic country. India is sovereign country. We have these provisions. Likewise, every preamble of the TCAA will have that this is a convention between two countries for elimination of double taxation and treaty shopping. Sir, Article 1 of every DTAA will say the same thing. To whom this article is, to whom this DTAA is applicable. Remember, if there is DTAA between India and France, it will apply to resident of India and it will apply to resident of France. That's it. Okay. This will apply to these two people. So this TTAA shall apply to either of the resident of the both the contracting states. Okay. There is a concept of fiscally transparent entity. I don't know when it can be asked, but when it is asked, you will be doubtful. So let us understand what is fiscally transparent entity. Just understand. Do not read it at all. Do not learn it at all. Just understand. In India, partnership firm and partners are two different people. Partnership firm is separate. Partnership partners are different. Okay. But in foreign countries, there is possibility that partnership firm and partners are not different. If you transact with a firm, you transact with partners individually. It is possible that they are considered as partner, they are considered as individuals only. There is no such partnership firm concept in other countries. It is possible. Many countries follow this rule. They do not consider partnership firm as a firm. They consider as partners doing something together. Income would be taxed in the hands of the partner. Losses would be allowed to partners. This is concept applicable in many countries. In this concept, what happens now? To be very precise, for example, there is France. There are two partners. One of the partner is French and the other partner is German. It is possible now. Partnership is German, France-based partnership, but one of them is French, the other one is German. Lawmaker says if partnership firm is a fiscally transparent entity, that means partnership and partners are not separate. They are not separate. They are equal only. So DTAA will only apply to those partners who are resident of France. That means if in that country there is no concept of partnership and partner, there is no concept, everything is same. In that case, DTAA will only apply to those partners who are resident of France. That's it. Okay, only of the resident of the France it shall apply. Article 1. Article 2 talks about which taxes to be covered. See, article in DTAA will always cover three types of taxes: income taxes, capital appreciation like wealth taxes. This is going to cover. Or in future, for example, income taxes being changed, and India comes up with a new tax called money tax. It is as good as income tax only, but money tax. So in that case, any law that would come which would substitute income tax, that will be also covered under this DTAA. Article number 3 actually talks about the definitions. We don't have to cover. We have to come to article number 4, that is residence. Important. Article number 4, residence. What does that mean? Very carefully understand, very carefully. Sir, India and France, DTAA is there. If Rahul is there, how can you call he is a resident of India, or how can you call the residents of France? You have to check the local tax laws. A assessee is resident of a country if he is resident as per the local tax laws. Assessee can be resident of India if he fulfills the conditions prescribed under local tax laws. He is a resident of France if he fulfills the local tax laws of France. That's fine. That's simple. But sir, what if he fulfills condition in both the countries? It is possible, no? He fulfills conditions in both the countries. In that case, what you have to do, you have to follow tiebreaker rule. What is tiebreaker rule? Lawmakers are clear. If you become resident of both the countries, now you have to check the first thing, that is permanent home. Where is my permanent home? If it is in India, then take for India. If it is in France, take France. What if, sir, I have permanent home in both the countries? Then you have to check the personal and economic relationship where they are close. For example, I have very personal economic relation in India, so Indian, I will become resident of India. If I have personal economic relation in France, then I will become resident of France. But if I have both, if I have personal economic relationship close in both the countries, then I have to go to third step. That is, where do I habitually abode? Where do I habitually stay? If I stay in India, Indian resident. If I stay in France, French resident. But if I stay in both the countries, in that case, I will be called for fourth step, that is nationality. Which country do I have the citizenship of? If I have citizenship of India, then India. If I have citizenship of France, then France. Legally, India stops at step number 4 because India doesn't allow dual citizenship. As soon as you become a citizen of the other country, you become non-citizen of India. You have to leave citizenship. This is not applicable, but in some cases, in some countries where there is dual citizenship allowed, in that case, if you become citizen of both the countries, then both the countries will sit together and decide your residential status via mutual agreement procedure. So 5 steps to be followed. First of all is permanent home. Second thing, personal economic relationship, then habitual abode, then nationality, and then MAV. Always understand the sequence is always same. Sequence shall remain same. Article number 4. Article number 5, very, very, very important. If business income is to be taxed in the source state, then there has to be a permanent establishment. That's it. It is very important that, for example, there is a French company and this is India. If French company does business in India, this business income can be only taxed in India if this French company has permanent establishment in India. Then only it can be taxed, otherwise it cannot be taxed. Now, what is permanent establishment? Remember, a fixed place of business through which business is being done. So a French company has office in India, branch in India, factory in India, workshop, outlet in India, oil mine, gas quarry in India, then only this French company will be taxed in India. Basic it is. Basic it is. Permanent establishment also include building site construction and installation project. Seems fair. See, if this French company does the construction work, this construction site shall become also permanent establishment. But important catch here is, you need to understand important catch. If this French company has permanent establishment in India now, has construction site in India, it will become permanent establishment only if as per UN model this site is for more than 6 months. This site has been abundance for 6 months or more. But sir, if this French company has a construction site, for example, with Germany, where OECD model is followed, in that case, in 12 months, this construction site would become permanent establishment. So construction site is also PE. Construction site can also be called PE, but if UN model followed, then 6 months old construction site will become PE. If more than 12 months in OECD model, then only it would become PE. Now, UN model now is what should I say, hungry for taxes. UN model is very hungry for taxes. Now, what happens in UN model? Listen, UN model gives benefit to source state. These poor states gets more charges, more say in taxes. In UN model, now there is a concept of service fee. Service fee. What does that mean? See, for example, there is a French company. French company has professionals doing the work. Professionals do not have any permanent establishment in India, but lawmaker says that if professionals come to India for more than 183 days, that means more than half a number of days, in that case, now any services via these professionals as well shall constitute the permanent establishment, and this shall be taxed in India. Income of this PE shall also be taxed in India. Important, na? Very important. And this service fee is only in UN model, not in OECD model. Sir, another difference. Sir, if there is an enterprise, for example, there is a South African company which collects insurance money from India. If anybody collects insurance premium for India, it is always PE. Irrespective of their status, it is always PE. Okay, this is normal. These are the PE definitions, extra PE definitions, sales, outlet, factory, workshop. These are PE always. But apart from that, the construction side is also PE. Service PE under UN model, along with that, insurance collection enterprise is also PE. Apart from that, sir, for example, if a foreign company or a non-resident has an agent in India, this agent shall also constitute PE. Under UN model as well, under OECD model as well, under both the models, this agent shall also constitute permanent establishment. Very simple it is. Some things are not called permanent establishment. For example, if a non-resident or foreign company has a place through which just information collection take place, call center and all this information collection take place, then it is not PE. If, for example, non-resident has an advertising owner and advertising board hoarding, these are not considered as PE. For example, if non-resident has a website in India, website does not amount to PE, but yes, if website server is in India, then it shall constitute PE. Sir, independent agent, for example, non-resident is not having the dependent agent, he is having an independent agent who works for many people, then this shall not constitute PE. If non-resident has subsidiary does not constitute PE, subsidiary is different entity altogether. Business profit, same thing that I have discussed. If non-resident has to pay taxes on business income now, then taxes will only be levied if non-resident has permanent establishment in India. If non-resident has permanent establishment in India, then only this non-resident can be charged to taxes in business income on business income in India. Perfect, sir. There is a concept of force of attraction rule, very not technical but very logically made. Listen up. Force of attraction rule. For example, there is USA and USA has Tesla. In India, there is showroom of Tesla showroom. For example, Nikhil, there is person called Nikhil. He went to buy Tesla to the showroom. Instead of showroom selling the Tesla, USA itself sold Tesla from the head office. It was not sale. It was not sales made through the. It was not sales made to the showroom, but rather direct sales was made. Lawmaker says that if you have showroom in that country, you have PE in that country, and you are directly selling from head office just to reduce the income of the PE, to reduce the taxes in that country, we will not allow that. Whatever sales directly you do now, that shall become sales of this PE only. Whatever direct sales that you do now, that shall become sales of PE only. Always understand. If you sell anything now, it shall become income of PE only. Wow. Wow. Amazing, sir. Amazing. Very nice. So if there is direct sales, it is called PE only. PE sales only. This is only applicable force of attraction rule. This is applicable in UN model only. Not in OECD model, only in UN model. See, UN model is hungry for taxes. Always, if for a head office has a branch in India and sales have directly been made from head office, not from branch, so we shall assume that sales of branch only. This is force of attraction rule, article number 7. Interest income. Sir, what is interest income? At CA final level, is it important? Yes, that is important. If I give you money or if I give you debt, income on debt claims of every kind is interest. Whatever extra money that I receive on the debt given to you, it is interest. If I give you 10 lakh rupees in return, I get 11 lakh rupees. 1 lakh rupees is the interest. Simple thing it is. Sir, it may be secured debt or it may be unsecured debt. It may be mortgage or it may not be mortgage. It may be profit participating or not for profit participating. Anything is okay. But sir, remember, income from debt claim of every kind is interest. Now, who is going to tax this interest? Remember, see, this French company gave loan to Indian company. And this French company gave loan to German company as well. Lawmaker says if there is UN model, then whatever the tax rate India can charge now is the specified percentage. Whatever you agree, India and France people agree now, at that percentage tax can be charged. But if it is OECD model now, right to charge taxes is only to is to source rule only up to 10%. Only 10% source can charge taxes. Source has only right to charge only 10%, but under OECD model, sorry, under UN model, whatever agreement we might agree at somewhere we might agree 5%, somewhere we might agree 50%, whatever we might agree, that's up to us. Article number 12 and 12A, royalty and FTs. Technical yet important yet beautiful. For example, if France provides technical services to India and provides technical services to Germany, in India it follows UN model. In this model, it is said that some percentage can be taxed by India, otherwise it would be taxed by France. But under Germany now, under OECD model, it is clearly said that tax will be only charged by the resident only. So under OECD model, right to taxes with the resident only, but under UN model, now some percentage can be taxed by source as well. Sir, what is meant by royalty and FTS? Listen very carefully. FTS is same as we have studied in section 9, but as it is managerial technical consultancy services, MTS, MTC. What is royalty? Listen, here royalty definition is different. Okay? For example, if I have any intangible asset, if I give that intangible asset to you, earn anything in return, no, that is royalty. Under OECD model as well, under UN model as well, whatever we give to the, whatever we give to somebody as intangible asset, and whatever money we receive, now that is royalty only. But under UN model, now, something extra has been said. UN model specifically says rental of film tapes is also royalty. For example, French company gave me film tapes to show French movies in India. In that case, whatever payment we make now for rental of film tapes, that is also royalty. Plus, if for example, a French company gave us some industrial, commercial, and scientific equipment now, then rental on industrial, commercial, scientific equipment shall also be considered as royalty. So OECD model says only right to use intangible asset is nothing but royalty, but UN model says something beyond. That thing is royalty as well. But apart from that, na rental of film tapes and equipment rentals shall also become royalty. Article 12b, what it says, see, it is as per UN model, automated digital services. There are some services called automated digital services. What are those? For example, online teaching is automated. Online gaming, cloud computing, social media, digital content creation, search engine. These are automated digital services which involve least human interaction and work more on internet. See, these are automated digital services. Capital gain. See, right to tax capital gain is with resident only. But some portion can be taxed in source state depending upon the type of asset. Some portion can be taxed in source. Otherwise, right is with the resident only. Independent personnel. We have already studied this point. See, if there is a non-resident company, non-resident foreign company who has employees, okay, these employees provide services to Indian by visiting India and they stay for 183 days, more than 183 days. Lawmaker says that if any non-resident visits India for more than 183 days, in that case, now that employee shall constitute PE. Employee shall constitute permanent establishment, and whatever income they earn, now that shall be taxed in India. That's it. Whatever income they earn, that shall be taxed in India. Perfect, sir. Perfect, perfect, perfect. Simple thing. Other income, for example, any other income like rental income. See, OECD model says that resident can only tax. UN model says resident plus source may also tax some portion of it. Now, article number 23. Very important. For example, this is Indian person. He earns in France as well and he earns in India as well. In that case, now, whatever taxes that have been paid in France, India has to give either relief or either has to exempt that. Because double taxation avoidance agreement is existence because we want to avoid double taxation. This person has paid taxes in France. Now, this person has paid taxes in France. In that case, what would happen? Lawmakers clearly say that either you have to exempt such income as per exemption method, or either you have to give credit of such income. You have to take that income into your account, add that income, calculate taxes, and give a rebate. Whatever rebate you give, rebate under 90 is given in India. So you have to give a rebate. So whatever income that has been taxed in the other country, now you have to consider that either exempt that or either add it to your income and give the credit accordingly. This is Article 23. Article 24, non-discrimination. There should be no discrimination between resident and non-resident. Wow, we never follow that. Okay. Article number 25. Yes, but we give the benefit to non-resident as well. Mutual agreement procedure. See, for example, India and France, two countries. Rahul earns both the places. Now there is a doubt as to who is going to tax it. There is a doubt as to who is going to tax it, India or France. So to clear the doubt now, both the countries' government officials can sit together and do a mutual agreement procedure and decide as to who is going to tax. This is mutual agreement procedure. Government officials of both the countries sit together and decide who is going to tax. In this entire process, whatever the outcome is there now, it may be accepted by both the countries, it may not be accepted by both the countries. But there is always an arbitration clause. What is an arbitration clause? See, if you both are not satisfied with the judgment of each other, because, for example, Indian people think that French are more dominant, so we might not win against them. We might ask third party, for example, we might ask Germany to become an arbitrator and help us deciding who is correct. Under UN model, both the parties can go to arbitration, but under OECD model, only aggrieved party will go to arbitration. Again, whatever the arbitration comes out now, either parties may accept that or may not accept that. It's up to them. This is nothing but mutual agreement procedure. At last, we have some exchange of information clause. What this exchange of information clause is? Very simple point it is. See, for example, this is India and France. Now, some people from India left India to France for earning something. Some people leave India. It has happened. It happens a lot. Now, India wants information of their properties in France. Can we get that? Right answer is yes. It is only available because of this article number 26, exchange of information. Just because of this article, now we have information about the people in France. Otherwise, we won't have information. Okay. This article facilitates the exchange of information. Why there is exchange of information required? So that there is prevention of tax evasion, avoidance of tax, better tax administration and compliance improvement. These are the purpose of exchange of information. Like London as well, like people from India, Vijay Mallya have fled to London. We get information because of this clause only. We get to know about the properties of Vijay Mallya because of this clause only. Now remember, whenever we ask any information from the contracting state, now for example France, for example London, lawmakers clearly say that they are not going to supply information which is not obtainable. For example, Vijay Mallya dug up a well of 20 30 meters and hid his gold coins in that well in London. Okay. Now, London government is not able to value that, not able to find out that. So anything that is not obtainable, government is not going to provide. If you ask any information which reveals their trade secret, they are not going to share. And at last, any information which is against public policy, they are not going to share. Also, there is always a clause of non-disclosure to third parties. That means if India and France share any information, now there has to be a clause that it should not be shared with third parties. It is logical enough now. By how third party should know, why third party should be allowed to know. Therefore, there is non-disclosure of third party agree. There is now non-disclosure of third party clause. In always every table it is there. So these are the 26 articles. What to learn in this entire process? Difference between OECD model and UN model important. Tiebreaker rule important. Permanent establishment very important. What is the difference between permanent establishment in UN model and OECD model? Force of attraction rule important. Interest definition is important. Royalty FTS definition is important. And at last, exchange of information is important. These are the important ones. Let's do one question answers. Let's one do once to the question answers. See, what is the difference between UN model and OECD model? See, difference between UN model and OECD model. See, UN model is between developing countries. OECD model is between developed countries. One of them is developing, they shall follow UN model. How many articles? 32 articles in OECD, 31 in UN model. And UN model only focuses on source-based taxation. Here, OECD model focuses on resident-based taxation. How do we apply tiebreaker rules, sir? We have 5 steps. We shall find out the permanent home, then personal economic relationship, then we shall follow habitual abode, then we have nationality, and then at last we have mutual agreement procedure. Interest and fees for technical services. How do we determine that? So interest and technical services. Interest is income of debt claim on every kind. It may be secured, unsecured, mortgage, not mortgage, participating in profit or not. Technical services are nothing but managerial technical consulting services. What are automated digital services? Services which require least human involvement. Standardized online teaching method, cloud computing, online gaming, content creation, social media platform. These are the same things. What is meant by royalty is the right to use any intangible asset. In both the models, it is called royalty. But UN model states 2 things extra, that is rental of film tapes and rental of commercial, industrial, and scientific equipments. So, what is the difference between the UN model, OECD model with respect to permanent establishment? See, permanent establishment, of course, if there is a factory outlet, workplace, factory, office, go down, these are permanent establishments. But if a foreign company, if non-resident, has a service fee, then UN model also considers as permanent establishment. That means if employees come to India for more than 93 days, then they are called P. Apart from that, sir, if insurance collecting enterprise is there, then too it is also P. And at last, sir, if work construction, so construction site is there for more than 6 months, UN model consider P. OECD model consider only if it is for more than 12 months. This is force of attraction rule, as we have already discussed. This is globe rules. We have to hold it for some time. Then with mutual agreement, so then with actually the model tax conventions. Wow, sir. Slowly, steadily, politely, lovingly. We completed this chapter as well. Wow. Just give me a second. I'll be back in a minute. We'll start with transfer pricing. Just give me a minute. Now, come on to transfer pricing. Very, very important chapter from examination point of view. First of all, let us understand an example. This will help us in understanding transfer pricing well. For example, there is a person called Rahul and there is a person called Rachel. Rahul sold goods to Rachel. Sales value is 100 crore and market value of this product is 130 crore. Tax rate in USA is 10% and tax rate in India is 30%. Now, what has been the impact of this transaction? Rahul sold goods for 100 crore instead of 130. So Rahul's P&L sales would be 100 instead of 130. So sales would reduce by 30 crore, profit would reduce by 30 crore. Since profit reduced by 30 crore, tax would reduce by 30%, that is tax is reduced by 9%. Tax is reduced by 9, so the tax is reduced by 9 crore. This is the first implication. Whereas in USA, if you check now, expenses instead of 130 crore, we just took 100 crore. That means expenses have been less. Therefore, profit is being more here. Profit of 30 crore more. And 10% taxes in USA. That means 3 crore taxes extra paid in USA. In India, we are reducing our tax by 9 crore. Whereas in USA, we are just paying taxes extra, that is 3 crore. In short, we have a benefit of 6 crore rupees. 6 crore rupees is the benefit between the two parties. Okay. Now, this 6 crore benefit is nothing just because of transfer pricing, and therefore transfer pricing is very much relevant. Very, very, very much relevant. How transfer pricing is determined, let us understand very carefully. Lawmaker says if there are two associated enterprises who does the international transaction, then it should be done at arm's length price. If any two associate enterprises do international transaction, it should be done at arm's length price. Two associated enterprise does international transaction, it should be done at arm's length price. Seems fair? Sir, seems fair. What are two associate enterprise? There are 11 conditions as to how do we determine what is an associate. 11 conditions. And 11 out of them now, 6 are very good, 5 are more good. What are those? First of all, sir, if one enterprise holds at least a 26% of the voting power in the other enterprise. For example, A Limited holds 33% in B Limited, it is associate. B Limited holds 90% in C, that is also associate. A indirectly holds 26% or more in C, that means they are associates. Okay? So if one holds 26% or more in the other, then they are associate. Second, one person or entity holds at least 26% in two entities. Wow. One person holds at least 26% or more in two entities. For example, there is a person called Uday Kotak who holds 30% Kotak Mahindra Bank and he holds 40% Kotak Securities. So these two entities would be associated. Third thing, one of the entity is controlled by individual and the other entity is controlled by the relatives of the individual. For example, Mukesh Ambani controls Reliance Industries. That means 26% or more is being held by Reliance Industries. Similarly, Anil Ambani, Anil Ambani holds 60% in Reliance Power, and the both of them are brothers. So one is held by, one is owned by, one is controlled by one entity, and the others have been controlled by their relatives. Relatives are mother, father, brothers, sister, LALD. These are relatives, spouse as well. If relatives hold 26% in the other entity, then these two shall be associates. Fourth, very important. No? If HUF controls one of the entity and HUF's member 1, member 2 cumulatively or individually controls entity, then these two shall become associated. Fifth condition, sir, if any person or entity has power to appoint more than half of the board of director or greater than or equal to one executive director, then this person and entity shall become associate. Person and entity shall become associate. Seems fair. 11th condition is also relevant. If any person has 10% or more profit sharing ratio in a firm, then this person and firm are associates. 6 conditions, I said 6 conditions. What are those 6 conditions? First of all, I holding 26% or more in the other enterprise, associate. I hold 26% or more in two enterprise, they shall become associate. Then I hold 26% in one and my relative hold 26% in other, then they are relative, then they are associates. If HUF holds 26% in one and HUF's members hold 26% or more in the other, then these are relatives. Then, sir, if one person has ability to appoint more than half of the board of directors or one or more executive director, then these are relatives, associates. At last, so I said if anybody has more than 10% profit sharing ratio of the other entity, then these are also associates. Perfect, sir. These are six relations based on the shareholding and powers. There are 5 shareholdings which are dependent upon transactions. What are these 5 shareholdings? Listen. Loan given. Person 1 gives loan to entity 1. Entity 1's total assets are 100 crore and loan given is more than 51%. That means 60 crore loan given, for example. Out of the total assets, whatever total assets are, more than 51% of the loan has been given by only one enterprise. That means your business is heavily dependent upon that person. Out of your total assets, more than 51% of the loan has been given by the other person. Out of the total assets, if your book value of the total assets are there, whatever your book value of total assets are there, more than 51% of that loan has been given by somebody, then this person is your associate. Fair, 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 fair. If person 1 has given the guarantee out of, for example, our loan is 10 crore rupees and somebody has given guarantee of more than 10% now, then that person shall become associate enterprise. This shall become associate enterprise. Other than that, loan given, guarantee. Our business is dependent wholly or mainly on the copyright provided by the other person, then we are associate. Whatever raw material requirements are there, out of that 90% of the raw material has been provided by somebody else, then we can call it we are associates. At last, at the time of sale, if anybody has the power to determine price and other influence the other conditions, in that case we are called associates. So there are 11 conditions. At last, 12 is there, any mutual condition as may be prescribed by CBDT later on. Now, in this entire process, what are 11 associates? I'm writing down, you just focus. These 11 conditions are very important. Okay? In every question you will be asked this thing. Person 1 holding 26% or more in enterprise 1. Person 1 holding enterprise 1, enterprise 2. 26%, 26%. Then these are associates. Then third one we have person 1 holding enterprise 1. Relative holding 26% in enterprise 2. These are associates. Fourth, person 1 is HUF. HUF 1 holding 26% or more in one enterprise. Member holding 26% or more in enterprise 2. These are associates. 6. Person 1, enterprise 1, who has having ability to appoint majority of the board of director or one or more executive director. This was fifth. And sixth one was person 1 has profit sharing ratio of greater than 10%, equal to 10% in firm. These are 6 condition based on percentages. Then loan given by person 1 represents more than 51% of book value of total assets. 7th. In whatever our total borrowing is there, more than 10% has been guaranteed by somebody, so they shall become associate. 9. Our business is wholly dependent upon their copyright. 10th. Our raw material requirements 90% have been fulfilled by somebody else, and whenever we sell to somebody, price and other conditions are determined by us. In that case, we shall become associate. So there are 11 conditions. You can become associate based on multiple simultaneous conditions as well. That is how you become associate enterprise. Two enterprise would become associate based on the following conditions. Now, in this entire process of making two enterprises associate, in this entire process of making them associates, what is the area that has to be looked upon? What is the area that has to be looked upon is associated enterprise having any international transaction or specified domestic transaction. We shall focus on international transaction. The international transaction is by default transaction between associate enterprise. Any international transaction, whenever you see now, by default definition is international transaction is transaction between two associates. It is not just a transaction where one of the parties outside. No, it is not international transaction. Between two associate enterprise, if transaction is happening and at least one of them is non-resident. Two enterprises start doing transaction and at least one of them is non-resident. At least one of them is non-resident. Then in that case, it is international transaction. Between two, one of them is non-resident. Sir, what type of transaction they can do? Expenditure, allocation of cost, interest, purchase, sale, lease, provision of services, lending, borrowing, any transaction they can do. Okay, sir. What did I say? Transaction between two associates and at least one of them is non-resident. Seems fair. There is a concept of deemed international transactions. And what is the deemed international transaction? Let me tell you. For example, this is Rahul and this is Rachel. We both are associates. Okay. So I preferred not to transact with Rachel. I transacted with somebody called Chandler. But sir, in fact, what happened? You know what? There was prior agreement between Rachel and Chandler. Plus terms were determined by the Rachel. So ultimately, even if I am transacting with the unrelated party, sir, every term has been dictated by my associate only. So this shall also become my associate party and this shall be deemed international transaction. Deemed international transaction means it will be called my associate only. It will be called my associate only and it will be considered as transaction with associate only. Once we find out there is associate enterprise, once we find out that it is an international transaction, and then any transaction shall be done at arm's length price only. Any transaction shall be done at arm's length price only. Now, what is arm's length price? We need to determine. Arm's length price is nothing but correct market price, and it is calculated based on the 5 methods. We have 5 methods for arm's length prices. Out of these 5 methods, ideally, in one case, now there are chances that more than one methods are applicable. You have to choose the most appropriate ones. If not, one method would be applicable and which one you have to identify and solve the question. One of the most gray areas of entire chapter where students find difficulty. We shall understand one by one. We shall understand when to apply which provision and how to apply which provision. I will be telling you. First of all is ALP shall be calculated with most appropriate method. First method, CUP method, comparable uncontrolled price method. In this case, you sell goods. You sell goods to your associates, you sell goods to your unrelated parties. Both the cases you are selling. But price charge from both of them are different. For example, let me take an example. We will do questions as well. For example, this is Rahul. You are selling to Rachel at a value, say 100 crore, and you are selling to Joey. Joey is your underrated party, and you are selling it at 130 crore rupees. Why you are selling to Joey at 130? Why? Because there are some benefits now. For example, to Rachel, when we are selling on maybe FOB basis. But here we are selling CIF basis. It is possible. What is this FOB? What is the CIFC? When goods are sold to Rachel now, freight is taken care of by us only. Sorry, freight is taken care of by Rachel. Insurance is taken care of by the Rachel. So we don't have to incur insurance expenditure. Therefore, we can charge Rachel less. But whereas when we are selling to Joey, we have to take the FO, we have to take the insurance as well. We have to take freight as well. Therefore, we have to charge Joey. So there is a reason for the difference. There is the reason for the difference. We have to find out the reason and we have to add or subtract and we have to find out the arm's length price. How do we find? Always follow these steps. Always take the price charged from uncontrolled transaction. Whatever the price you have charged from unrelated party, we shall take that. Price charged from unrelated party, we are always going to take that unrelated party. Always take that unrelated party. Always unrelated party. Seems fair? How much we have charged from Joey? 130. Is it comparable to Rachel? Right answer is no, because it is on CI basis. Insurance money is included in this. Take off this insurance, make it FOB, reduce whatever 10 crore insurance, whatever it is. After reducing also, 120 should have been charged to Rachel. Even if we sell to Joey on FOB basis, 120 should have been charged. Now 120 we would have charged from Joey, so 120 should have been charged to Rachel. Whatever the difference is, 20 crore, this will be nothing but primary adjustment. This will be added to your income. Basic fundamental is this. You have to find out the sales made to one person, sales made to other person. In that case, you have to compare them directly based on functional differences. That is how you calculate cup method. Let me help a question. Let me do this with a question so that you understand this concept better. Question number 124 of Super 150. Beautiful question. Or I should say beautiful concepts altogether. Surya Limited is an Indian company engaged in manufacturing activities by importing raw materials from Sun Inc. So Sun Inc. Is outside country. India is Surya. Here we have Sun Inc. Manufacturing activities by importing raw materials. It has Sun Inc. has total borrowing of 1 million. 1 million pound. Okay. Out of that, guarantee 20% has been given. Oh my god. So 20% has been guaranteed given by one person only. So these are associates. Yes. Surya and Sun are associates. Seems fair. During financial year 25-26, Surya imported goods of 60 crore rupees. That means Sun sold 60 crore rupees goods to Surya from Sun. Sun supplied similar raw materials at a markup price to others. Oh, achha. So cost, whatever the cost that has been with Sun plus 20% has been sold at 60. Cost plus 20% has been sold to has been sold at 160 crore. Whereas Surya provide the similar material to somebody. Oh. Ideally, when you sell to somebody, you charge cost plus 20%. But from Surya, you have charged cost plus 25%. Oh my God, sir. Why this difference? Why you are charging extra from your relatives? Why? The reason is Surya was allowed to use a brand name. Acha, you are charging extra because you are getting a brand name. Brand name is also given, and that is why they are charging extra from Indian entity. Annual cost of brand name. Annual cost of brand value is 100 lakh rupees. Acha, brand value is 100 crore rupees. Okay. Seems fair. 100 lakh actually. ठीक है. 100 lakh. Surya Limited is allowed trade period of 2 months, whereas unrelated allowed. Acha. Unrelated party are given just 1 month trade period, whereas Surya is given 2 month trade. So this is the basis of difference. We are charging 20% from others. We are giving him them 1 month credit. We are not allowing them brand value. Whereas when we are selling to associate, we are giving them 2 month credit. We are giving them brand name as well. So we are charging them more. Seems fair. Right answer is no, it's not fair. We have to calculate cup method. First thing that has to be done is price charged from unrelated party. Always find out price charged from unrelated party. How much price this should have been they would have charged from unrelated party. See, from associate we are charging 60 crore. 1.25, 1.25, if we divide we will get the cost, and 1.2, that means 20% we are charging, so we would have got the price 60 crore divided by 1.25 into 1.2. That means from unrelated party we are charging this. So the Sun is charging 57.6 crore rupees. This is what is being charged from the unrelated party, whereas from associate you are this party is charging more. Why there is a difference? So there is a difference because 1 month warranty has been given here, 2 month warranty is given. Sir, we shall add the warranty. 1 month warranty we shall add. What is the value of the warranty? 1 month credit period. The cost of interest may be taken as 12% per annum. So 12% of per annum we shall take into 12% divided by 1 by 12. That means we shall take 0.576%, 0.576 crore we shall add up. After charging 1 month extra warranty, this is the price to be charged. No, no, sir, but there is difference of brand name. Even after getting 2 month warranty, this associate is given brand value now. So we shall add a brand value here as well. We shall add a brand value here as well, or I should say 100 lakh. So now these are comparable. 2 month warranty, 2 month warranty. Brand name, brand name. But price charge here 60 crore. Here price charge, let's do the total. 59.176 crore charge. Oh my god. So from associate you are charging 60. From unrelated party you are charging 59. That means there is a difference. There is a difference. How much difference? 82 lakh 40,000. And this is nothing but primary adjustment. I hope you understood. You find out at what price you are charging from associate and what price you are charging from unrelated party. Find out the functional differences. It may be warranty, it may be anything, it may be warranty, anything. It can be anything. Just adjust for them and you will arrive at arm's length price. Very simple. Do this method. This is, I think, easier. Come on to next method, that is resale price method. Resale price method. Now, what does this resale price method say? Resale price method is very good. Here says, for example, this is Rahul. Here you are not selling to unrelated party, you are purchasing from unrelated party. From say from associate also you are purchasing, from unrelated party also you are purchasing. Okay. You are selling both the goods, but on one goods from associate you are getting less profit, but from unrelated party you are getting more profit. Why this is so? Why this is so? Because you have bought goods at a higher price from associates. What did I say? You are buying from related and you are buying from unrelated parties, but you are selling both of them goods to in the common market. From associates, whatever goods you are buying now, you are selling at a lesser margin. But from unrelated party, you are able to charge higher margin. Difference between the two is because of you have purchased goods at a higher price than higher price from associate. In this case, resale price method is applicable. How that is applicable? How do we solve? First of all, always charge the sales value minus the normal gross profit margin. And then we have to do the functional differences. Let us solve one question from this as well, and we will understand this concept. It is not difficult. Come on to question number 126. Come on to question number 126. You will understand question very nicely. Indiana Limited is an Indian company engaged in manufacturing and trading of electronic projectors. Oh wow. Indiana Limited is an Indian company. Indiana Limited has following stakes in the different foreign countries. Okay. Okay, okay, okay. So it holds 30% in Star GmbH. Oh, 30% in Star GmbH. That means, can I say that this Indiana and Star are associate enterprise? Yes, these are associates. Indiana and Star are associates. Seems fair. A German company, it appoints six directors. Out of six directors in a Moon American company, it has 15 directors. Acha. There is a company called Moon in which out of 15 directors, we can appoint six directors. So this is not associate. Star is associate. I am highlighting that in blue. Star is associate. Whereas Moon is not associate. I am highlighting it that in red. It has given guarantee for a loan amounting to 12 euros taken by the asteroid on the UK. The value of the total borrowing of the asteroid is 150. So there is a company called Asteroid where out of 150 borrowing, we have given guarantee of 12. Is it our associate? Right answer is no, sir. It is not our associate. If we would have given guarantee of 10% or more, then they would have become associate. In that case, it is not associate. So what shall we do? This asteroid is not associate. I'm highlighting that in red. So only star is associate, others are not associate. What is the treatment of this transaction? Let me tell you. Transaction with Star GmbH. Indiana bought 1,000 projectors, electronic projectors from Star GmbH at 15,000 rupees per unit for the purpose of resale in India. Indiana bought 1,000 projectors at rupees 15,000 each. This is not Indiana. This is Indiana. And there is a Star, which is an associate. You are buying goods from associate enterprise. Okay. It sold the projectors in India without doing any modification, and gross profit margin on the resale is 20% on sales, and after sales warranty is provided 1 year key. So whenever you are buying goods from Star, you are able to sell at 20% on sales. On sales, you are able to get 20%. On sales, you are able to get 20%. Seems fair. On sales, you are able to get 20%. But sir, when you buy from Star, now you get 1 year warranty. Okay. Transaction with Moon Inc. Indiana Limited has bought 1,000 similar projectors from Star, like as purchased from Star GmbH from Moon Inc. at rupees 14,000 per unit. So Moon also has supplied the projectors, which is not associate, by the way. 1,000 projectors at the rate of 14,000. For a minute, 14,000, ignore that. Now, if these projectors are sold without doing modification, 30% on sales you have earned. That means here you have earned 30% on sales. Oh my God. Oh my God. The cost of warranty, acha, say after sales warranty is 9 months. Here you are providing 9-month warranty. Understand the difference here. You are buying projector at 15,000 rupees and you are able to sell 20% on sales. Whereas you are buying projector from somebody else at 14,000 rupees or some other price, you are able to sell the same projector at 30% margin. Why there is difference? Because there is difference in purchase prices. Your resale price is telling that there is difference in purchase prices. Your resale price is telling that there is difference in purchase price. How do we determine? First of all, we have to calculate the sales value. Sales price. How much is the sales price, sir? 15,000 and 20% margin on sales. If there is 20% margin on sales, what will be the margin on cost? Minus 20, that means 25% on cost. 15,000, 15,000 plus 25% will give us margin. This will give us 18,750. This is the sales margin. This is the sales price that we are going to charge. This is the sales price that has been charged. See, you have earned 20%, but you should have earned 30% now. So reduce 30% from this. 18,750 minus 30%. That means 13,125. This is the should have been price. Should have been priced. Understand? Should have been priced. You bought for 15,000, but you should have bought for 13,125. You should have bought for 13,125. You bought for 15,000, but you should have bought for 13,125. This is what the question is trying to say. But sir, these are not comparable ones. Why? Because when you buy for 15,000 now, you get 1 year warranty. But when you buy from unrelated party, you get 9-month warranty. So there is a difference now. See, if we add 3-month warranty to this will become comparable. So we have to add 3-month warranty. What is the value of the warranty? Sir, value of the warranty is 3% of the sales price. So what is the sales price? 18,750 is the sales price into 3% for 3 months out of 12 months. 18,750 into 3% divided by 12 into 3. 140 to be added, 0.625. Once we add this now, 13,265.625 into 1000 projectors, 136 or 132,65625. This is the value that should have been paid to your associate as well. You are paying heavy goods, you are paying higher charges to associates. You are charging, you are paying higher charges to associate. This is absolutely unjustified, absolutely unjustified. That is why resale price method would be attracted here. That is how we calculate figure on resale price method. Cost plus method. Under cost plus method, what do we do? Sir, we manufacture goods. We manufacture goods and sell to different people. From associate, we might charge something. From unrelated party, we might charge something. Whatever margins that we are charging now, this is the tussle of margins. It is possible that from associate we are charging 20%, but from unrelated party we are charging 70% on cost. So this is a tussle of margins. This is the tussle of margins, and that is what we have to account for. Let me see, let me show you how actually things go. Let us also solve the question in this case as well. This will help you in understanding how to proceed. Are you understanding now with these concepts, with these question answers? Are you able to understand how to apply the method? With the question answers, are you able to process how to apply question, how to apply in questions? Are you able to understand now? Question number 113. ABC Canada holds 35% shares in LMN Limited India. ABC Canada holds 35% in LMN. Develop software for both on-site and off-site consultancy to customers. Okay, okay, fine. During the year, ABC Canada billed 120 man hours for 1800 man hours. Acha. So billing was done 120 man hours into 1800 rupees per man hour. How much billing was done? 120 into 1800, which is nothing but 2,16,000 is the billing done. Seems okay. 2,16,000 is the billing amount. Seems okay. The total direct cost for executing the work amounted to 225. Oh, so cost incurred is 225. Hey, I don't know. I don't understand much business. To be honest, I don't understand much business. One thing I understand is how is it possible? How is it even possible that you are incurring 225 and charging 216? How is it possible? LMN billed XYZ at a rate of 2,800 rupees, same level of manpower, 50% on cost. So from XYZ, you are charging 50% margin on cost. But from associate, you are selling at a loss. How come? From unrelated party, you are charging 50%, but from associate, you are selling at a loss. Bhaiya, why there is difference? Why there is difference, sir? Why there is difference? There are difference because transaction with LMN and ABC are comparable because of these differences. Listen, LMN derives technological support from ABC and there is no support from XYZ. Therefore, it may be taken as 50% of the gross profit margin. Understand? No? See, when we are selling to LMN, we are selling to XYZ now. We do not get any technological support. We do not get any technological support. That is why we are able to charge 50%. But sir, when we are selling to ABC now, we get tech support. We get tech support, therefore we cannot charge 50% from them. We have to charge lesser percentage. How much lesser? Sir, lawmaker says 18% of the 18% of GP. So charge lesser, 18% of 50%. That is reduce 9%. Charge 41%. If technological support is given, reduce technological support. If you get if you consider technological support, then to charge at least 41% now. If he's giving you tech support, you can charge 41% from him. No, no, sir. No, 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 no. See, ABC is a big customer. He provides he buys goods in the large volumes. Therefore, we have to offer him 10% discount. Sir, see, we are able to charge 50% from XYZ. We are able to charge 50% from XYZ, but sir, we cannot charge 50% from ABC. Why? Because he's buying in large volumes. So we have to give him 10% discount on GP. So whatever the GP is 50%, out of the 10% we shall take. So 5% we shall reduce. Okay, sir. ठीक है. In case of rendering services to ABC, if we are rendering services to ABC, element neither risk any marketing cost. On the other hand, where so goods are sold to XYZ, element has to assume all the risk and functions. Listen now. When element provides to XYZ, so there is the risk involved, there is marketing involved. But sir, to ABC, no risk, no reward. Therefore, we cannot charge him 50%. We have to charge him lesser. We cannot charge him 50% now because there is risk involved. I mean, there is no risk involved. There is no marketing cost incurred, so we cannot charge that much now. Therefore, we can reduce that. How much is the gross profit margin? 12%. 50% into 12%, 6. At last, LMN offers 1 month credit to ABC. It may be taken as 2% of GP, whereas no credit. Oh my God! Oh my God, sir, what it is? See, LMN, when you are selling to XYZ now, no credit is given. But to ABC associate, credit is given. See, you are charging 50% plus no credit. Here you are selling at a loss plus credit. Are Baba, give credit to him, charge extra margin. Charge extra margin. So add. How much to add? So 2% of GP, 50% into 2%. That is 1% we have to add. How much? 41 minus 11 plus 1, that is 31% on cost should be charged. 31% on cost should be charged. 2,25,000 plus 31%. 294,750. This is your arm's length price. You are transacting at 2,16,000 rupees. So difference will be 78,750 rupees. This is the adjustment. This is the adjustment. Important point here is the price we are charging from unrelated party. That is the same price we shall be charging from associate as well. Here in this case, we take the margins, how much cost plus margin we are charging from associate, whereas how much margin we could have charged from unrelated parties. That is the difference we take here. Now, in this entire process, we have a fourth method called profit split method. Now, what is this method all about? See, this method is different altogether. For example, 3 people come up and do a joint venture. For example, this is Rahul, Ross, Rachel, and Rahul. Ross, Rachel, and Rahul, 3 people have come together to do a joint venture. 5,000, 5 lakh, 6 lakh, 9 lakh, 5 lakh, 6 lakh, 9 lakh. This is the cost incurred by them. And output is 20 lakh rupees. Cost incurred is this much. Output is 20 lakh rupees. Okay. Sorry, total cost is 20 lakh rupees, but revenue incurred is 30 lakh rupees. So how much money would be given to each of the person? That is what profit split method talks about. Cost incurred by all of them is 5 lakh, 6 lakh, 9 lakh, and profit is 10 lakh rupees. In what ratio this profit is to be split up now? That is what is told by profit split method. A ratio can be multiple. For example, ratio can be, sir, manpower, it can be functions performed, it can be risk taken. Any ratio can work. There can be any ratio between the two. Would split out the profit. There can be any ratio. Okay. So in exam, you will not be worried. In exam, you will be given with the ratio. You don't have to worry about it at all. If nothing is mentioned, you can consider cost as well, cost incurred. Else, whatever is given, whatever ratio is given, you shall consider that. So in real life, it is difficult, but in exam questions, it is easy because it will be given to you. For example, capital employed ratio is 1:1:3. In that ratio, we are going to split. So 10 lakh profit divided by 3/5, that means 6 lakh will be added. So overall 15 lakh will be cost of this is the price paid to Rahul. This is amount that should be paid to Rahul. So profit split method will tell you the further details. Transactional net margin method. What is transaction net margin method? See, if you understand the three methods that we have discussed, four methods specifically, but three of them are more relevant. Cup method. When you sell to associate, when you sell to unrelated party, or when you purchase from associate, purchase from unrelated party, in that case, what happens now? Whatever the functional differences are there, we shall account for that and make it comparable, and then we shall find out the arm's length price. Perfect, sir. Resale price method, purchase from unrelated party, sale at a different margin. Cost plus method, selling to associate as well, selling to third person as well. In all the three methods, it is presumed that we are selling to associate, we are selling to unrelated party as well. We are selling to associate and we are selling to unrelated party. We are selling to both the people. That is what assumed. That is what it is assumed. Fair enough. It is assumed that we are selling to associate and we are selling to unrelated party as well. So what if we are just transacting with associate only, no unrelated party? No unrelated party transaction we are doing. We are just selling to associate only. No, from where we will compare? Cost plus method would fail. Cup method would fail. Resale price method would fail. How are we going to compare if we are not even transacting with unrelated party? It is possible many people don't even transact with unrelated party. What will happen in that case? Entire working would be done. Entire working would be done, and you have to find out the other players in the industry. For example, Google India services provide services to Google USA. You have to check how much money, how much profit the Facebook charges for the same services. How much Spotify charges for the same purpose, same services. How much Alibaba charges. So in the same industry, you have to charge. You have to find out the what other players are charging. Based on that, you will get the price. Let me take an example. Google India provides services to Google USA. Technical services charges to 1 lakh rupees. Operating cost is 70 lakh rupees. Seems fair. As of now, it seems fair. Whereas if we check the Facebook charges 60%. Facebook charges 60%. So we shall also charge 60%. We shall also charge 60%. So 70 lakh plus 60%. That means how much should have been charged? 1 lakh 12,000. 1 lakh 12,000 minus 1 crore rupees. That means 12 lakh is the arm's length price. So here we are comparing with the other players in the industry. That's it. This is transaction net margin method. Are we clear with the methods? Are we clear with the methods? Just mention this thing. Did you understand how five methods apply? Sir, we are clear with the methods. Coming on to next topic. See, transfer pricing is a very big topic, and to be very precise now, there are areas very unrelated, and anything missed out can come in exam and will hurt you a lot. If some new question, if some similar topic comes, it will hurt you a lot if you miss out anything. In transfer pricing, you should not even think of skipping out any topic. Okay. Coming on to more than one arm's length price. It is possible that you follow a same method and you get different arm's length prices. It is possible. Sir, how is it possible? For example, in India, okay, Google India is providing services to Google USA. Assume in Google India is providing services to Google USA. Assessing officer checked out Facebook India, how much margin it is charging. We can also check how much TCS is charging. We can check how much Wipro is charging. We can check how much HCL is charging. So we can find different players in the industry where we can compare our transaction price. We can compare multiple pairs. Sir, what if that? All the transaction price would be arm's length price now. So in that case, how do we arrive at the correct arm's length price when we have multiple arm's length price possible? What if we have multiple arm's length price possible? How will we arrive at the correct arm's length price? Lawmaker says if more than one arm's length price now via same method, you have to follow the two things. If you arrive at more than one arm's length price up to say five arm's length price, two, three, four, five arm's length price you arrive. Lawmaker says do the simple arithmetic mean of all the ALPs and whatever the average ALP you shall arrive now. You will have a 3% cushion. For example, average ALP turns out to rupees 1000. You will have a 3% cushion. That means 970 or 1030. If your transaction lies within this cushion, that means up more than 970, less than 9 or 10,030. If your transaction lies within this range now, then in that case, your transaction price shall become arm's length price. Transaction shall become arm's length price. But sir, if your transaction is very beyond, in that case, what will happen? This average shall become arm's length price. What did I say? If you arrive more than one but up to five, in that case, sir, you shall have to do the average out of it. What will happen to the average? In that average, you have to take 3% margin. If your transaction is within 3% margin limits now, then transaction will become arm's length price. But if transaction is beyond, in that case, what will happen? In that case, whatever the average is there, that shall become your arm's length price. Seems fair enough. Seems fair enough. Seems fair enough. If you are doing a wholesale business, then instead of 3%, we shall take 1% margin only. Cushion shall be given only for 1%, otherwise 1%, otherwise normally 3%, but for wholesale trading, 1%. What is wholesale trading? See, wholesale trading, that is not relevant. Where out of the total purchases in the P&L, total expenses in the P&L now, 80% are purchased on goods only. So that is wholesale. Plus, whatever sales you are doing now, less than 10% is held as average inventory of that month. So that is a wholesale business, not important. This is what you are going to do if you have more than one, but up to five arm's length price, 2, 3, 4, 5 arm's length price. If you have, this is what you are going to do. What if you arrive at say 6 arm's length prices, 7 arm's length prices, 8 arm's length prices, 9 arm's length prices, 100 arm's length prices? What if you arrive at that? In that case, what will happen? Sir, you have to follow the range concept, and range concept is important. Very technically understand. Very technically, very logically understand this concept. How range apply? Sir, for example, you arrived at 6 arm's length price, 7 arm's length price, 8 arm's length price, 9 arm's length price, any arm's length price. For example, you arrived at 12 arm's length prices. Always step one is to arrange the data. Arrange in ascending order or increasing length. You have to set them. Step number 2, you have to find 3 things. 35th percentile position value, 50th percentile position value, and 65th percentile position value. What does that mean? Out of the entire data set, now you have to find out which data set is in the 35th percentage position. That means out of 12 points, what is the 35th percentage position? 12 into 35%. 4.2. So do we have any 4.2 position? Right answer is no. We have next position, that is 5th. Take the data set from the 5th position. Take out the 65th percentile position, 60 or 12 into 65. 7.8. Do we have 7.8 position? Right answer is no. So we shall take the 8th position. Okay. Whatever the data is on the 8th position, we shall take that. Take 50th percentile. So 50th percentile out of 12 data sets into 50th percentile, 6th value. See, whenever your percentage value is absolute number, never take that position. Never take that position. You shall take that position plus next position divided by 2. That means 6.5th position you are going to take. That is how you are going to arrive at the exact value. That is how you are going to arrive 35th percentile value, 65th percentile value, and 50th percentile value. That is how you are going to arrive at. Let me take this an example. Okay. Let me take an example to illustrate what do I mean. We have data set 1020, 990, 1070, 1100, 1100, 1010, 1050, 1060, 1080, 1000. 1120. This is the 10 data sets, 10 values. First of all, you have to rearrange data in the ascending order. From in increasing order, you have to rearrange the data. In that, now you have to find out the 35th percentile value and 50th percentile value. 35th percentile value you have to find out, and 50th percentile value you have to find out. 35th percentile value and 50th percentile value. This is what you have to find out. In this data set of 10, what is the 35th percentage value? That is 3.5. 3.5 is not a position, so we shall take the fourth position. So 35th value is 1050. Find out 65th position value. Out of the 10 data set, 65th position, we don't have 65th position, so we shall take the 7th position, 1080. Then we have to calculate 50th percentage position. So 50th percentage position is nothing but fifth position. If any number turns out to be a absolute number, now we shall never take that. We shall take fifth position plus sixth position divided by 2. So fifth position plus sixth position divided by 2, that is 1065. This is 50th percentile. Now what is the significance of this 50, 65 and 35? Whatever your transaction price is, at whatever price you have done the transaction now, if that transaction price lies within the range of 35th and 65th position, if your transaction price lies within this range, then your transaction price is nothing but arm's length price. If your transaction price lies within this range, then transaction price is the arm's length price. But here is a catch. Here is a catch. If transaction price is beyond this limits now, then 50th percentile value shall become the arm's length price. Whatever the data is on the 50th percentile, that shall become your arm's length price. Important point, beautiful yet technical. You need to process this thing. You need to process this thing. What did I just say? 35th percentile, 65th percentile. This is the range. Your transaction should lie within this range. If it lies in this range now, whatever transaction price you are incurring, that is the average. That is the arm's length price. But sir, if your transaction is beyond this range now, then whatever the 50th percentile position is there, that shall be considered as arm's length price. Sir, whenever you apply range concept, there is no margin of 1 or 3%. Already we are giving you range, so no margin is given. Range concept is not applicable in case of profit split method. Because in profit split method, you can have multiple ways of splitting the profits. How many ways you want? 1, 2, 3, 4, 5. 5 are enough. So profit split method range is not allowed. Sometimes multiple year data is given to you, so you might have to do weighted average as well. Not simple average, but weighted average you have to do. In this weighted average, you have to consider three things. Resale price method, you have to take the sales price as weight, say sales quantum. Cost plus method, you shall take cost as average. TNMM, we have to take anything that is mentioned as the average. In cup method, we do not take weighted average, we take the simple average. Not relevant from solution point of view, but from MCQ point of view, it might be asked. Otherwise, range concept is this much only. Not anything extra is required from this concept. That completes your range concept as well. Oof. Important concept, really very important concept. Upcoming concept is important. So there are instances where whatever arm's length price you have declared now, AO is going to disregard that. What are the instances when AO is going to disregard our arm's length price? Lawmaker says if you have chosen wrong method of calculation. If you have chosen wrong method of calculation, AO is going to disregard your transaction price. Disregard, simply disregard your transaction price. Sir, if data chosen by us is not reliable, for example, so first of all, we selected a wrong method. We were supposed to choose cup method, but we choose cost plus method. AO is going to disregard and he will calculate ALP of his own. So then data is not reliable. For example, we Google India transacted with Google USA. We are comparing margins of Reliance India and Reliance USA. These are not comparable, wrong data collected. So books of accounts not maintained and books of accounts maintained but not got audited. That is why in four cases AO shall compute the arm's length price. And if AO computes the arm's length price, if AO computes the arm's length price, now then what is the implication? Sir, if AO computes the arm's length price, then there is a very high consequences. Very high consequences. What are those high consequences? Sir, first of all, whatever the increased portion of income is now, whatever the increased portion of income is on that increased portion, you are not going to get any deduction. Any chapter 6 deduction is not allowed on increased portion of income. Apart from that, if income of one enterprises is increased, the others remain unchanged. For example, Rahul increased, then income of Rachel would remain unchanged, because if my income is increased, so Rachel should get more deduction. Right answer is no, no deduction allowed. Wow, sir. See, always understand, assessing officer is just an IRS officer. Assessing officer is a normal IRS officer. He doesn't understand much accounts. He doesn't understand transfer pricing. So he has to refer the case to a special officer called a transfer pricing officer. Transfer pricing officers has a duty has to calculate the arm's length price. Arm's length price cannot be determined by AO. It is determined by the transfer pricing officer or TPO. If AO feels like he wants to refer the case, he can refer the case to TPO. TPO shall collect the data and calculate the arm's length price. Remember, during the course of the transaction, if TPO feels like, Acha, I want to cover this transaction as well. Acha, this domestic transaction is also subject to arm's length price. I want to calculate this as well. Acha, you have entered more transaction. I want to cover this as well. Acha, you have another one unit. I want to check that unit as well. TPO can increase the scope of its findings. TPO has the power to increase the scope of its findings. Based on that, TPO shall find out the order. Whatever the date is the assessment order, now at least 6 months, at least 60 days prior to that, TPO is going to give the order. KPO is going to give the order. See, whenever there is exchange of information happening, for example, government of India went to government of France to collect some information. There is exchange of information. In that exchange of information, it is possible that TPO's time is wasted. So lawmaker says whatever the time is wasted in exchange of information, or whatever the time is wasted on stay by court, in both the cases, that much extension shall be given. If after considering all the extension, TPO has less than 60 days, he shall get at least 60 days to pass the order. A joint commissioner, assistant commissioner, joint director, assistant director, a joint commissioner, assistant commissioner, deputy commissioner can only become TPO. ITO cannot become. Block assessment in transfer pricing. See, this is not technical as it looks. What it means, see, whenever TPO finds out any arm's length price for a specific year, you have an option to use that method for at least 2 upcoming consecutive years. See, what it says, if arm's length price is determined by the TPO for any previous years, you can use a similar transaction price for 2 consecutive upcoming years, provided that you have selected that method and it has been applied within time. TPO shall, within 1 month from the end of the month in which such option exercise, shall declare whether such option is valid or not. So we have to apply it to TPO and he shall declare within 1 month that whether we are applying correctly or not. In such case, we are not going to use that. If we use this block assessment, in that case, there is no reference to TPO to be done in future. That's it. Safe harbor rules. Oof. Let's do safe harbor rules and I'll give you a break. Let's do a deal. Let's do safe harbor rules and I'll give you a break. Let's do a deal. Okay. I'll give you a break. For sure, I'll give you a break. Once, let's do safe harbor rules. I know sometimes studying too much puts some pressure on your brain, but you have to study. Okay? You are very close to exam. In just 10 or 11 days, you have exam, so you cannot even distract at all. Okay? How is the Josh? I guess how is the Josh? Please let me know in the comment section. Okay? If you have not liked the video, subscribe to channel. Do subscribe to like the video. How is the Josh? Sir, superbly high, sir. Superbly high, sir. We have very high energy right now. Come on to safe harbor rules. Come on to safe harbor rules. What are the safe harbor rules? Understand. See, there are instances where if you declare certain percentage as your income now, or if you declare certain percentage as your arm's length price, department is not going to argue at all. Case will not be referred to a TPO. AO will not interfere in calculating arm's length price. Penalties would not be applicable if you opt for safe harbor rules. Yes, it is correct. You have to opt for safe harbor rules. Sir, are safe harbor rules notified for our attempt? Yes, they have been notified, and there are 9 safe harbor rules, out of which 8 are very easy. One of them is a bit technical. We will study one by one. First of all is, if any foreign company does diamond mining business, it sells raw diamonds in special notified zones, uncut, unpolished, unassorted diamonds in special notified zones. Then whatever the money received or receivable is, that company shall offer 4% as PGBP. 4% as PGBP is to be offered. Okay. This is PGBP. Tax rate is not 4%. Tax rate will be 35% only. What do I say? Foreign company under on special notified zone in display of uncut, unassorted diamond. This does not mean business connection. This is exempted from business connection. Whereas if it sells the uncut and unassorted diamond, now it is eligible for safe harbor rule. 4% is to be declared as PGBP. Basic fundamental. So government will not argue. No reference to TPO shall be made. Conditions is that whenever you opt for 4% rule, no deduction of any expenditure shall be allowed. WDV shall be reduced notionally. See, even if you don't get depreciation, your block shall continue to reduce. Whenever you declare 4%, no losses against this 4% shall be allowed. Maintain documents and report a furnish an ROI. At least 2 months prior to, at least before ROI, you shall furnish Form 3 CEFC so that valid safe harbor rule is allowed. If AO feels that you have submitted incorrect information, he might declare your safe harbor rules as invalid. Whenever you go for safe harbor rules, that MAP is not allowed. You cannot go to government and request MAP. Mutual agreement procedure is not allowed. This is first safe harbor rule. Moving further, subsequent safe harbor rules. First, or I should say, second safe harbor rule. If Indian company provides software development, not research and development, but software development to any non-resident foreign company, which is an associate enterprise. Non-resident foreign company, which is an associate enterprise. In that case, what happens? Sir, what is software development? Actually, it is application development, backend support, support for existing system, but do not include research and development. So if you are providing software development to your non-resident associate enterprise, lawmaker says if your transaction is up to 100 crore now, then 17% of the operating margin you shall offer. If transaction up to 300 crore, then 18% of the operating margin. If more than 300 crore, no safe harbor rules applicable. No safe harbor rules applicable. No safe harbor rules. Okay. So international transaction, very simple. Associate enterprise with associate enterprise, 100 crore, 17% of operating margin, up to 300 crore, 18%. More than that, no safe harbor available. Third business. What this third business talk about? So, if Indian company provides IT enabled services, what are IT enabled services? IT enabled services means back office operations, call centers, data processing, insurance processing, payroll, research and development, educational content creation. Acha, payroll, but do not include research and development. Research and development is not included. Educational content development, medical advice, or clinical trials, these are not the IT enabled services. Majority of the IT enabled services only. Okay? If non-resident Indian entity provides IT enabled services to associates. Then again, up to 17%, up to 100 crore, 17% to be offered as operating margin. 100 to 300 crore, then 18% as profit or as operating profit, and at last more than 300 crore, no safe harbor is allowed. We discussed the three businesses: foreign company to diamond business, software development, IT enabled services. Fourth business, very good, very important. Take a long breath. What this safe harbor talks about. Indian company provides knowledge process outsourcing services. What is process outsourcing services? It is nothing but HR services, engineering services, digital design, business analyst, financial analyst, market analyst. These are some MBA related services that you provide. But yes, do not research and development. Do not do research and development. Any type of services being provided now. Up to 300 crore, you can go for safe harbor. Beyond that, you cannot go for safe harbor. What is up to 300 crore we can go? Lawmaker says that if employee cost upon total operating expenses greater than 60, in that case, 24% of the transaction value has to be offered as arm's length price. If employee cost to operating expenses 40 to 60, then 21% of the transaction price. If employee cost upon operating expenses lesser than 40, then in that case, 18% of the transaction value is arm's length price. So more than 60, 24% you have to offer. 40 to 60, you have to offer 21%, and less than 40, you have to offer 18%. This is how much you have to offer. This is how much you have to offer. More than 60, employee cost upon operating expense, then 24% of the transaction value. 40 to 60, 21%, and less than 40, then you have to offer 18%. Fifth business. If Indian company provides corporate guarantee. Sir, what is this corporate guarantee? If the subsidiary is not able to pay, we will pay. This is corporate guarantee. Lawmaker says if Indian company provides corporate guarantee to subsidiary, it is not just to associate. Normally, all the transactions have been associate centric. This transaction is to subsidiary centric. If you provide corporate guarantee to subsidiary and corporate guarantees up to 100 crore rupees, then you have to charge 1% as the guarantee amount, 1% fees as the guarantee amount. At least 1% fees this Indian company should charge. But sir, what if transaction is more than 100 crore? Then ideally safe harbor is not allowed. But here is the catch. If you are providing guarantee to somebody, which is as per highest safety standard as per SEBI registered rating agencies, in that case, you can provide guarantee and charge 1% fees. What did I say? If guaranteed amount is 100 crore, then in that case 1% fees is to be charged. But sorry, if it is more than 100 crore, in that case ideally safe harbor is not given. But if the other party, if other subsidiary is highestly rated as per SEBI registered agency, in that case you can provide him guarantee and 1% fees can be charged. In this entire process now, we do not take the letter of comfort. We do not take implicit guarantee. We do not take performance guarantee. We shall only take the actual explicit guarantee. If Indian company provides contractual research and development for software development, or contractual research and development for generic pharmaceutical medicines, in that case, sir, you have to offer up to 300 crore, you have to offer 24%. And beyond that, there are no safe harbor rules available. If Indian company manufactures and exports core auto components, Manufactures and exports core auto components. Manufactures and exports core auto components. In that case, now 12% margin on international transaction value. Here you have to offer 8.5% margin on whatever the transaction value you have done. Core auto components 12%, non-core auto components 8.5%. Sir, what are core auto components? Sir, it implies engine parts, transmission, suspension parts, braking, steering, lithium ion batteries. These are the core auto components. At last, sir, if Indian company provides low value adding activities to non-resident associate enterprises, then up to 100 crore, then no transfer pricing rules shall apply. No transfer pricing rules shall apply. What are low value adding activities? Support a business that do not change that do not require unique tangible assets. So these are low value adding activities. Up to 10 crore, you can provide, no transfer pricing rule shall apply. I have told you 8 safe harbor rules by now. Can we recall? Can we recall 8 by now? I'm taking off my specs. I don't know. I cannot see the screen. I cannot see anything. I have closed my eyes. I'm just trying to recall of my own. Foreign company doing diamond business in India. Sale of raw diamonds, uncut, unassorted. So for 4% of PGP has to be offered. Second thing, Indian company providing software development up to 100 crore, 17% operating margin, up to 300 crore. In that case, 18% operating margin. This has to be offered. Okay. IT enabled services, Indian company providing to associates 17%, 18% on 100, 300 basis. Then KPO services up to 300 crore we are allowed if employee cost upon total cost is more than 60%. In that case, you have to offer 24%. 40 to 60%, you have to offer 21%. Less than 40%, you have to offer 18%. This was KPOs. Then we came on to guarantees. Ideally, guarantee fees is 1% if transaction is up to 100 crore. But if it is more than 100 crore, safe harbor not allowed. But if you are giving guarantee to your subsidiary, which is highest safety rated by registered SEBI agencies, in that case, 1% fees you can charge. This was sixth safe harbor. Then we have, if you are into contractual research and development for pharmaceutical medicines or for software development, in that case, up to 300 crore, you have to offer 24%. Beyond that, you cannot offer. After that, sir, it comes to, if you are into core auto components, then you have to offer 12%. Non-core auto components, you have to offer 8.5%. And if you provide low value adding activities up to 10 crore rupees, in that case, safe harbor rules are not given. So they is not in that case, no transfer pricing provision shall be applicable. See, I try to learn this way. I always try to learn things in this way so that I am able to recall things. I always do this way. I think you should also try this once. This will surely help. Now we have the biggest of all and the father of all safe harbor rules. Biggest of all, father of all safe harbor. What this safe harbor rule is all about. What this next safe harbor rule is all about. Just give me 5 minutes and you will understand this. And this just give me 5 minutes. You will understand and you will enjoy this as well. If any non-resident or associate enterprise, if any non-resident associate enterprise gives any loan to India, sorry, no. Ulta I said. If Indian company gives loan to non-resident associate enterprise, how much interest the Indian company should charge to be safe from department? How much interest this Indian company should charge to be safe from department? How much interest income should be charged? Interest income should be charged by Indian company to be safe from department. How much interest? Lawmaker says check out in what currency you have given the money. If you have given currency in the rupees, then you should charge SBI lending rate of the 1st April of the previous year plus something. If money has been given in foreign currency, then that currency's lending rate as on 30th September plus something. Simple. Simple. Very simple it is. If you have given loan to somebody, you have to charge interest. How much interest you shall be charging? There are two conditions in this case. First of all, whatever money you have given to that person, whatever money you have given to that person, no, you shall take two. If you have given money in rupees, then SBI lending rate on 1st April plus something, and whatever money you have received in whatever money you have received, in that case, what you are going to take, sorry, what if you have given money in, if you have given money in foreign currency, in that case, what will happen? That country's financing rate plus something you have to charge. Now, what is that something? That depends upon credit rating agencies. That is dependent upon credit rating agencies. Listen, how much interest will be charged? Listen, I'm just writing it down to show you as to how do we calculate. Loan given, if it is given in rupees or if it is given in dollar. Assume dollar. Okay, it can be any currency. Assume it is a dollar. Then dollar rate of 30th September plus something. How much is something? If loan given is up to 250 crore, more than 250 crore. If loan has been given more than 250 crore now, then dollar rate plus 1.5, dollar rate plus 3, dollar rate plus 4.5, and dollar rate plus 6. It seems like a poem. Dollar rate plus 1.5 and dollar rate plus 3, dollar rate plus 4.5 and dollar rate plus 6. Oh wow. 1.5 for triple A rated, double A rated, and single A rated. Dollar plus 3 for triple B. That's it. Dollar plus 4.5 for double B, single B, C, and D. My bad. Double B and single B, C and D plus no rated. This is what how much you are going to charge. Sir, what about this two if loan is up to 2 crore? Same thing would go. Dollar rate plus 1.5, dollar rate plus 3, dollar rate plus 4.5 plus dollar rate and plus 6. 1.5 for triple A, double A, triple B. But this 4.5% and 6% is not applicable. Simply 4.25% we are going to add dollar rate. And for this will be double B, single B, C, and D, and no rating. So this 4.25 is the maximum rate. 4.25 or 4.25, yes. No, not 4.25, but just 4%. Just 4% you have to charge. That's it. That is how much you have to charge. Again, I'm repeating, focus here, focus. If transaction is more than 200 crore now, if loan given is more than 200 crore, then dollar rate plus 1.5 and dollar rate plus 3, dollar rate plus 4.5 and dollar rate for 6. How much? Triple A, double A, single A, then triple B, then we have to take double B and single B, then you have to take CD and no rating. But if transaction is up to 400 crore, maximum interest that will be charged is 4%. Remember, maximum interest that will be charged is dollar rate plus 4%, maximum. Simple, sir. Whatever transaction, if this transaction has been into rupees, then what to do? Then SBI rate we shall take on 1st April plus something. What is that something? Dollar rate plus 1.5 and dollar rate plus 3, dollar rate plus 4.5 and dollar rate and 6. This is what you have to go into charge. In addition to that, 0.25% Fokat ka you have to add. Free of cost, 0.25% you have to add. That means 1.75 you have to add here in dollar rate. Here 3.25% you have to add. 4.75 you have to add, and here you have to add 6.25%. This is how much you have to add on dollar rate. Once you add this much now, once you add this much, this is what you have to charge in rupees. And in rupees also, if loan advance is up to 100 crore, then maximum interest you are going to charge is 4.25%. But that's it. Dollar rate plus, sorry, dollar rate nahi here, SBI rate, huh? SBI rate. SBI rate plus 4.25%. Oof, 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 oof. Now, Again repeating, if loan has been given to somebody in foreign currency, if loan has been given to somebody in foreign currency, in that case, dollar rate plus 1.5 and dollar rate plus 3, dollar rate and 4.5 and dollar rate plus 6. If loan amount is more than 250 crore. But if loan amount is less than 250 crore, then what do we do? Maximum interest that will be charges 4%. That's it. If amount has been transacted in rupees, then SBI rate we shall take. We shall take up the SBI rate. SBI rate plus 1.75, SBI rate plus 3.25, SBI rate plus 4.75, SBI rate plus 6.25. Whatever the dollar rate was for, then a plus 0.25 extra you have to charge. And here maximum rate, if loan given is maximum 100 crore now, then in that case maximum rate that will be charged is 4.25%. That is maximum in India it will be charged. So it is simple. These are the all safe harbor rules available to you. All safe harbor rules available to you. Now remember, whenever you opt for safe harbor rules now, you have to file form 3 CIFA. 3 CIFA, that means 3 CEFA. You have to file up to the date of ROI in which you have to exercise this safe harbor. Whenever you opt for safe harbor, you have an option. You have an option to opt for safe harbor for individual or for continuously 3 years. Individually you can opt for safe harbor, plus continuously for 3 years as well you can opt for safe harbor. See, whenever you opt for safe harbor, na AO will check whether these are valid safe harbor or not. AO will check this, otherwise AO will not give. AO will check this. Okay? If AO thinks that it is an eligible transaction, he will give, but if he thinks it is not eligible, he will refer the case to transfer pricing officer. Within 2 months, whatever AO wants to do, he shall do. Within 2 months, not more than that. 2 months from the end of the month, he has to do anything. Either accept, reject, refer the case to TPO within 2 months. As soon as case was referred to T3 CIFA, sorry, as soon as case was referred to TPO, in that case, TPO shall check the transaction. If he thinks that the assessee is ineligible or transaction is ineligible or assessee furnished the false documents, in that case, TPO shall declare the safe harbor as invalid. It will declare invalid. Whatever TPO wants to pass, he shall also pass within 2 months from the end of the month in which a request was made. If assessee has been declared that it is invalid safe harbor rules, in that case what would happen? So in that case, a reasonable opportunity of being heard would be given to assessee, and even though assessee is not satisfied now with the order of TPO, he can refer the case to CIT, and CIT within 15 days he can refer the case to CIT, and CIT will check out whether the TPO was correct or not. CIT will be given again 2 months. Everybody is given 2 months. AO is given 2 months. TPO is given 2 months. CIT is also given 2 months. They have to pass order, whether confirming, rejecting, invalidating the order of the TPO. Whatever TPO has done, they have to process the CIT. CIT has to process. If all of them or either of them are not able to pass the order within the time, within 2 months' time, sir, safe harbor rule shall become valid. No questions attached, safe harbor shall become valid. If safe harbor rule is applied now, no 1%, 3% margin is given. You have to get yourself books of accounts audited under 92E, plus documentations to be furnished. Sir, whenever you opt for safe harbor rule, mutual agreement procedure is not given to you. That means you cannot sit with government to decide. The government of India cannot sit with government of other country to decide what the transaction price would be. And at last, sir, for example, if you transact with somebody who lives in notified jurisdictional area, if somebody is located in NJA, in that case, safe harbor rules are not applicable. Always understand, safe harbor are not applicable if somebody is located in NJA. Along with that, if somebody is located in tax haven, then to safe harbor rules are not applicable. So this is all about safe harbor rules. I guess that is sufficient. Now we can have a break. After break, we shall continue with advanced ruling, and after advanced ruling, we shall complete the entire transfer pricing. Then we shall do DTAA as well. We shall do other topics as well. Okay. Keep yourself energized. Keep yourself strong because we have to travel very long. Wow, 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 wow. Keep yourself energized, keep yourself strong because we have to travel very long. Ah, ah, ah. Go to break and we shall see you after the break. How much break you are given with. Abhi it is 2:10 it is. You are given break up to 2:30 plus minus 2 minutes. Okay. Lunch break. Take 2:35. Okay. Take proper break. I will remove the break portion. आफ्टर ब्रेक वी शैल कंटिन्यू, ठीक है। So, guys, welcome back from break. Mm, mm, Can you all hear me? Can you all see me? Can you all even hear me? Okay, perfect, perfect. So, guys, welcome back from break. Welcome back from break. So, repeat block assessment once. I will repeat that after some time. Okay? Let's not break the streak. Advanced pricing agreement. I will repeat that. Advanced pricing agreement. See, every year I enter transaction with Rachel. Every year I enter with transaction with same transaction I enter with Rachel. And this poor transfer pricing officer, poor assessing officer always intervenes, always comes between me and Rachel. Always. What do? I have an option. I can go to CBDT. I can request to CBDT that, hey CBDT, oh pyara pyara CBDT, oh lovely lovely CBDT, I want to enter a transaction with you. I can do an agreement with CBDT as to how much transaction price would I and Rachel would have. And once I do an agreement with CBDT, this assessing officer will have no say in that, because if I do agreement with your father or your mother, you will have to accept it now. Same way, I am entering into agreement with CBDT so that there is no say AO, there is no say of AO left. No say of AO left. Wow. So agreement with CBDT, done, sir. Whenever we enter advanced pricing agreement, reference to TPO is not made, calculation of arm's length price is not done. Perfect, sir. Whenever we want an APA, sir, we will get APA for 5 years. For 5 consecutive years, we can get the APA for 5 upcoming years. Sir, whenever we enter any agreement, any person entering into that agreement will be binding. IT authority shall also be binding, even up to PCCIT will be binding on that APA. Along with that, that transaction will be binding on that transaction. APA shall always apply. If assessee has taken advanced pricing agreement by giving fraud details, fraud data, in that case, na government or CBDT may declare such advanced pricing agreement as void ab initio. What will happen if it is declared void ab initio? See, all the provisions of Income Tax Act will apply as if there has been no APA given. Whatever the time that has been wasted from giving the APA till the time of declaration it as void ab initio, that time would be given extra for completing the other assessment proceedings. After excluding all the proceedings, if less than 60 days left, then 60 days will be given to APA. 60 days will be given. Now, important point here. Listen very carefully. Listen. A very beautiful point I am going to say. Very beautiful point. Sir, is it possible that I am entering into agreement for future transaction? Is it possible kya ki I have already incurred some past transactions? I might have entered some transactions in past as well now. If I am entering into some future transactions, I might have entered some similar transactions in past as well. Like I will be transacting with future. I am transacting with Rachel in future. I might have already transacted with Rachel in past. It is possible. So I can get a rollback for that. I can get a rollback for that, and that rollback will be applicable for 4 years. For 4 years, I can get a rollback. And how will I get the rollback? There is condition. See, for future agreement, whenever you do now, there are very less conditions because it's easy to give an agreement for future. But if they are giving you a rollback for last 4 years, so they have to undergo many changes now. It is possible that you have already filed return of last year's. It is possible that assessment is completed. It is possible that you filed return of income late. It is possible that assessment have been done in some or the other manner. So there are many possibilities in the past year returns now. So whenever they are giving you rollback, they will give you too many conditions. What conditions they might put up? Understand, first of all, return of income for the relevant rollback year has been furnished by the applicant before due date. What does that mean? Whenever rollback is given to you, remember, for all the 4 years that have passed, you must have filed return under 139(1). Under 139(1), you must have filed the return. That's it. Under 139(1), you must have filed the return. Second thing, for all the years now for which you want rollback, in that case now you must have got yourself audited under 92E. You must have got yourself audited. So rollback shall be applicable for all the 4 years. All the last 4 years you shall get rollback, not less than that, not more than that. Remember, whatever the transaction, enough yakin, enough. Correct, correct. You, whatever you are planning is correct. Fine, it's fine. Now, what provision says, if you are wanting rollback now, whatever the transactions that you have done in the past now, same transaction should be done in future. That means if you are taking APA for some transaction now, rollback should also be for similar transaction. It should not be like we want rollback for different transaction and APA for different transaction. Transaction should be similar. And at last, whenever you are going for rollback, you shall apply for rollback in form 3 CDA. 3 CDA form you have to apply by paying 5 lakh of fees. So return for all years have to be furnished on time, audit report to be furnished. In addition to that, sir, for 4 years you will require the past 4 years shall have similar transactions as well, and 3 CDA fees is to be filed. Now there are two cases where rollback would not be given to you. There are two areas, there are two situations where rollback would not be given to you. Very important it is. Believe me, it is very, very important. Why it is important, understand. So first of all, I transacted with Rachel. Rahul transacted with Rachel. Yakin says, thank you, sir. Love you so much. Your words give me hope in exam. I would clear. I will surely message. Thank you. Love you too, Yakin. This is Rahul transacting with Rachel. All the very best, huh? Rahul transacting with Rachel. Sales value 100 crore, market value 150 crore, 130 crore. Case went to AO. AO said 130 crore final. Case went to CIT appeals. CIT appeals also said 130 crore. Case went to ITAT. ITAT saw this transaction and he said, "Chi athu." I mean, what ITAT is saying? "Chi athu." 130 crore final, final. Not even a rupee less. Not even a rupee less. ITAT rejected my application. ITAT can do two things. ITAT can reject my application for 130 crore. This is first thing ITAT does. Lawmaker says if ITAT has disposed of your application before signing up of rollback, in that case, you will not be given rollback. The method, the manner of computation I had requested ITAT, ITAT has rejected that. Then CBDT will never give rollback in that sense. If I have prescribed a manner which was rejected by ITAT, and again I want to claim rollback for via that method only, now CBDT will not give rollback. Where determination of arm's length price is subject matter of appeal, and before ITAT, and ITAT has disposed of such application before signing off the agreement. ITAT has disposed of my application. In that case, rollback for that year will not be given. But sir, there are cases where it is mentioned that ITAT has not disposed of. ITAT has not disposed of. ITAT has just referred the case to AO for fresh assessment. ITAT has referred the case to AO for fresh assessment. ITAT has referred the case to AO for fresh assessment. If ITAT has referred the case to AO for fresh assessment, ITAT has set aside the order of the AO and referred to AO for fresh assessment. It simply means that rollback will be given to you. Fair enough. Second instance where rollback will not be given to you is where rollback results in reduction of filed income, declared income. For example, I filed my ROI with 1,000 crore. Assessment was done, and there was 500 crore addition, and my total assessed income was 1,500 crore. Sorry. Now I want a rollback. Okay. Now I want a rollback. I went to CBDT. Based on the conditions that we have agreed now, rollback would decrease my income. How much income it would decrease? Instead of this 500 addition, my addition would be just 300 crore rupees. My additions would be just 300 crore with rollback. It is benefit to me. Can I get rollback? Right answer is yes, I will get rollback. But sir, if my additions will go negative, for example, my filed income is now 900, then rollback will not be given to me. If my declared income is being reduced because of rollback, now I will not get rollback. If my assessed income is reduced, I will get the rollback. Now, what is the impact of APA and rollback? Listen, very carefully listen. Very carefully listen. Impact of APA and rollback. See, since you have already filed return for 4 years, now what will happen? If ROI has already filed, if ROI has already filed now, then you have to file a modified return. You have to file modified return. What is modified return? Sir, we have to modify a return based on rollback, and you will have to file modified return within 3 months from end of month of rollback. If not filed, file as per APA, file as per rollback. What about assessment? See, if assessment is completed for any of the last 4 years, if assessment has been completed, then what to do? Sir, AO will pass a fresh order within 1 month. Within 1 year from end of financial year of modified return. As soon as assessee filed the modified return, AO will process this modified return within end of the financial year, 12 months. AO will process the modified order. If assessment is not completed, in that case, AO will get fresh 12 months. AO will get fresh 12 months to do the completion of the assessment. So this is what are the benefits of APA. If return is filed, modified within 3 months from the end of the month of the rollback. If not filed, file as per rollback. If assessment has been done, 12 months extra. Not done, or if not done, then 12 months extra. Assessment done. So within 1 year, add 12 months, AO will get fresh time to pass the modified order. Wow, sir. Wow. Some clarifications regarding rollback. See, if you want now, you have to get for 4 years only. Not more than that, not less than that. You will get rollback only if you have filed return well on time. For all the 4 years now, you have filed return under 139(1). If you have delayed return in any of the year, for that respective year, you will not get rollback. Third thing, if your declared income is reduced, rollback will not be given. But if your assessed income is reduced, you will get a rollback. Next thing, APA for future can be entered without rollback. What does that mean? See, if I want APA for future, then I can get rollback extra. But I cannot simply go and request for rollback without applying for future. I cannot request for rollback. It's as good as if you went to buy vegetables. So you get free of cost coriander now. Sometimes you get free of cost coriander. Doesn't mean you can just get free of cost corianders. If you buy vegetables, then only coriander is free. You cannot simply go and ask just give me free coriander because you normally give. So give that to me. You are not allowed. Okay. It is very simple. Free coriander is only given when you buy vegetables. So it's like when you go for APA, then only rollback will be given. If you don't go for APA, rollback will not be given. You cannot simply ask for rollback. Sir, for example, if there is X company which has APA and it merges with Y, it becomes Z. Sir, no APA will be given. APA will not be allowed. If X has APA, it merges with Y and becomes XY. Sir, again, no APA will be given. If X is a company having APA, merges with Y and becomes Y, again, no APA will be given. If X is a company having APA, merges with Y, becomes X, in that case, APA will be given only to the transaction that correspond to X only. Wow. Compliance procedures of APA. Now, what is the compliance requirement? See, whenever you want APA, na, it's not like you just go and tick on portal and you will get. No. You have to go to DGIT of international taxation for pre-consultation. He will determine whether you are going to get APA or not. Now, whenever you want APA, you have to apply APA well on time. And what is the due date? 1st April of the previous year. Prior to that, you have to apply. Understand now? For example, for previous year 25-26, you want to apply. So you have to apply before 1st April 2025. Before that, you have to apply. If application date has been mentioned in the question, now it is absolutely clear. You will get the answer. But sometimes question does not mentions the application date. Whenever you apply APA now, sir, it is later on entered. It is later on signed. You applied on 1st Feb. APS was entered in September. APA was entered in October. APA was signed in November. It is mentioned. Applied on Feb, entered in later on. Sometimes the lawmakers, examiners, what they do now, they don't give the application date. They just give this date that APA was entered on 15th May, 15th June. They just give the entry date. So, sir, when do we assume when APA was entered, when APA was applied? How do we assume that? Sir, we assume it that previous year only. If date of application is not mentioned in the question, now always assume that date APA was entered well on time. It was entered before due date, only assume that. That means if entry date is given 15 June, assume that application was done before 1st April. If signing date is given 15 September, that means application was done well on time. Unless application date is given late, you are not going to assume application was delayed. Application was well on time. That is what you have to assume. Sir, what is the fees required to go for rollback and APA? See, whenever international transaction is up to 100 crore, you have to file the fees of 10 lakh rupees. If international transaction 100 to 200 crore, then in that case 15 lakh, and more than 200 crore, then 20 lakh fees. Apart from that, 3 CEDA 5 lakh fees extra for rollback purposes. So 10 lakh, 50 lakh, 20 lakh plus 5 lakh rupees for rollback. Whenever you apply for APA now, you get APA. During this process, for example, if you don't want APA, okay, you want to withdraw the application, they will not return your fees. I mean, how miser they are. They will not return your fees. They will take away your fees. Whenever you will enter APA now, you have to mention 4 basic things. First of all, international transactions. What all international transactions you are going to cover? What is the method of transfer pricing? Cost plus method, resale price method. What method you are going to follow? What are the critical assumption? For example, you are choosing cost plus method. So why this 25%? Why this 30%? Why you have to tell the critical assumptions? At last, rollback provision. Rollback provision simply mean whether you have whether you are opting for rollback or not. That is to be clearly mentioned. Every year, whenever you have entered into APA, you have to submit a compliance report. Till when you have to submit the compliance report, lawmaker says within 30 days from the due date of ROI. That means up to 30th December you have to submit, or 90 days from entering APA, whichever is later. That means 30th December only. So compliance audit is to be done as soon as compliance report is submitting within 6 months from the end of the month of compliance report. TPO will do the compliance audit. That's it. This is all about advanced pricing agreement. All about advanced pricing agreement. All about advanced pricing agreement. Secondary adjustment. Secondary adjustments. Secondary adjustments. Secondary adjustments. Very humbly, politely, secondary adjustments. What is a secondary adjustment? Understand the basics. Understand, it's easy. It's not difficult at all. First of all, whenever you transact with associate and you do not do transaction at arm's length price, you are giving benefit to associate. You are reducing taxes in India. Basic fundamental. Whatever the benefit that you are giving to associate, now it is nothing but primary adjustment. Whatever benefit you are giving to associate, it is primary adjustment. Second provision, what lawmaker says now. Second provision. So if you are giving benefit to associate, you should get that money as well. For example, if I do sales of 100 crore rupees, market value is 130. So I have transferred 30, I have given benefit of 30 crore rupees. So Rachel should give me 30 crore rupees. Whatever benefit I have given to Rachel, she should return this benefit to me. She should return this benefit to me. If she does not return this benefit to me, if she does not return this benefit to me, this will be loan given to the other person. And whatever loan given to other person is now, we have to charge interest on that. We have to charge interest on that. And very importantly, how much interest, for what period interest, and how can we save the interest? That is the only question of the topic. What did I say? Listen. What did I say? What did I say? Sir, if I transacted with associate enterprise, given some benefit to it. So that benefit is primary adjustment added to our income. But sir, whatever benefit that we have given to associate, na, it is nothing but a loan given to other person, and we have to offer interest on that loan. How much interest we have to charge, sir? We have to charge interest based on three ways. We have to understand three things: how much interest to charge, for which period interest to be charged, and how can we save that interest. Three things we have to understand. First of all, when there will be a secondary adjustment, sir, lawmaker says that wherever there is a primary adjustment, there will be secondary adjustment. Wherever there is primary adjustment, there will be secondary adjustment. Wherever there is primary adjustment, there will be a secondary adjustment. Perfect, sir. Wherever there are primary adjustments, there will be secondary adjustments. Perfect. When primary adjustment take place, it can take place suo moto. It can be because of appeal order. It can be because of AP. It can be because of safe harbor. It can be because of DTAA. Anything can happen. Five reasons can be primary adjustment. Based on this, you have to do secondary adjustment. Now listen. Whenever primary adjustment take place because of suo moto, I myself increased my income in ROI. I myself declared that I have given benefit to Rachel. I myself. First of all, why will I do that? That's not known. But just out of my inner sense said that you just have to report this. So I declared my income in ROI. I showed this benefit given to Rachel in my ROI. Lawmaker says as soon as you did the primary adjustment now from in the ROI, from the due date of ROI, within 90 days you shall get the money back to India. Within 90 days, you have to get this money repatriated back to India. If you do not get it from the very next day of the ROI, from the very next day of the ROI, due date of the ROI, interest will start charging. Interest will start commencing. Oh dear God. Sir, because of safe harbor rules, for example, I did adjustment, and safe harbor rule adjustment would be done in ROI only. Lawmaker says if safe harbor, because of safe harbor rule, you are doing the adjustment now. You have to get money within 90 days from the due date of ROI. If you did not get from the very next date of the ROI, you will be charged interest. For example, you are doing adjustment because of appellate order or AO, because of assessing officer's order, you are doing adjustments. Because of assessing officer's order, you are doing adjustment. Lawmaker says within the date of the order of the AO, you shall bring the money back to India. Within 90 days from the date of the AO's order, you shall bring back the money. If you are not able to bring back the money within 90 days, from the very next day of the AO's order, you have to start charging interest. You have to start charging interest. Now, there are possibility that sometimes because of mutual agreement procedure, you have to do the adjustments. Government of India sat up with the government of that country and decided what will be the arm's length price. Government decided, not us, because of which we have to do the adjustment. Lawmaker says if because of government order we are doing the adjustment now, in that case, the date on which such impact has been given in MAP, within 90 days we have to bring back the money. If we did not bring, the very next day interest shall start. It is also possible that because of advance pricing agreement, we are doing the adjustment. Because of advance pricing agreement, we are doing the adjustment. It is possible that because of advance pricing agreement, we are doing the adjustment. Now, sir, if because of advance pricing agreement we are doing that, there are two possibilities. First possibility is before ROI, before due date of ROI, APA is entered. See, if before ROI APA is entered now, you shall bring money within 90 days from the actual date of ROI. If you are not able to bring that, you shall charge interest from the due date of ROI. 90 days from the very next day of the due date of the ROI. But sir, if AP is entered after due date, after ROI, after due date of ROI, in that case, you shall bring money within 90 days from the end of the month of the APA. If not, then from the end of the month you shall starting interest. Start charging interest. I am repeating myself. I am repeating every point now. So if adjustment is done on ROI, suo moto, adjustment is done on safe harbor rules from due date 90 days. If not, then from very due date next date you have to start charging interest. If because of AO order you are doing the adjustment, then 90 days from the date of the order of AO. If not, then from very next day you have to start charging interest. If because of MAP, then date on which MAP has been given impact to, you have to bring money 90 days. If not, then very next day you will be charged interest. If because of APA, advanced pricing agreement, you are doing the adjustment. Sir, if AP is entered before ROI, then from actual date you have to bring money within 90 days. If not, then from due date within 50 within very next day you will be charged interest. If after due date you are entering APA, then from the end of the month within 90 days you have to bring the money. If not, then from the very next date you will be charged interest. We understood from when interest will charge. So what date interest would be charged, sir? It will be charged indefinitely. There is no limit as to how much how much period interest will be charged. There is no limit. Interest will be charged till indefinite period. Indefinite period, there is no limit as to how much interest will be charged. Oh dear God. Oh dear God. No limit as to how much interest will be charged. Oh bhai sir. That means lifelong. Yes, lifelong. Unless you get the money repatriated back to India, interest will be charged. Sir, at what rate interest will be charged? See, a rate of interest is very good. Lawmaker says that if transaction is done in rupees, if you have transacted in rupees, then you will check the SBI rate as on the 1st April of the previous year plus 3 to 5%. 3 to 5, you understand? 3 plus 2 is equal to 5. 3 plus 2 is equal to 5. 3 plus 2 is equal to 5. You understand now? So 3.25% plus SBI rate you have to offer. But if transaction is done in foreign currency, then you have to take 6 months labor rate on 30th September plus 3%. 6 months labor rate on 30th September plus 3%. This is amount you should charge. So international transaction done in rupees, in that case SBI rate on 1st April plus 3.25%. If transaction is done in foreign currency, then labor rate on 30th September plus 3% you have to charge. Sir, can I save myself from taxes? Right answer is yes, you can save yourself from taxes. There is a direct option available to pay additional taxes. Whatever the amount of primary adjustment is now, on that primary adjustment, 18% additional tax plus 12% surcharge plus 4% educational cess you can pay as full. As final settlement, you can pay. What if you pay in final settlement? What will happen in that case? Lawmaker says if you have paid this in the final settlement, now you will not be charged any more interest. But till the date you pay, till that date, interest will be charged. Till the date you pay the amount, interest will be charged. Oh dear God. Remember, if primary adjustment is up to 1 crore rupees, there is no secondary adjustment required. If primary adjustment is with respect to 1st April 2025, sorry, 1st April 2026, before that, then no adjustment is required. No adjustment is required. If primary adjustment is before 2016, no adjustment is required. Sir, whatever the additional taxes you pay, it is final tax, no credit available, no deduction available under PGBP, nothing available. Let me draw a question for you. Let me solve a question for you. You will understand the concept to the fullest. You will understand. For example, this is Rahul and this is Rachel. Rahul sold goods to Rachel for 100 crore, arm's length price is 130 crore rupees. We transacted on 1st July. Sir, when this income will be added to our income, see, there are multiple reasons why this income would be added. Either I can declare myself, either AO finds out, either any other thing. There are multiple possibilities as to how do we get to how will this income be added to our income. Sir, I myself did primary adjustment in return of 30 crore. See, I am the culprit. I only declared this 30 crore rupees in my ROI. Filed on 15th November 2025, due date was 30th November. So my duty is to bring back money within 90 days from the due date. My duty is to bring back 30 crore is treated as loan unless such money is repatriated back to India. Rate of interest is 11.5%. See, I did not get this money repatriated. So how much interest will be charged? Lawmaker says from 1st December till 31st March. That means whatever days it turns out to be, 31 days plus 31 days plus 28 days plus 31 days, all in all, it turns out to be 121 days. For 121 days multiplied by 30 crore, multiplied by 11% rate of interest and plus 3.25%. This is the amount of interest that shall be charged from us. 30 crore plus 14.5% into 121 divided by 365, 1.417 crore interest would be charged. This will be added to our income. Oh dear God. This will be added to our income. Now, SSC wants to pay additional tax on 1st to 31st July 2026. If SSC wants to pay additional taxes, can he pay? Yes. But till the time he pays additional taxes, now he will be charged interest. He will be charged interest. How much interest? Sir, from 1st April till 31st July, 30 days plus 31 days plus 30 days plus 31 days. So 122 days out of 365 days into again 11%. See, for 2026, if we are charging interest, so 2026 rate we shall use, but we have not been given, so we are using old rates only. 11 plus 3 to 5 into how much is the amount? 30 crore. This will be the amount of interest. How much additional tax required to be paid? 30 crore into 20.9664, that is 6.29 crore of additional tax we shall be required to pay. This is how primary adjustment is done. Oh wow, sir. Oh wow. Maintenance of documentation. Wow, sir. Did you understand this point? Primary adjustment and secondary adjustment. Perfect, sir. Documentation in transfer pricing. Always you should have a glass of water. Na? Always sip that water again and again. The more you sip, the more you drink water, na, the more rejuvenating energy will be there. Okay? Perfect, sir. Perfect, sir. Perfect, sir. Documentation and information. Okay? Maintenance of documentation and information. Whenever you do any international transaction, there are possibly three documentation plus one audit report you are required to furnish. Three possible documentation plus one audit report. First of all, is local file or TP study report. Okay, what is local file? Whenever you enter any international transaction, individually or aggregate, international transaction means transaction with associate only. Okay? If you enter any international transaction, individual or aggregate, if it exceeds 1 crore rupees, lawmaker says secondary adjustment is required in case of specified domestic transactions as well. Yes. Yes. All the provisions of transfer pricing are applicable in case the transaction is transaction if the transaction is done with in domestic transfer pricing also every provision of transfer pricing shall apply. Now, documentation. What did I say? If you do any of the international transaction where individually or an aggregate, individually or an aggregate, if transaction value exceeds 1 crore rupees, you have to maintain books of accounts, and first documentation that you have to maintain is local file. Whatever transaction you enter now, you have to mention in this local file. Whenever AO will ask, you have to submit this within 10 days. Extra days, 30 days would be given to you, not more than that. Sir, this file has to be maintained for 8 years from the relevant assessment year. What did I say? International transaction submitted, TP study report. Whatever international transaction you do, that shall be entered in TP study report. That shall be maintained for 8 years. Whenever AO will ask, you can submit that in 10 days. Whenever you do any international transaction, you have to get yourself audited by a chartered accountant up to 31st October in Form 3CEB. If you fail to get that done, 1 lakh fees is applicable. Important is country by country reporting. Always understand. See, why country by country reporting came into picture? Logic is important than just learning. issue was now there were multiple companies like Nestle. Nestle is from Switzerland. Okay? It has operations in USA as well. It has operations in India as well. It has operations in China as well. It has operations in South Africa as well. It has operations in Russia as well. Now, as an Indian entity is only aware about Indian transactions. If government of India wants to know how much Nestle is earning across the globe, government is not aware. If government of India wants to know how much employees are employed at Nestle across the world, we are not aware. What is the tax rate? What is the tax it is being paid? It is being paying. Not aware. What is the capital employed by Nestle across the world? We are not aware. So there are many information that we are not aware. It's like having a guest in our house about whom no information is available to us. So what governments did? Every government sat together and made a provision mandatory in their local tax laws. That is country by country reporting. I will study this. I will teach this when I will be teaching you BEPS as well. Every country came up with this provision under their local tax laws that if there is a multinational entity in their country and parent company is located in your country, for example, India, TCS. TCS is a multinational entity. It has operations in multiple nations, India also, US also, Germany also, Dubai also. TCS has operation in multiple countries. So it is a multinational entity. And if the parent company is located in your respective country now, then you have to take a CBC reporting, country by country reporting. What is the purpose of country by country reporting? At least parent entity shall submit this report in their respective country about taxes, total taxes in every country, capital employed in assets, employee details, and profit before tax. Every practical numerical data of every entity is to be submitted in the CBC reports. Okay. So that parent entity's country is aware about every transaction. For example, Nestle would report this in Switzerland. For example, now if China wants information, China can directly call and ask the Switzerland government via exchange of information clause. India can call Switzerland government and Switzerland government will share the information because of exchange of information clause. In this entire process, mostly the numerical data of the entity are being furnished in CBC reporting, mostly numerical data. Now, in this case, now, when an Indian entity is required, for example, parent entity is located in India, then when an Indian entity is going to report, sir, Indian entity is going to report within 12 months from the end of the financial year. So, joint director and 3 CAD, okay. India requires CBC reporting only if consolidated group revenue exceeds 6,400 crore, not less than that. 6,400 crore is the minimum requirement for the group revenue. Remember, sometimes what happens is, see, normally parent entity is always required. For example, always parent entity is always required to furnish the CBC reporting. But there are situations where constituent entity located in India might also do the CBC reporting. Government of India might force a constituent entity to furnish the CBC reporting as well. What are those situations? First of all, lawmaker says that we do not have any information sharing agreement with your parent nation. For example, India might not have information sharing agreement with Switzerland, so India will force Indian entity to do the CBC reporting. Second thing, sir, parent entity is located in that state where there is no CBC requirement. For example, parent entity is located in North Korea, where there is no CBC reporting requirement. So how will we get information? We will force our country to do CBC reporting. Third thing, we went for information, but the other company denied the information. That country denied to give information. Is that possible? So that is possible. Other company might deny the information to give. They might deny. If they deny to give the information, remember, if they deny to give the information, then it is called systemic failure. Systemic failure, that we went to go for information, but they denied to give information. In all the three cases now, we will force our Indian company to do the CBC reporting. Especially in case of systemic failure, which is a blunder in itself, that country's government denied information. That is a blunder. In this case, the Indian company will do the CBC reporting within 6 months from the end of the month in which systemic failure is intimated. Now, If Indian company is required to do CBC reporting, what is the time limit? Lawmaker says, see, up to 12 months from the end of the financial year, or from the end of the financial year, CBC reporting is to be done. But important aspect is, if we delay by 1 month now, then 5,000 rupees per day fees is required. If we delay beyond 1 month, then 15,000 rupees per day fees is required. If we delay even after receiving the notice, then 50,000 rupees per day from the date of notice penalty would be required. And if we furnish wrong information, now then 5 lakh rupees late fees penalty would be required. And if there is reasonable cause of failure, no penalty is required. Master file, master file. Oh, master, master file. What is master file? See, like a study report was for all the international transactions. TP study report, local file was for all the international transactions. CBC reporting was with the parent entity only, and it is only done by parent company only, and it contains practical data, numerical data. Master file, on the other hand, is responsibility of every constituent entity to furnish some theoretical data. What master file wants? Master file contain list of all the entities, at least what are your group entities, what all countries they are in, what is their address, what is their legal status, what is their ownership, what is the transaction that they do. At least this Indian entity should be aware of, and at least theoretical details of every entity should be aware of. India will force Indian entity to file the master file up to ROI. Sir, this master file is submitted to joint director in form 3CR. It has to be furnished within it has to be kept for at least 8 years. And if master file is not submitted, then penalty is applicable at the rate of 5 lakh rupees. Sir, when master file is to be filed, see, master file is to be submitted if your group revenue exceeds 500 crore or your group revenue exceeds 500 crore. Plus, if your transaction with associate enterprise is more than 50 crore, or sorry, plus your purchase sale of intangible asset from associate is more than equal to 10 crore. So gross revenue more than 500 crore plus transaction with associate more than 50 crore, you have to submit the master file. Or if gross revenue is more than 500 crore, you have bought and sold intangible assets more than 10 crore, then you have to maintain master file as well. So this was nice, but isn't there any, don't you think there should be a shortcut to learn this? I mean, very theoretical bad, but data it is. Don't you think there should be some shortcut to learn this? I will tell you shortcut. I will tell you shortcut. But only if you have subscribed to the channel, you have liked the video. I will tell you the shortcut. And also hype the video as well. Sir, when we see your expressions now, I mean, we feel desperate to like the video. I mean, even if you don't want to, your expression will force us to like the video. At least. See, after some hours of efforts, I have created a summary on the last day. Even if you refer this now, that will work. I am giving you time to take a screenshot. You can pause the video, pause the screen and take a screenshot of this. What are the documentation summary? Local file, CBC reporting, master file. What is to be recorded? Any international transaction with A in local file. CBC requires PAT reporting, taxes, capital employed, employee details, group level details. And master file requires theoretical state details like legal status, ownership, country of incorporation, transaction. These are the things that are required in master file. When individual aggregate transaction exceeds 1 crore, if individual aggregate transaction exceeds 1 crore rupees now, then in that case, local file is reported. If consolidated group revenue is more than 6,400 crores, consolidated group revenue is more than 6,400 crore, then only CBC reporting is done. Master file is done when group revenue is 500 crore plus international transaction is 50 crore or international intangible transactions are 10 crore, then only master file is required. Sir, study report is not filed anywhere, whereas CBC reporting is filed within 12 months from the end of the relevant accounting year. If there is systemic failure, then 6 months from the end of the month of the intimation of systemic failure. And master file is reported up to the due date. For 8 years it is maintained. Penalty for non-maintenance for TP study reports are 2% of the transaction value. If you did not maintain master file, then 5 lakh rupees. And 15,000 rupees is the penalty. 5, 15, 50 is the penalty amount for CBC reporting. If you incorrect furnish information, then 5 lakh rupees for CBC. In all the cases, always understand, penalty would not be levied if there is reasonable cause of failure. How did you like this summary or not? Just mention this point to me so that I am a bit motivated to make more such summaries. Perfect, sir. Perfect. Perfect, sir. Perfect. Moving further. Moving further. 92 BA. 92 bar. What it says. See, initially we started off with transfer pricing where we understood any associate enterprises. Perfect, sir. Wow. Wow. Now, if any associate enterprise does any international transaction, it should be done at arm's length price. Along with that, there was a line if any associated enterprises, if associated enterprise do any specified domestic transactions, specified domestic transaction, that should also be done at arm's length price. Now, what does that simply mean? What does that simply mean? We need to understand that if there are two entities, entity 1 and entity 2, these are associated enterprises, and one of them claims 10AA or 80 IA to RRB or 115 BAA, sorry, BAB or BAE. Any of the three things is claimed by one entity now. Then specific domestic transfer pricing rules are triggered. What it is triggered? See, whatever the transaction they would be doing now, same transfer pricing provisions would apply as if normal international transaction would apply, and the same transfer pricing provision shall apply every transaction. Sir, be it associate enterprise, be it calculation, be it reference to TPO, be it any kind of documentation, be it audit, and be it other penalties, everything shall apply as if it was a domestic transaction, as if it were international transaction. But important here is, sir, transaction shall only be attracted. I mean, transfer pricing shall only be attracted if transaction value is more than 20 crore rupees in a financial year. That's it. If transaction value is more than 20 crore in a previous year, individual or aggregate, then only transfer pricing provision shall apply. Otherwise, it shall not apply. This is specified domestic transaction. Bonus stripping transaction. What does this mean? Bonus stripping transaction. What does this mean? Let me tell you. For example, it is day. I mean, there is a company called Reliance. Okay. I have 1,000 shares acquired for 3,000 rupees. 30 lakh rupees shares I have. As soon as acquired, within 3 months, within 2 months, I received a bonus. Now I have 2,000 shares at the rate of 1,500 each. Out of this 2,000, 1,000 are original shares and 1,000 are bonus shares. 1,000 are original, 1,000 are bonus. What I did, I kept bonus with myself and original shares I sold. So full value of consideration for this 1,000 shares would be nearly 1,500 only. So 1,500 is the value minus cost of acquisition. Cost of acquisition would be 0. Sorry, cost of acquisition would be original 3,000. For original shares, cost of acquisition is original shares only. For bonus, it would be nil. So now I have a loss of 1,500 rupees on each share. Loss on 1,000 shares. That means I have fokat ka loss, free ka loss. I have 15 lakh rupees and I can use this against other capital gain. So this is loss shopping. Okay, loss shopping. What lawmaker says, if a person buys any securities within 3 months prior to record date of being bonus, within 3 months you are buying and you have been allotted bonus, lawmaker says that if you transfer any securities or any of the original units or any of the original units, if you are transferring and keeping the bonus securities within 9 months from the record date, lawmaker says that loss arising on the original units shall be completely ignored. This loss of 15 lakh shall be ignored. Sir, what will happen? Sir, this loss will become cost of acquisition for the remaining securities. This will become cost of acquisition for remaining securities. Whatever the bonus shares I have now, this 15 lakh would become loss. The biggest question comes to students' brain is why is this chapter, why this topic is from transfer pricing? Why are we studying this topic in transfer pricing? Ideally, I have no answer to this. The reason why we are studying this in transfer pricing is because this is a part of section 90 to 94 series, and that is a part of transfer pricing. That is why we study this. Otherwise, there is no reason. Transaction with person notified jurisdictional area. See, we are na Vishwa Gurus. In India is a Vishwa Guru. India is into Amrit Kal. I don't know how much you understand these terms, Vishwa Guru, Amrit Kal. I don't. But India is is a very developing country, very fast moving developing countries. If we look at any other small country and if we want to kill that country, we might declare such country as notified jurisdictional area. If we want, I mean, loss of a country, then we might declare such entity as notified jurisdictional area. Now, what does notified jurisdictional area means? If a country is treated as NJA by India, in that case, now every entity that is located in NJA, every entity that is located in NJA shall become associate. Every transaction entered with person located in NJA, that shall be an international transaction. Every transaction that is done shall be done at arm's length price only. And the best part, all the provisions of transfer pricing shall apply as if it was an associate enterprise only. Except for one provision will not be applicable. And which one? So that the 1%, 3% range we used to get, now range will not be given here. Oh dear God. Range will not be given, sir. Otherwise, every provision of income tax shall apply as it is. Wow, sir. Wow, 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 wow. And at last, sir, whenever you make any payment to person located in NJA, you shall deduct 10% TDS. 10%, 30% TDS. You have to deduct 30% TDS plus surcharge plus education cess. You have to deduct the TDS. If you receive any money from person located in NJA, remember you have to offer the explanation on such income. If you do not offer explanation, if you cannot offer explanation, lawmaker says that it will be treated as your income. It will be treated as your income. Sir, there is a special pointer that one must be taken care of. One must be taken care of. For example, this is Rachel. She is located in NJA. For example, she is located in United States, and because India is a, very bold country, India declared USA as NJA. India declared United States as NJA. ठीक है? For example, now if Indian government, if Indian person pays taxes to pays 1 crore royalty to Rachel, deducts 30% taxes, for example, ठीक है? Plus whatever surcharge is there, plus whatever education cess is there, we deducted TDS. ठीक है? Done. We deducted TDS. Now, issue here is, you know what? Deducting TDS at the rate of 30% doesn't taxes the income of Rachel at 30%. See, this NJ is only for compliance mechanism. This NJ is not a harm to the other person. We want effective information mechanism, and that is why we have declared you as notified person. There is no information mechanism. That is why we declare. There is no such reason we want to hurt that economy, but we want effective exchange, information exchange mechanism. So if Rachel wants to pay taxes at a lower rate, na 20%, she shall come to India or she shall file return of income in India. And once she files, she can take the refund of the remaining amount. She can come to India and file ROI. That means whenever we talk TDS at the rate of 30%, that never implies the tax rate as 30%. Tax rate will remain the as it is. Person located in NJA doesn't mean the tax rate would be 30%. Only TDS rate would become 30%. 30% or rate of respective section, whichever is higher. Limitation of interest now. Limitation of interest is somewhere called thin capitalization. So if you hear the word thin capitalization, it means section 94B only. If there is an Indian company or permanent establishment of a foreign company and this pays interest to any of the associated enterprises. Okay. Interest can be a short-term loan, long-term loan, operating financing, any interest can be paid. Lawmaker says whatever excess interest that you are paying now, that shall be disallowed. Up to limited interest you are allowed to pay, but excess interest whenever you pay, that shall be disallowed. Limited interest will be allowed, but excess interest if you pay, that shall be disallowed. What is excess interest? Listen. What is excess interest? Very carefully listen. Sir, 30% of EBITDA is allowed. It is allowed. 30% of EBITDA is allowed. Not more than that. If you pay any way more than that, that shall be absolutely disallowed. Sir, but legal terms, if you see now, they say interest to associate minus 30% of EBITDA or interest to associate, whichever is lower is disallowed. So it is same as allowed is 30% of EBITDA. Now, what is 30% of EBITDA? It is earning before interest, taxes, depreciation, and amortization. Sometimes what people do is instead of paying the interest now, they pay commission, they pay fees, they pay brokerage, they pay financial charges, which resonate to interest only, but that is not interest. Lawmaker says that any financial charge you incur, it is interest only. Sometimes what happens is, now this is for example Rachel. Rachel is my associate, and this is Rahul. Rachel is my associate, and Rahul is B only, na? I pay interest. So 94B provisions would be triggered. But what happened? You know what? I did not pay interest to Rachel. There is a person called Chandler who gave me loan and I gave him interest. But in fact, what happened? Rachel has given guarantee to this Chandler person. Rachel has given guarantee to Chandler, or Rachel has deposited corresponding amount to Chandler. Deposited corresponding amount to Chandler. Lawmaker says that if Rachel has given guarantee, or Chandler has deposited corresponding amount to Chandler, in that case, what would happen? In that case, what would happen? Sir, if you pay interest to Chandler as well, now this shall be also covered under 94B. That means if you are not paying to associate, but if you are paying to third party, but with that third party, your associate has given guarantee or associate has deposited corresponding amount. In that case, interest to such third person shall also be considered under 94B. Few more, two or three more pointers here. See, whenever you pay interest up to 1 crore rupees now, then no 94B provisions are applicable. Up to 1 crore it is allowed, you can pay. See, for example, if there is Indian bank, if there is insurance company, if there is an NBFC, if there is finance company located in IFSC, if they pay interest more than 30% of EBITDA, it's allowed to them. Because for them it is business only. They want money at a lower price, so they want money. They can take money. They can even pay more than 30% of EBITDA. That's allowed. At last, sir, whenever excess interest is disallowed, it is carried forward for fresh 8 years. Let me take an example. For example, previous year 24-25, our EBITDA was 20 crore. So allowed interest is into 30%, that is 6 crore is the allowed interest. We paid interest, how much? We paid 8 crore. So how much will be actually allowed? So 2 crore will be disallowed. Lawmaker says whatever is disallowed, you can carry forward for 8 fresh years. 8 years. You can carry forward for 8 fresh years. Now, issue involved is a very, very small issue. Next year, again, EBITDA is 20 crore. Allowed is 30%, that is 60 crore, 6 crore. This time we paid just 5.5 crore. Lawmaker says since we are allowed to pay 6 crore, we just pay 5.5 crore. So 50 lakh is extra allowed now. 50 lakh is okay to us. It is allowed. We can use this. So whatever last year disallowed, out of this 2 crore, 0.5 crore will be carried forward. This can be set off. This can be set off. This can be set off in current year, and remaining 1.5 year would be carried forward for remaining years. This is how we set off interest. Okay? In 1 year it is paid extra. Next year we can set off if we pay lesser. That's it. Oh my god. Oh my god. Done. Done. Array. What else you want? Come on to question number 114. See, whenever these are the questions from indirect, these are the questions from 94B. Understand how they are asked, how they frame the question. You will understand. You will enjoy this. NP Limited is an Indian company. Borrowed 80 crore from TL. So there is a company called TL who gave 80 crore rupees. Company incorporated in London. So, and at an interest rate of 10%. So at a rate of 10% interest. That means interest paid by NP is 8 crore rupees. Seems fair. The said loan is repayable for a period of 5 years. Further, loan is guaranteed by ST, which is incorporated in UK. Acha, loan has been guaranteed by ST. Who is our ST? ST, who it is? If it is an associate, then interest paid to this would be covered in 94B. It's Tweed is a non-resident, holds 40% in voting powers in both NP and ST. So there is a company called Tweed who holds 40% in NP and who holds 40% in SD. Oh, Tweed holds 40% in NP. Tweed holds 40% in ST. That means NP and ST are associates. And our associate has given guarantee. That means whenever we will pay interest, 30% of EBITDA shall be only allowed. Okay, so net profit is 7 crore rupees. Net profit is always after considering interest, depreciation, everything. After debiting above interest we shall add up. Depreciation we shall add up. Taxes we shall add up. How much it turns out to be? 15, 21, 20, 25 crore it will be. Out of that, 30% is allowed. That means 7.5 crore is allowed. Out of 7.5 crore, how much we have actually paid? We have actually paid 8 crore rupees. Sir, we have actually paid 8 crore. Allowed is 7.5 crore. So 50 lakh would be added back. Oh my God, sir. Oh my God. It is very easy, very easy peasy. Easy peasy, easy peasy, easy peasy. So your overacting is not easy peasy to take. You really overact a lot. I mean, sir, really overact a lot. So what? Huh. Even though we are left with double taxation avoidance agreement, but I personally think we should start with base erosion profit shifting. Base erosion and profit shifting. Did you understand transfer pricing? How was your experience at transfer pricing? Acha, see, we take this marathon. See, of course, we study. Maybe we might take 8 hours, we might take 8.5 hours. I will clip out the break portion and I will upload the remaining portion. So it will be a compact marathon of 7.5 hours, 7 hours. It will be that much only. 7.5 hours, 7.5 hours. Now, so we are allowed 5 to 10 minutes of time pass for sure. Meanwhile, how are you? How is life going on? Please elaborate in the comment section so that at least we get to know from where people are listening to this video, from where you are looking at this video, which state you are from, which city you are from. How did you get to know about this video? If you are watching this lecture recorded, do mention this thing in your comment box. Even if day before exam, if you are watching this lecture, now do consider answering this. Why, sir? A day before exam? Arey, always a fresh up is better than a rigorous studying for 8 hours. Small breaks, small time passes are always better. Chalo, let's do base erosion profit shifting and then we'll have a break. Small chapter, very small chapter, a very important chapter, even though. Very important chapter. Understand what was the purpose of BEPS, why did it come into picture. It will give it will give you a clear idea as to how to write the answers. It is for sure that BEPS is asked in exam, and always give yourself this privilege not to skip out this chapter. I personally think that if you watch this video now, your entire concepts would be cleared in BEPS. If you are left with some doubts now, your doubts will also be cleared with this video. I can assure that thing. Only thing what I want is just listen, participate, and process what I say. Okay? In transfer pricing, we understood how a change in transfer pricing can lead to so much of tax change. Just because of this transfer pricing, just because of this arbitrage, so much of profit was shifted from India to other countries. It happened. There are many places, there are many manners through which people can transfer their profits from high tax paying countries to low tax paying countries. People will do that, of course. Why would anybody want to pay for 35% tax? Why would anybody want to pay? If there is a multinational entity, every multinational entity would try to maximize their profits in the area where there are less taxes. Of course, every entity would do that. And that is nothing but base erosion, profit shifting. Erosion of profit based from high tax paying countries to the areas where there is low tax paying countries, taking advantage of mismatch and gaps. Shifting your profit from high tax paying country to low tax paying country and disappear profit, so that there is tax arbitrage. That is nothing but base erosion, profit shifting. Now, for example, if India undergoes BEPS, I mean India undergoes BEPS as in India suffers BEPS, profit from India is shifted to other countries, then what are the consequences? There are four major consequences. First of all is revenue in India is less. I mean, government has lesser revenue but higher admin cost, lesser taxes to government of India, more profit gone, lesser the taxes India would receive. Similarly, admin cost will be higher. To collect the taxes, it has to focus more here. It has to hire more assessing officers. So lesser revenue and higher admin cost. Second thing, underfunding of public enterprises. Sir, what is the biggest? So the biggest loss? If government has lesser revenue, there will be lesser money for schools, hospitals. Third thing, tax integrity is undermined. What does that mean? See, government ultimately wants taxes. Government ultimately wants taxes either from your pocket or from corporates pockets. If corporates if do BEPS, it will be on your pocket. So individual has to bear the higher burden. And at last, sir, what happens? Sir, local competition is suffered. For example, if there is a foreign company and entire of their profits is wiped out, so they will be left with more profits. They will have more marketing spent, they will have more money to spend, they will have more money to R&D. But in India, there will be lesser profits, there will be higher taxes, so there will be lesser competition left. Foreigners would wipe away the Indian competition. So four losses of four adverse effect of BEPS. First of all was lesser revenue, underfunding of enterprises. Third thing, tax integrity is undermined, and fierce competition in local market. These are the advantages, these are the four consequences of BEPS. Now, how to tackle the base erosion, profit shifting? For that matter, entire globe, entire countries, most of the countries met at OECD. OECD is nothing but Organization for Economic Cooperation and Development. It is headquartered at Paris. Every country is seated in a room, and there is a chairperson of OECD, and he is taking a mic. Like this. He's taking a mic. Listen, 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 listen. Everybody, listen, 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 listen. Like this, he's taking a mic and saying this thing. OECD person is saying, "See, you small, small country. See, imagine. Imagination is the best thing. Okay? OECD chairperson is saying out to every country, "See, you small, small countries. You small, small countries. You small, small countries. Your profit is eroded from your country, and profit is charged to taxes in the country where there is actually no tax. Do something, do something, do something." Country says, "Yes, yes, yes. Profit is really eroding, but what can we do?" So OECD says, "I am telling you what are the ways people are doing base erosion and what we suggest you could do. And third thing, what you actually did." Okay? OECD is suggesting ways. So OECD is suggesting how base is eroded. OECD is suggesting how to correct that. And OECD lists down the things that India did. Okay? First, OECD suggested, see companies, see companies, these big companies like Google, Spotify operate everywhere in the world and pay taxes nowhere. OECD is telling first action plan about digital economy. Big companies like Google do not have any permanent establishment in any countries. They pay taxes nowhere in the world. They pay taxes nowhere in the world because they do not have P. So old permanent establishment rules are irrelevant as of now for these big companies. OECD has told this bigger issue that old permanent establishment rules that we have studied in Model Tax Convention, old permanent establishment rules are not relevant today because of the digital nature. So this is the bigger issue, digital economy, because old PE rules are not relevant. What OECD recommended? OECD recommended three things. First of all, change the definition of PE. Make digital presence as PE. This is what OECD recommended. First thing, make digital presence as PE. This is first recommendation. Second, change definition of PE by making virtual place of business as PE as well. What does that mean? If a website is located in your country, then make it PE. Sir, can it be made? Sir, it cannot be made. But what if web server of a website is located in your country? Make it permanent establishment. Third thing, whenever any such company like Google, like Spotify wants to take money outside of India, outside of your country, impose some withholding taxes, impose some equalization levies. Three things they suggested. First of all, make digital presence as P. This is first thing. Second thing, fixed virtual fixed place of business. Third thing, withholding taxes or equalization levy. Three things are suggested. Three things are suggested by this OECD. What India did, please try to speak out. Please try to speak out. What was the issue? Sir, old permanent establishment based rules are irrelevant because of digital presence. So what suggestions that they gave? Sir, change the definition of the permanent establishment, make digital presence as PE. Second thing, virtual fixed place of business. If they have website in India, it cannot become PE. But if they have server that is on Indian place, it can become PE. And third thing, impose withholding taxes. What India did, India came up with significant economic presence. Section 9, subsection 1, we discussed in the morning, significant economic presence. If any company has more than 3 crores of to 3 lakhs download, 2 crore revenue, then any advertisement money that they take is taxed in India. India came up with significant economic presence. Second thing, what India did is India imposed equalization levy via Finance Act 2016. Even though it is abolished as of now, but it came now as an action plan of the BEPS. I hope you understood what is action plan number 1. Just mention the word clear so that it is clear that you understood. Action plans are very simple, but the mindset is very difficult to understand. Action plan number 2 is hybrid mismatch arrangement. See, a Mahapurush, a Gyani person once said, your 6 can be my 9. Your 6 can be my 9. Okay, your 6 can be my 9. It is possible. Let me tell you one example. For example, this is France and this is Germany. France gave loan to Germany. Germany paid interest. It paid interest, and interest was allowed as deduction because interest is debited to P&L and it is allowed across the world. It is allowed across the world. When this money was received in France, now it is considered as dividend because the investment that this France has made is in the form of subsidiary. So it is considered as dividend. And let me tell you, my dear friends, India does not have this concept, but across the world, whatever the dividend income is received, it is exempt. Across the world, whoever receives the dividend, it is exempt because taxes are already paid by the company. If company distributes dividend, they are distributing profits now. Post tax profits they are distributing, so it is already exempt. So in this case, France has exempted the dividend because it is already taxed. Now, if you see, this is the hybrid mismatch I'm talking about. Hybrid mismatch means different treatment of the same instrument in different countries. Different treatments of the same instruments in different countries. OECD saying, listen, you small countries. Listen, you small countries. Sir, you overreact a lot. No worry. You are understanding, that's it. Listen, you small countries. People will make use of hybrid mismatch nature. For you, it might be interest. For other, it might be dividend. And therefore, they are going to take the advantage of tax exemption. Did you understand OECD's second issue? Issue here is arrangement that exploits the tax treatment in the entity. There are different tax treatments of the same transaction. It is possible. Now, how hybrid mismatch arrangement is achieved? See, taking deduction twice. Taking deduction without even considering the income. Misusing foreign tax credit or participating in exemption regimes. These are the ways through which hybrid mismatch arrangement can be done. Now, what OECD said? OECD said, "Arey, change your tax laws. Do not allow hybrid mismatch arrangement. If tax is not charged in that country, charge taxes in your country. Do not exempt that." This is how hybrid mismatch arrangement is tackled. OECD recommended change your tax laws. That's it. What India did? So India doesn't have any problem of hybrid mismatch because India taxes everything. Even if you tomorrow sweats can be sold now, everything can be it will be charged that as well. Everything. Okay. India never leaves out anything. So there is no hybrid mismatch arrangement left in this case. India has not done for hybrid mismatch arrangement. Now, third thing. Action plan number 3. Control foreign operations. Again, OECD, take up mic. Listen, you poor small countries, poor small countries. Acha, you are able to hear ना? ऐसा तो नहीं ना कि my voice has become voice goes too much up and down. ठीक है. Again, OECD is taking on you poor countries, poor countries. Listen, what poor countries? Issue is, see, if you have rich people and if you have higher tax rate now, people would create companies outside your country in non-tax paying countries. People would create companies in non-tax paying country and earn passive income there. For example, we have with us Kishore. We have with us Kishore. Kishore is from India and he has 1,000 crore rupees of wealth. 1,000 crore rupees of wealth, and he created a company in Panama Islands. Panama Islands. He invested 200 crore rupees there and he's earning interest, he's earning dividend, he's earning capital gain, he's earning royalty. Everything he's earning in that country. Everything he's earning in that country only. Why he's earning in that country? Because tax rate is zero. Tax rate is zero. This is controlled foreign operations. Your people will create companies in the countries where there are low taxes to earn the passive income. See, active income cannot be transferred there. See, active income you need to do on day-to-day basis. Passive income can be transferred. So lawmaker says people will create companies in tax haven countries, will be controlled from high tax paying countries to direct the income to the low tax jurisdiction. Now in that case, what to do? OECD said this is an issue. People from your country will divert the income to the lower countries where there is no tax rate. Do something, do something, do something. What OECD recommended? OECD recommended is charge taxes when in any way this money enters your country. If this money comes to your country in the form of dividend, charge taxes. If this money comes to your country in the form of loan, charge taxes. OECD recommended change your local laws so that whenever money comes to India, it is taxed in your hands. Do you think that India needs to do anything on this? Do you think that India needs to do anything on this? Right answer is no, because India already has deemed dividend concept. India already has deemed dividend concept, so India is not required to do anything. Are you understanding? India is not required to do anything because India already has deemed dividend concept. Sir, we got it. We got it. So India already has deemed dividend concept, so India is not required to do anything in this case. Perfect. But one thing India still did. One thing India still did. What thing India did, sir? India did poem concept. Do you know? As per poem concept, in the morning only we said, if there is a company outside India whose management has been, whose decision making whose decision making is done from India, then poem will be Indian. This company will be resident and the taxes will be charged in India. Do you remember? Are Baba, listen. See, it has been 6.5 hours. I have been shouting. Okay? If you are not listening, it is absolute your loss. This is not the chapter that you are going to take off your own. I'm saying you are not going to take off your own. And if you are not listening now, you are just losing yourself. You are losing 4 marks that is free of cost. Listen. Now, what did I say? People from your country where tax rate is high will park their income in low tax paying countries to earn the passive income. What should you do? You should charge taxes whenever income enters your country. This is what OECD recommended. In that sense, now what India did, India already had deemed dividends, so India did nothing here. India did nothing here. But sir, India added one more thing. India already had one thing to cover this, that is poem concept. If any foreign company is being controlled by India, it is poem is in India only. So that is why controlled foreign operations is less relevant, because everything has been taken care by India only. Perfect, sir, perfect. Action plan number 4. What is action plan number 4? Sir, 4 resonates to 94. 4 resonates to 94. What is this 4? See, try understanding. If you are high tax paying country, if in your country tax rate is high, you will see that majority of the debt is in your country. If there is a multinational group now and they have an option to invest equity or invest debt in your country, for sure they will invest debt in your country because you have higher tax rate. So they will try to take away interest expense and they will try to take away your profits from India. OECD is again recommending, see, you poor countries, if you have higher tax rate now, if you have higher tax rate, you will see that there will be more debt instruments, there will be debt investments in your country, so that there is more interest outflow. What OECD recommended? OECD recommended three things. OECD recommended three things, sir. So OECD said fix a ratio rule. Fix how much interest outflow can be there to a specific entity. For example, if India is paying to any entity in France, maximum 20% of the PAT you can pay. Maximum 20% of the PAT you can pay as interest. Maximum 10% of EBITDA you can pay as interest. You should fix that. Second thing, group ratio rules. Sir, as a group, individually you can pay 10% of EBITDA. Group 40% of EBITDA you can only pay. Make that rules. Entity specific rules, group specific rules, how much interest should be allowed. Third thing what they said is targeted rules. If you are a banking company, if you are an insurance company, how much interest outflow should be there, how much interest percentage should be allowed, make rules for that. What India did, India only came up with one thing, that is 94B. India only said that if we pay any money to associated enterprise, we shall charge 30, we shall only allow 30% of EBITDA. OECD recommended to an individual level, to a group level, to a banking level, but India did nothing. India just did the transfer pricing 94B. That's it. Action plan number 4. Action plan number 5. For example, we have with us Janvi. No offense to Janvi, take it, no offense, it's just a joke. She was in a kitchen. Why, sir? Why a girl will be in kitchen? Arey Papa, just joke, I am saying. Chalo, leave Janvi. We have with us, for example, Kishore. Sir, Kishore is in a kitchen. One day he was making a sambar. Sambar, you understand? Idli, dosa, sambar, chutney, sambar. And in that sambar, na, by mistake, some harpic was poured in. By mistake, some harpic. Sir, why sambar, harpic? I mean, whatever it is now. Sambar, I mean, harpic was poured in sambar. And by mistake of salt, na, he put some sugar in it. I don't know what happened, but there was a blast that happened. Blast. Sambar, sugar plus harpic. There was a blast that happened. Entire droplets of that sambar was in the entire kitchen. Kishore was worried. What happened? What happened? What happened? There were droplets of sambar on his face, on his hands, on his body, on his clothes, everywhere. The next day, hair started to grow up. Hair started to grow up in Kishore's entire face, entire hands, entire even clothes started to grow hairs. Oh my God. The very next day, Jeff Bezos started calling, "Oh my dear Kishore, please share this technology to us." Elon Musk called Kishore, oh Kishore, share this technology to us. Even Donald Trump, Barack Obama says, I want this technology. This technology became so popular. But what Kishore did, you know what? Kishore registered this patent in Panama Islands. Nimotai was happy that there was some invention happening in India, some great invention happening in India. But Kishore did not register that in India. Kishore registered this in Panama Islands because their tax rate is low. That is what suggested by OECD. OECD again took up the mic and said, see, you poor countries. See, majority of the registration, if your tax rate is higher, then most of the intellectual property rights that are made in your countries now will not be registered in your countries. Most of the intangible assets that are created in your country now will not be registered in your countries. They will be registered in a country where there are lower tax rates. This was the fifth way of base erosion profit shifting. What OECD recommended? OECD recommended that you should reduce your tax rates for royalties. You should reduce your tax rates for royalty. And in that case, what India did, India came up with 115 BBF on the royalty to patents. If patents have been developed in India, if a royalty is being paid on that patent, now India will charge only 10% taxes under section 115 BBF, provided 75% of the expenditure is done in India. Action plan number 5, 115 BBF. Okay, 5, same to same. Action plan number 6. Preventing treaty abuse. What is this treaty abuse? Understand. For example, India has double taxation avoidance agreement with Russia. Whatever the people of Russia are there now can invest in the equity shares of the India, and whatever the cap gain is there now, it will be exempt in India. India exempts such capital gain. India says Russia is our brother, Russia is our crime partner, so Russia is our chaddi buddy. Whatever the cap gain Russia incurs, that will be exempt in India. India exempts such capital gain from Russia. Can India give preferential treatment to somebody? Yes, it can give. It's up to them. It's up to us. But there was somebody who was looking at this, who wanted to take advantage of it. Who wanted to take advantage of it? This person was nobody but Donald Trump. He created companies in Russia and started investing in India. Wow. So FDIs came to Russia and people started investing via Russia route to India. People started investing via Russia route to India. Now, are you understanding how people are trying to misuse, how people are trying to treaty shop? People would do that. There would be more capital gain in your hands, and that too only from Russia. So, if you are giving any preferential treatment to somebody via treaty, make sure that people do not misuse that. Other people are not allowed to misuse that. This is what the action plan number 6 says: preventing treaty abuse. See, small people will try to abuse your treaty. This is what the sixth issue OECD recommended. What was the suggestion? Sir, OECD suggested some actions. What it says, bring the limitation of benefit loss. What does that mean? Understand. OECD said, bring out the limitation of benefit loss. What does that mean? See, whenever you are paying whenever you are having a preferential treatment in DTAA, make it more difficult to access to an outsider. For example, if you say that it is exempt, capital gain is exempt for Russia, in that case, what should you do? Sir, you should make a clause that only Russian citizens are allowed to invest. Whichever the companies are being formed in that company, directors have to be Russian citizens only. Exemption would only be given if the securities are held for more than 10 years. These type of limitation of benefit laws should be given. Okay? Action plan number 7, artificial avoidance of PE. What does this means? What does this mean? Try understanding this. Try understanding. See, what happens is, for example, this is a French company. French company does work in India, a construction work in India. We have studied this thing that if there is construction work now, if there is construction site under OECD, under UN model, if this construction site is for more than 6 months, then this construction site shall become permanent establishment. If this construction site is for more than 6 months, it shall become permanent establishment. We understood this thing. Now, what this French company did, you know what? It created a contract of 3.5 months via one company, and second company it created via contract 3.5. All the members are same. All the members are same, but just two different companies, two different contracts, so that status of permanent establishment is avoided. Status of P is avoided. See, people will try to do that. People will try to do that. In that case, what you should do, sir, if people are trying to artificially avoid the treaty, you shall club all the activities. Club all the activities. If multiple entities provide, try clubbing that and find out the P status. If you are able to find that P is being avoided, you shall consider it as P. People will try to avoid P. Now, action plan number 8 to 10. These are all similar, not difficult at all. Let me take an example to illustrate that. For example, there is a France and India DTAA. There is an Indian company which works in India, which works in Panama as well, and which works in China as well. Okay? It works in 3 countries. Okay? There is a foreign company in India which works in 3 countries. Okay? Now, like French company gave an order of 1,000 crore rupees, and this Indian company was supposed to execute this work. Indian company was supposed to execute this work. Indian company itself gave the manpower. Technological support was given by China, and Panama gave nothing. But when turn came of allocating how much money should be allocated to which country, allocation will also be done now. Of course, entire 1,000 crore will not be in India. For example, India's allocation was 100 crore, China's allocation was 100 crore, and Panama's allocation was 800 crore because taxes there are zero. Can you imagine if an Indian company has multiple operations? So whenever there will be allocation of income, income would be allocated in those countries where there is lower tax rate. This is also an area, is a danger area. A danger area. See, if there is transfer of intangibles involved, because ultimately, if you are providing services, you are not sure how much money to charge. If there is contractual allocation of risk and rewards, and if there is high focus area like profit allocation in case of controlled transaction, using transfer pricing to divert project, branch expenses, overall over allocation, under allocation of the funds, in all the cases now, there are greater areas. What OECD recommended, just carefully watch the transaction. This is the area where OECD itself failed. OECD said just to do the proper transaction, just to do the proper vigilance of the transaction. That's it. OECD recommended this much only. Action plan number 11. Action plan number what? Action plan number 11 says always time to time monitor BEPS. Always time to time monitor BEPS. Always measure BEPS time to time. What does that mean? See, you should continuously check that whether base is eroding or not. Sir, what are the indicators as to how do we understand that base is eroding? There are 6 indicators as to how do we understand base is eroding. First, profit rate in M&E affiliates is lower in lower tax countries is higher than group profit worldwide. Let's understand. Okay? There is a company which has operations in India, China, Panama, and Russia. Overall profit rate is 20%. Overall company is earning 20%. India also 10%. China also 15%, Panama 90%, and Russia 15%. Can you see something wrong? Same company, when it is operating in different countries, profit rate is very less. But in country where there are no taxes, profit rate is very high. So this is an indicator of BEPS. Next, effective tax paid by M&E is lower than domestic entity. What does that mean? Listen, there is a company which has operations in multiple companies. Overall tax rate is just 15%. Overall tax rate is just 15%. In India, 35% taxes is required. The 35% taxes is paid. China, 35% taxes is paid. Russia, 25% taxes is paid. But Panama, 0% taxes. Are you understanding? 0% taxes, 25% taxes, 35. All these three average out to nearly 20, or average out to nearly 30. But still average is coming 50. That means majority of the profit has been shifted to Panama. That means whatever your local tax rate is, average tax of the world is lesser. That means your profit is shifted to low tax paying countries, and that is what the measurement of BEPS is about. FDI concentratedly increasing. See, you will see that if there is base erosion, you will see that people will start parking their income in the other countries. FDIs outside India will increase. All of a sudden, you will see that there is outflow of the money. So FDI will start increasing. This is an indicator of BEPS. Location of value creation of the activities and taxability is different. What does that mean? See, for example, Kishore created Sambar in India but registered in Panama. So value creation is a different place, but registration is taxability is profitability is different. So this is an indicator of BEPS. Royalty received by countries in low tax paying countries is higher in that country. In the countries where there is lower tax rate, where there is lower tax rate, you will see that higher royalties being earned. And at last, so debt is concentrated in high tax paying countries. More and more debt would come to those countries where there are higher tax rates. Equity would go to those countries where there are lower tax rates. So that is also an indicator of BEPS. Sir, aggressive disclosure. See, these big companies now will not disclose you. This is another action plan. What OECD recommended? OECD recommended you change your local tax laws and make more and more disclosure requirements mandatory. In India, under tax audit, 50 clauses are required, and even every reporting that is being mentioned as reported in tax audit. This is how every country should increase the reporting requirements so that even a small thing, if mismatches, there is an indication of BEPS happening. Re-examine transfer pricing document. See, every country should re-examine the transfer pricing documentation. Local file should be re-examined properly as to whether there is any dodging of transactions. Master file should be checked that what other companies incorporation status is. CBC reporting should be constantly checked so that we are aware how much profits, how much taxes are being charged. This will tell you how much base is eroding and profit is being shifted. Action plan number 14, dispute resolution mechanism more effective. See, if any of the person is being charged taxes in two countries, then in that case, MAP should be accessible as soon as possible so that there is not a shifting of income. If somebody has doubt as to whether income would be taxed in this country or that country, if somebody sees that base erosion is happening, so there should be a fast MAP, there should be a fast dispute resolution mechanism that will help in preventing base erosion profit shifting. Last thing is MLI. Up to this point, I don't think anybody would be having any doubt. Next point is technical. Understand this. Whatever I am saying, that is what you need to understand. Now, OECD came up with MIC. This is the OECD and having a mic. Listen. These are the adjustments you shall do. You shall do. You shall do. Every country is sitting in the corner, scratching their head, understanding how do we do the adjustment. Every country is doing scratching their head as to how do we do the changes. 14 action plans, 50, 60 suggestions. Suggestions are good, of course, but just imagine India. India has 140 DTAAs. Every 140 DTAA are to be changed. Similarly, every 140 countries should be agreeing to get changed. Difficult, na? Really difficult, na? Really difficult. How do we get that changed? So OECD said, let's do one thing. Whoever agree to our conditions, just come and sign to this paper. For example, India agrees with 140 countries, and 140 all the 140 countries would come and sign. So everybody is agreeing to everything now. So this will happen. This instrument is called multilateral instrument. Multilateral instrument is nothing but it is an instrument which amends the treaty. Instrument by OECD which amends the treaty as a whole. That is nothing but a multilateral instrument. If India signs to that multilateral instrument, now India agrees to the required changes given by OECD in all the DTAAs with which India want to change. For example, out of 140, India wants 90 DTAAs to be changed according to us. 90 DTAAs. Why, sir, 90? We don't want to change with Pakistan. We don't want to change with Pakistan. We don't want to change with North Korea. We don't want to change with United States. We don't want to change. It is possible we don't want to change. It is possible. If it is possible that we don't want to change, then we selected just 90. And out of 90 also, we can select some of the DTAAs, some of the adjustments. See, for example, OECD recommended 14 action plans. And out of that action plans, some are already there in India. Like CFC regulation, we already have na POEM concept. For passive income, we have POEM concept. So we don't want every changes. We just want only some changes. So Nimotai went and signed for 90 DTAAs and some changes in every DTAA. She made a checkbox, she made a tick box, and she signed. She signed, okay? She signed like this. Of course, I am signing, but Nimotai would sign in her way. Which means we agree to 90 DTAAs. We agree to 90 DTAAs. Okay? We agree to following changes in 90 DTAAs. Do you think that all 90 countries would agree? Do you think that all 90 countries would agree to us? Do you think that if we agree to 90, all 90 would agree from them? I mean, with us? Do you think there are many countries who are jealous of us, will never agree to us? So I am assuming we agreed for 90, and out of that, from front, 70 also agreed. 70 also agreed with us, and this is called covered tax arrangement. If we agreed for 90 and 70 agreed for us, that is called covered tax arrangement. Now, as soon as we agreed for 90 and 70 agreed for us, 70 would be considered as covered tax arrangement. Do you think that it will be enforced as soon as signing? Right answer is no, it will not be enforced as soon as we sign it. Once Nimotai signs now, once Nimotai sign that MLI instrument, for example, India agreed for 90 countries, which includes Singapore. India signed for 90, Singapore also agreed. Okay, both of us signed. Just that we sign it, it does not mean that MLI is enforced. MLI is not enforced. MLI is not applicable. These changes are not applicable. Nimotai has to come back to India. She has to get it ratified in parliament. Similarly, Singaporean Prime Minister also, Finance Minister also had to ratify in their parliament. After ratification, they have to go back. They have to go back to OECD office, Paris, and submit this ratification instrument. Similarly, Singapore also has to sign it, ratify it, and then submit it to OECD. For example, let me tell you some arbitrary numbers. For example, on 1st April 2022, Nimotai signed it. This is not the actual date. She signed it, ratified it, and submitted it. Sign must have been done earlier. She submitted on this date. And on Singapore submitted on 1st October 2020. 2. Singapore submitted the ratified instruments. ठीक है? This is how MLI would go. First of all, she would sign there, she would come and get it ratified, and then she will submit this back to the OECD. As soon as India signed it, now OECD will take 3 months. Whatever the first date comes after 3 months, after 3 months. What is the first date that comes after 3 months? The 3 months is nothing but 1st July. First date that comes after 3 months is 1st August. 1st August will be the date. First date that comes after first date, first of the next month that will come after that will come after 3 months is 1st August. This is the date of and this is the date of entry in force. As soon as we submit the MLI, now we submitted the ratified instruments within 3 months. After 3 months, whatever the next first comes on that day, it will be considered as entry in force. Similarly, for Singapore, can you all tell me entry in force? So 3 months. December 3 months. It will be first Feb. It will be first Feb. So 1st March 2023 will be entry in force. Sir, whatever the date we both have entered, whatever the date we both have entered, latter of two shall be taken. That means 1st March 2023 shall be taken. After 1st March, now, whatever 1st Jan comes, 1st Jan 2024, this will be effective date of MLI. This will be effective date of MLI, and that's all what you need to understand. That's it. First of all, Nimotai would go and sign. She would come back, ratify it, and again go back and submit this ratified instrument. As soon as this ratified instrument is submitted, OECD will take 3 months to process, and after 3 months, whatever the first month comes, first date of that month would become entry in force of India. Similarly for other countries as well. As soon as other countries submit, when both of them submit now, after that, whatever the 1st Jan comes, that becomes the effective date for MLI. That's all you need to understand, and that completes your base erosion profit shifting as well. There should be some clauses. See, if India accepts to all the 15 adjustments, 15 action plans, but Singapore wants to do or adjust for 4 action plans only, so there has to be reservation clause so that if Singapore doesn't want to follow all, there has to be a reservation as well. Whoever is the signatory to MLI is going to do 2 action plans in their local tax laws. Sir, benefiting or motivating them to register intellectual property right in their respective country, they should change their tax laws uh, to motivate people register intellectual property right in their country. This is the first tax law that everybody will change. Second thing, CBC reporting will be changed by everybody. CBC reporting will be required by everybody. These are two basic minimum standards everybody has to follow. This is the entire base erosion profit shifting. I hope I made this point very, very clear. Let's try solving question answers of BEPS. What do you mean by? Achha, this is treaties. Huh? This is treaties. MLIS cover tax arrangement. This is the same question. You can refer Super 100 as well. This is the same question that I have told you about MLI. This is the same question mentioned. What do you understand by BEPS and profit shifting? The base erosion profit shifting is nothing but transferring of profit from high tax paying countries to low tax paying countries by exploiting the gaps and mismatches. What are the consequences? Low tax revenue, underfunding, and integrity is hurt, and local competition is higher. OECD action plan number 1. OECD recommended 3 things: virtual fixed place of PE, virtual fixed place of business. That means make server as well as server as PE. Second thing, change the definition of the PE, make dematerialized presence as PE. Along with that, introduce withholding taxes. India did equalization levy and significant economic presence. Action plan number 4, your country will have more debt because you have higher tax. So India did 94B. 3-tier structure, master file, local file, and country by country reporting. Action plan number 5, your intellectual property right would be developed in India, but it will be registered in the country where there are lower tax rates. After that, this is the hybrid mismatch. How hybrid mismatch arrangement is being done? Taking deduction twice or the single borrower, or what will happen? Generation of deduction without considering the income, misuse of foreign tax credit, and participation in exemption regime. These are the hybrid mismatch arrangement. This is the entire BEPS for you all. Oof, 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 oof. We have 3 more chapters left. double taxation avoidance agreement. But for that matter, I want some break. It is 4:21. Break till 4:30. 9-minute break. After break, we shall continue with DTAA. We shall proceed further with advanced ruling, and at last, tax treaties and latest development in international taxation. In just 1 hour or one and a half hour, we will be done with all the three chapters. See you guys after the break. Welcome back from break. Guys, are you back from break? Sir, we are back from break with more energy, more positivity, more excitement, and more dedication towards the topic. That is what I wanted. That is all what I wanted. Come on to next chapter that is double back from break. Come on to next chapter that is double taxation avoidance agreement. Okay? I was looking at my video to be honest now. When I was looking at my BEPS, I mean, I did not realize I was funny or creepy. I did not understand. Okay? Do share your experience. But I somehow have to craft some innovative manners to make you remember BEPS, to make you focus more on BEPS. I don't know how to do that, but these manners I devised to make it more interactive. Was it funny? Was it joyful? Was it enough to make you learn? Or was it creepy? Please message me out so that we can work upon further as well. Double taxation avoidance agreement. See, there are basically two kinds of double taxation happening across the globe. First of all, like I am a resident of India. Rahul is resident of India, but earning in United States. So United States is going to tax based on source-based taxation, but India is going to tax as per residence. So there is double taxation. Source is USA, US is going to tax. India is having residence, so India is going to tax. Both are going to tax. So there is double taxation happening. This is called jurisdictional double taxation. If source is other country and earning is other country, in that case, this is jurisdictional double taxation. There is a concept of economic double taxation as well. For example, I invested in the form of loan, and the other company treats it as equity. So while paying the dividend, it has already paid taxes, but for me it is interest, so it is again taxed in my hands. It is possible that because of nature of the transaction, it might be taxed. So for economic double taxation, we have to change the tax laws. That is nothing else we can do. But for jurisdictional double taxation, we can have double taxation avoidance agreement. To give the credit now, there are two manners as to prevent jurisdictional double taxation. There are two manners. First of all is either we can exempt that income as it is, or we might give a credit. Now, how credit is given, there are two manners. If there is double taxation avoidance agreement with that country, India allows credit based on section 90. Relief is given based on section 90. But if India does not have any DTAA with that country, India gives relief as per section 91. Both the topics we shall discuss. First of all, I am assuming there is a person called Saurav, and he has income from North Korea as well. He has income from India as well. I'm giving you time to. I'm giving just give me a second. I mean, let me rub the irrelevant figures. Okay, just a second. Let me rub the important unnecessary data. Let's do it. Okay. If you want to have a photograph of it, just take a screenshot right now, so that whenever you want to refer it later on, you have sufficient information. Okay, this is the data. You can pause and take a screenshot now. There is a person called Saurabh. We are solving question as if there is no DTAA. Listen, now this I will tell you multiple things. What all action plans to be remembered? Nice point. Nice point. Let's discuss what all action plans to be remembered. Adverse effect of BEPS. Action plan number 1. In action plan number 2, only the reason why there can be hybrid mismatch arrangement. Action plan number 3, you can cut down. Action plan number 4 is important. Action plan number 5 is important. 6 you can skip out. 7 you can skip out. 8, 9, 10 you can skip out. 11 is important. 12 you can skip out. 13 can be read. 14 you can skip out. 15 only the portions that I have said that you can remember. See, this is a 4-page chapter only, half an hour video. If you just listen the video and go in exam, I think that would be sufficient for you to appear. If there is no DTAA, how relief would be given if there is no double taxation avoidance agreement? That is what I am telling. If there is no double taxation avoidance agreement, how process will go? Assume Saurabh is a person who earns in India as well and who earns in North Korea as well. He has business income in India. He has interest income in India. He has dividend income in India, and he has salary income in India as well. He has income in four countries. Oh, sorry, four forms. He has house property income in North Korea, 4 lakh rupees. Sorry. He has royalty from books. He has business loss, which is not allowed in that country. He has agriculture income, which is exempt in that country. He has short-term capital gain on gold of 5 lakh rupees. He has interest of 4 lakh rupees in that country. How will relief be given in India if you have been given this question? Always understand, follow 5 steps, and examiner will give you full marks. 5 steps. First step is calculation of the total income. Under section 91, 5 steps are to be followed. Computation of total income, and that's you have to solve. That you have to do in every question. 5 steps. First step is computation of total income as per Indian tax laws. As per Indian tax laws, how much would be the income? Sir, as per Indian tax laws, business income would remain business income only. It will be taxed as it is. Interest income in India will be as it is. Dividend income in India will be as it is. And salary income would be as it is. Sir, it is computed. Therefore, we will not give any standard deduction as well. So, we have to find out the total income as per Indian tax laws. House property income of 4 lakh rupees in North Korea, when it would be considered in India, we are going to charge 30% standard deduction. So 2.8 lakh would be charged to taxes in India. 2.8 lakh would be charged to taxes in India. So 30% standard deduction we would get. Royalty on books, whatever royalty is being earned in North Korea, India would charge 5 lakh rupees, but India would give a deduction of 80 QQB. India would give deduction of 80 QQB. Sir, what all deductions are given? I will tell you. Don't worry. I will tell you what all deductions are given in deductions chapter. In this DTAA chapter, believe me, I will tell you. Wait for some time. Royalty would be taxed in India and 80 QQB would be given in India. Business loss. Sir, if it is not allowed in that country, we don't care. We allow in India. In India, business loss is allowed. We give deduction of business loss irrespective of loss allowed in that country or not. Agriculture income. If it is exempt in that country, we don't care. In India, we are going to tax it. Agriculture income will be taxed because that country laws are irrelevant for determining the total income. That country laws are irrelevant. Only we need to find out our income. Short-term capital gain on gold. At that country, we have 5 lakh of short-term capital gain on gold. In India, we have 5 lakh rupees. Same as it is taxable. Interest income 4 lakh there, 4 lakh will be taxed here. So can I simply say whatever I have highlighted will give us the total income? 15 lakh plus all 19, 19, 21, 25, 30, 32.8, 34.8, 39.8, 40, 39.8. Yes, after 0. 39.8 lakh will be total income. This will be total income. So total income is to be calculated as per domestic tax laws only. Total income will be calculated as per domestic tax laws only. Done. Sir, done. Step number 1, calculate total income as per domestic tax laws. How much will be total income? So 39.8 lakh. Step number 2 that you have to follow is taxes in India. Indian tax laws will be calculated as per Indian tax laws only. Sir, it is possible question says old regime, follow old regime. If question says new tax regime, follow new tax regime. If question involves some capital gain taxes, apply capital gain taxes. If question involves partial integration, apply partial integration and find out the final tax liability. This will give you the final tax liability. Step number 2. Sir, can we do the shortcut? 39.8 lakh minus 10 lakh into 13,000, 30% plus 1 lakh 12,500 into 1.04. Can we do this shortcut, sir? We can do. Examiner does the same thing. If it is new tax regime minus 24 lakh into 30% plus 3 lakhs, you can do. Same thing you can do. Examiner also does the same. So Indian tax laws are clear. Step number 3 is absolutely clear. Step number 3 is absolutely clear. No questions attached. Nothing, no doubt whatsoever. Step number 3 is absolutely clear. Step number 2, add taxes in India is clear. Step number 3, 4, and 5 will give you relief. Step number 3 will ask average rate of tax in India. What is the average rate of tax in India? In India, if we check, total taxes are 10 lakh 46,000 and total income is 39 lakhs. So average of tax in India is 26.3 lakh rupees. This is the average rate of tax in India. Step number 3. Step number 4. Sir, foreign tax rate. Foreign tax rate. It is possible that we might have income in. It is possible. We will be having income in foreign country only. We need a single consolidated average rate of tax in foreign country as well. If it is directly given, then well and good. If it is not given, we might have to calculate it as well. Here it is directly given to us 21%, but it is possible that we might have to calculate. How do we calculate? Sir, we shall find out the total income of that country. We shall find out the taxes of that country. Multiplying 100 will give us the foreign tax rate, average foreign tax rate. One or twice they have also asked this as well. Sometimes they give slab rate in that country. We shall find out single average foreign tax rate in that country. Single average foreign tax rate in that country. This is going to this is going to help us out in foreign tax rate. Here we are given with step number 4 clear. Anybody having any doubt? Step number 1 total income, step number 2 taxes, step number 3 average of tax, step number 4 foreign tax rate, step number 5 you have to follow is doubly taxed income. You have to find out the doubly taxed income. Sir, what is doubly taxed income? Sir, how much income is taxed, how much income is suffering the double taxation? Let me make you understand how do we calculate doubly taxed income. Try understanding. Huh? House property tax in North Korea is 4 lakh rupees. There is no municipal taxes deduction at all in that country. In that country, 4 lakh is tax. But when this income comes to India, India only charges 2.8 lakh rupees because of deduction. So on what income we are having double taxation? On what income we are having double taxation? So double taxation is only happening on this 2.8 lakh rupees. So I'm highlighting this. For a second, I am removing the highlights one. So double taxation is only happening on this 2.8 lakh only. Na? Consider this books. Consider this books. Consider books. Sir, 5 lakh is the royalty on books in that country. Exact 5 lakh are being taxed. But when it comes to India, India specifically gives deduction on this interest. India specifically gives interest on this deduction. Sir, in this case, 2 lakh is only taxed because India gives QQB deduction on this. Business loss, wait for a second, I will tell you. Business loss, wait for a second. Agriculture income, sir, it is not taxed in that country. But when it is taxed in India, it is taxed at 2 lakh rupees. Just tell me, is there any double taxation happening? Not taxed in that country, taxes taxed in India. So is there any double taxation happening? Right answer is there is no double taxation happening. Double taxation not even happening here. Double taxation is not even happening. So if double taxation is not happening, there will be no doubly tax income. No doubly tax income. Short-term capital gain gold, the way it is taxed there, the same way it will be taxed here, 5 lakh only. Interest income, the way it is taxed there, the way it will be taxed here. So whatever that I have highlighted, that we will add. But sir, always remember, business loss in that foreign country always minus. While calculating doubly tax income, always minus. Write it down somewhere and take this paper in with you in exam. Write it down this in a paper and take this paper with you in exam. Business loss is always reduced while calculating doubly tax income. Business loss is always reduced while calculating doubly tax income. Business loss is always reduced while calculating doubly tax income. Always, always reduce. There is a reason why I am saying this. Write it down in a piece of paper and take it with you in exam hall. Do not forget, business loss is always reduced. 2.8 plus 2 minus 1 plus 5 plus 4. So 12.8 lakh. Doubly tax income turns out to be 12.8. Oh my God, sir, 12.8 lakh doubly tax income. Always reduce. Loss from foreign companies always reduce while calculating doubly tax income. Seems fair. You shall take average rate of tax or foreign tax rate, whichever is lower. Whichever is lower is 21%. Multiply it with W tax income. You will arrive at 2,68,800. This is the amount of relief that you will get. This is the amount of relief you will get as per section 90. Pen down. Section number 90 is done. This is up to this much only. This is this much only. Every question is solved with this. Okay? Every question can be solved with this. What did I say? Step number 1, total income as per Indian tax laws. Step number 2, taxes as per Indian tax laws. Step number 3, average rate of tax. Step number 4, foreign tax rate. We need a consolidated tax rate. And step number 5 is doubly tax income. Income that is taxed in both the countries. During this doubly tax income, you might have business loss in other countries. Always reduce that. While calculating doubly tax income, always business loss is reduced. Seems fair, sir. Now, what happens when we calculate relief under section 90? What changes do we have to make? See, step number 1 and 2 shall remain same, because for calculating relief, we need to have taxes. Unless we don't have taxes in India, from where we will reduce the relief. So relief for tax, step number 2 shall remain same. Step number 3 shall also remain same. But here we consider two things. Taxes paid in that country versus taxes paid on such income in our country. This is we shall take. What did I say? Action plan now. Oh, sorry, action plan I'm saying. Under section 91, doubly tax income into foreign tax rate or average of tax, whichever is lower. Doubly tax income into average of tax or foreign tax rate, whichever is lower, we take. But here what we take, here we take taxes paid in that country versus taxes paid in our country. How much are the taxes paid in that country and how much are the taxes paid in our country, we shall take. Taxes paid in our country is 12.8 lakh income we are considering, and 23.6% is the average rate. So we shall take this much. This is the amount of taxes that are being applicable in our country. Our country is charging taxes only on this much amount. Our country is charging taxes only on this much amount. So doubly tax income into average rate of tax. Our country is charging taxes on this much amount only. But how much taxes are being paid in that country, we have to calculate. So whenever there is section 90, now we shall take taxes paid in that country versus taxes paid in our country. How much taxes we are paying in that country, try understanding. I'm again removing the highlight portion. Here we have to calculate how much taxes we are paying in that country. We have to find out. Sir, in that country, house property is taxed as it is 4 lakh. Royalty income is taxed as it is 5 lakh. Business loss is not allowed, so we will not reduce this. Agriculture income is exempt, so we shall not take it. Short-term capital gain on gold is 5 lakh rupees. Interest is 4 lakh rupees. So if you take 18 lakh is the total income, and there 21% is the tax liability. So 378,000. This is the average rate of tax. This is the average rate of tax applicable. This is the average taxes paid. 3 lakh the 78,000 is the taxes paid in that country. 378 taxes paid in that country. 336, 640 lower of 2. This shall be allowed under section 90. This is the amount of relief that we will get under section 90. I hope you understood the difference between section 90 and 91. If I clearly tell, section 91 says doubly tax income into average rate or foreign tax rate, whichever is lower. That means doubly tax income into average rate of tax, whichever is lower, or doubly tax income into foreign tax rate, whichever is lower. Whereas section 90 says taxes paid in such country or taxes paid in India versus taxes paid in that country, whichever is lower, we take that. This is the difference between two reliefs. Now, during this entire process, 2 or 3 things, special things you need to consider. First special thing that you have to consider is, under old regime and new regime, you are given some deductions. What are the deductions that you might see? 80C is the first deduction. See, if you are given with an individual, he might invest in LIC, he might invest in public provident fund, housing loan, principal repayment, or he might pay some SDV charges, stamp duty value charges he might pay. For self or children, so up to 1.5 lakh, he will get a deduction under 80C. For parents, government does not promote any type of life insurance on parents. Okay? Government promotes health insurance on parents, not life insurance. Okay? If somebody is already 60, 70, so government doesn't promote life insurance. Government promotes health insurance. Okay? So for self and children, these things 1.5 lakh can be seen in 80C, 80D. If you buy health insurance for yourself, so 25,000, but if you are a senior citizen plus resident, then 50,000. For parents, 25,000, but if parents are senior citizen plus resident, then 50,000 rupees. Seems fair. 80CCD too important. Whenever employers contribute to pension fund of the employees, employer contribute to pension fund of the employee. Then this is added to income first, and then we get deduction of 80CCD. How much? 14% of the salary, and under old regime 10% of the salary. This is how much deduction we get. What else deduction are we going to see in the DTAA chapters? ATTTA, savings interest, 10,000 or interest are paid, whichever is lower. ATTTB, senior citizen, FD, RD, savings account, whichever is, interest is interest or 50,000, whichever is lower. This is the amount of deduction you will get for senior citizen. ATQQB, if you receive royalty from books of scientific nature, literary nature, or artistic nature, you will get deduction. Royalty received or 3 lakh, whichever is lower, you will get deduction. In this entire process, sir, 80 is also allowed. New employees, on that new employee cost, 30% you will get. Remember, any employee which is paid 25 more than 25,000, no deduction on that. Any employee who doesn't participate in RPF, no deduction. Any employees who has worked for less than 240s or 150 days, no deduction. Any employees whose salary paid in cash, no deduction. Out of these, 80 CCD2 and 80 GAA is available in new plus old. Rest all deductions are available only in old tax regime. That is what deduction is all about. Comparing about foreign currency conversion rules. Understand this point very carefully. See, if we are earning outside, is it necessary that we will be earning in rupees only? Is it necessary? Right answer is no. It is possible that we might earn in dollar. We might earn in any other currency as well. It is possible. So how do we convert that? Lawmaker says that you shall convert business income, house property income, or IFOS income. Business income, house property income, IFOS income with the year-end exchange rate. With the year-end exchange rate. Business, house property, IFOS. IFOS like agriculture, like casual income, whatever incomes you have now, you will take the year-end exchange rate. Year-end exchange rate. That is 31st March 2026 exchange rate you are going to use. But if you have any salary, if you have any interest and dividend, which interest and dividends are interest and dividend on securities? Rest every interest shall be converted with year-end rate, but interest and dividend on securities shall be converted with the given rate. Salary, interest, dividend on securities, capital gain, taxes paid. These all 5 or 6 things shall be considered in the month of accrual. You shall take month of accrual, month of payment, take the preceding month, and take the last date of the preceding month. That is the conversion rate you are going to use. What did I say? Try understanding. Take a try understanding. Business income, house property, IFOS, year-end rate. Any kind of interest dividend on securities, do not take year-end rate. Interest dividend on securities, salaries, capital gain, taxes paid, you shall take the month of accrual or month of receipt, take the preceding month and take the last date of the preceding month. That shall be the conversion rate. With that, you shall be taking off. With that, you shall be converting. Last date of the preceding month of the accrual and payment. Perfect, sir. Perfect. These are the conversion rules that you have to follow. These are the entire conversion rules you have to follow. That completes our DTAA. I don't think there is much to discuss in this. More and more questions. I have the Bula series uploaded. If you want to solve question answers, try solving questions that will improve your understanding over DTAA. After DTAA, see, we are left with 3 small chapters. Just give me 45 minutes and we'll be done with it. Okay? Advanced ruling. Very easy chapter and important from examination viewpoint. Always, very carefully listen. See, if you have any doubt in applying income tax, you can request to Board of Advanced Ruling and seek judgment in advance. If you have any doubt in applying income tax, you can go to Advanced Ruling and seek judgment in advance. Okay? Advanced Ruling means taking judgment in advance. If you want any judgment in advance, you can go to Board of Advanced Ruling for already undertaken transaction or proposed to be undertaken transaction. For the question related to question of fact or question of law, anything can be there. What is the constitution of board? Lawmaker says that at least 2 CCIT will be there. And appeal will be again to only High Court, not at even ITAT. If you are aggrieved by the order of the advanced ruling, you can only go to High Court. How much is the time limit? The time limit is 60 days. See, ideally for any appeal, you can go to High Court within 120 days. But for advanced ruling, you have to go within 60 days. For advanced ruling, you have to go within 60 days. You cannot even go to ITAT as well. Application of advanced ruling, sir, who shall apply and when he can apply? Done, Kishore. Who can go for advance ruling? Understand. If non-resident has already undertaken transaction or is proposed to undertake any transaction, he shall file advance. He shall file an application to advance ruling. If non-resident is there, okay, non-resident. Is there any transaction limit for non-resident? So no transaction limit for non-resident. Second thing, if a resident person wants to apply transfer so advance ruling, wants to know advance ruling on behalf of non-resident. A resident wants to go on behalf of non-resident. Can he go for advance ruling? Right answer is yes, he can go. Resident on behalf of non-resident can go without any limit. Third thing, sir, resident for his own tax liability, can he go to advance ruling? Sir, he can go. He can go to advance ruling for his own tax liability. But what are the things to be considered here? Sir, if resident wants to go for himself, then transaction amount should be more than or equal to 100 crore, below which he cannot go. Below which he cannot go. Seems fair. Seems fair. If any public sector undertaking wants to go for advance ruling, can it go? Sir, definitely it can go. Definitely a public sector company can go for advance ruling. It can go, definitely, for sure it can go. Sir, for any amount it can go. Even if matter is pending before ITAT also, na, public sector undertaking can go. Any person who thinks that transaction entered by him might be called impermissible later on, he can go to advance ruling and seek the judgment. So 5 people I told. First of all is non-resident for any transaction, resident on behalf of non-resident. Third thing, resident who undertakes transaction greater than or equal to 100 crore. Then any PSU or any person who wants to know that whether his transaction would become impermissible or not. These 5 people can go to advance ruling. Whenever they want to file the application, they will file the application. They can withdraw at any point of time. But remember, withdrawal has to be made within 30 days, not beyond that. Sir, what is the fees required to be paid to advance ruling? See, if there is any public sector undertaking and against which you want to go to advance ruling, sorry, public sector undertaking wants to go to advance ruling, now 10,000 fees has to be paid. If somebody who wants to know that whether transaction would become impermissible or not, just want to know whether transaction would become impermissible or not, he can go to advance ruling for 10,000 with 10,000 fees. But if any other person like resident, like non-resident, like resident or like a resident on behalf of non-resident wants to go now, in that case, if transaction is up to 100 crore, then 2 lakh. If transaction is 100 to 300 crore, then 5 lakh. If transaction is more than 300 crore, then 10 lakh rupees. How much fees? 2 into 5 is equal to 10. This is how you can remember. 2 lakh, 5 lakh and 10 lakh. This is the amount of fees that is required to be paid for advance ruling. Application should be digitally signed. This application should be absolutely digitally signed and communicated via email address. Sir, whenever you go to advanced ruling, how judgment is given to you? Listen, whenever assessee goes to advanced ruling, okay, whenever assessee goes to advanced ruling, how the process takes place, understand. Board shall refer the case to jurisdictional CIT. Jurisdictional CIT, and CIT will determine whether case is pending to assessment, pending or not, whether case is pending or not, and also call for information. Board will pronounce its judgment within 6 months from the date of application, and copy will be shared to CIT PCIT. Okay? Board will see the case and pass the order. Now, understand this thing. If there is any assessee whose assessment is going on, can he go to advanced ruling? Right answer is yes. If his case is going against at CIT appeals or Joint Commission appeals, can he go to CIT? Can he go? No, sir, he cannot go. If his case is already pending at ITAT, can he go to advanced ruling? Sir, no. If his case is pending at High Court, Supreme Court, can he go to? No, sir, he cannot go to advanced ruling. If his case is pending at revision 263 or 264, can he go to advanced ruling? Sir, he cannot go. Sir, what if he goes? What if he goes? His case is already pending. Or what if he goes? In that case, sir, application would be rejected. Application would be absolutely rejected. But what if this is an public sector undertaking? Can this public sector undertaking go during assessment? Yes, sir. Can this PSU go during CIT appeals? Yes, sir. Can this go towards ITT as well? If case is already pending at ITT, can public sector undertaking go for advanced ruling? Yes, sir. But if case is pending at High Court, Supreme Court, na, then PSU will not go. If case is pending for revision purposes, na, then only PSU can go. Then also PSU can go. So if case is pending at High Court, Supreme Court, na, then PSU cannot go. Otherwise, PSU can go any point of time. Other people can go only if assessment is pending at any point of time. Any other case is pending, na, then other people cannot go to advanced ruling. Simple thing, as simple as it can be. What if PSU goes to advanced ruling when question is pending at High Court, Supreme Court? There will be rejection of application. What if normal SSC goes if case is pending? Sir, rejection of application. What if somebody goes for advanced ruling for determination of FMV of an asset? See, for FMV determination, there is valuation officer. Why would we go to advanced ruling? They will reject our application. Sir, if PSU, if public sector undertaking goes to advanced ruling, during this process, PSU goes to advanced ruling. PSU goes to board of advanced ruling. In that case, what will happen? PSU goes to board of advanced ruling. In that case, what happens? Sir, if PSU goes to advanced ruling during this process, sir, these people will stop working unless judgment is passed. These people will stop working unless judgment is passed. Application is made by PSU, then IT authority will not proceed further unless board pronounces its judgment. At last, at any point of time when board thinks that this transaction is meant for avoidance of tax, this transaction is meant for tax avoidance, now board will reject the ruling. Board will not give the ruling. Board will take off the ruling. Will not give the ruling at all. Sir, but if somebody has asked that whether my transaction would be impermissible or not, in that case, ruling would be given that transaction is impermissible or not. But otherwise, if actually transaction results in impermissible avoidance agreement, board will not give any type of tax liability determination. It will not give any judgment. This is when advanced ruling will give you the judgment. Sir, advanced ruling given by the board will be void. Ruling means judgment. Judgment would be given. Judgment given would be void if you have done fraud or misrepresentation to get the ruling. If you have done any fraud or misrepresentation, your ruling would be void ab initio, void from the first date. And provisions of this chapter would apply as if there has been no ruling ever been given. Powers of Board of Advanced Ruling. See, what powers do Board of Advanced Ruling have? First of all, discovery and inspection. If you have any asset, board can get that discovered and inspected. If you have books of accounts can be compelled for production. They can ask books of accounts. Enforcing attendance of a person. If you have books of accounts, they can request. They can request you to come at a certain place, and you have to respond. Issuing summons means they can issue questionnaire. These are the same powers that IT authority had. IT authority general powers, whatever they had now, these are the same powers that we are discussing. Same powers we are discussing. These are the same powers with civil court as well. These are the same powers with CAT as well. These are the same powers with SAT as well. Every appellate authority has these type of powers. Sir, what if you are not satisfied with the order of the board? Then you have to go to High Court within 60 days, and 30 days additional time limit is given to you. Sir, as an Indian, we have a habit of asking something extra. Whenever we go to eat pani puri, to eat golgappa, to eat water balls, we seek for extra puri. Or if we go for buying vegetables, we seek extra coriander. We always seek extra. So, for example, if we went to advanced ruling to seek a judgment, and all of a sudden I felt, I 10 lakh rupees given and just a tax liability. I want to know something more. So I requested later on to give the judgment on TDS as well. Do you think that advanced ruling will give the judgment? Right answer is absolutely no. Advanced ruling will not give the judgment. Once the application is put forward, board will not give any extra ruling. Okay? Only the question that was mentioned in original application will be considered. Now, during the process, if advanced ruling thinks that additional evidences are required, it may ask the SSC, and SSC has to submit that. Now, there are 2 pointers I want to discuss. First thing here is, sometimes what happens, this is Rahul. Rahul wants to enter into transactions with Rachel. and want to know advance ruling as to how much will be the tax liability. But Rahul's brother Mehul has already entered into similar transaction with Jill, and has already obtained advance ruling. The fact is, have similar ruling. Can I use that advance ruling as it is in my case as well? Can I use that at similar advance ruling in my case as well? Right answer is no, you cannot use it. You have to go to board, you have to request board, and then board will allow. If allows, then you will be allowed to use, otherwise you will not be allowed to use. If board permits, then only you will be allowed to use, otherwise you will not be allowed to use. Believe me, you will not be allowed to use. Sir, gotcha? Gotcha? Sir, gotcha? In this process, if board wants to have extra information, they can always ask. Anyway, they can ask. Another second point, what I mean to say, for example, this is non-resident who enters into transaction with multiple residents. Somehow, SSC went to AO to know the tax liability of non-resident. It is possible that SSC went to AO to know the tax liability of non-resident. And simultaneously, non-resident also went to Board of Advanced Ruling for judgment. Advanced ruling now rejected the application of the non-resident, citing that case is already pending with AO. Whether advanced ruling is justified, right answer is yes, advanced ruling is justified because case is already pending at AO. So AO will give the judgment, board will not interfere in this case. That completes our advanced ruling as well. Application of and interpretation of tax treaties. Oof. Listen very carefully. Last two chapters, application of tax treaties, and at last we are left with latest development. That will take 5 minutes. This will take 20 minutes. Just wait for it, and we will be done. Energy, last time. Okay, last line for the today. Energy, some energy, sir. We have energy. We have a lot of energy. Application and interpretation of tax treaties. What does this mean? See, whenever there is a double taxation avoidance agreement, how do we read that? How do we interpret that? This chapter tells that. Okay. First of all, what are the sources of international tax laws? Always understand how can two countries have a tax, how can two countries have a law? There can be double taxation avoidance agreement for tax laws. How can two countries have tax laws? Now they can have double taxation avoidance agreement, first thing. Second thing, there can be some general international customary practices that has been happening since 2000 years, 3000 years. There can be some international customs. Third thing, there is a VCLT, there is a convention which is for treaties, a law for treaties, how treaty would be designed, how treaty would be made. There is a law, entire law for the treaty, that is Vienna Convention law of treaty. Vienna Convention law of treaty. So there are three sources of international tax laws. Sir, what is treaty? Cut down. What are the types of DTAA? What are the types of DTAA? Sir, OECD model, UN model. Yay! Examiner would, if examiner could come out of the screen or out of the answer sheet and can slap you, would slap you if you write this answer. Okay. Types of double taxation avoidance are limited DTAA and comprehensive DTAA. What we had studied in Model Tax Convention was models of DTAA. Models of DTAA. Okay? Limited DTAA, comprehensive DTAA. Limited DTAA, which covers only certain aspects. Comprehensive DTAA that covers all the aspects. Okay? Limited and comprehensive. Limited covers some aspects. Comprehensive covers all the aspects. India, Pakistan is limited. India, Australia is comprehensive. Now, need for treaty. What is the need for treaty? See, basically there are 7 needs of treaties. This is important question and try understanding this. See, if there is India and France treaty, what is the advantage of this treaty? See, you need to understand now. Who charges tax is being told by treaty. So allocation of taxing rights. Actually, who is going to charge taxes? This is the first purpose of treaty. Allocation of taxing rights and elimination of double taxation. So first benefit of treaty is who is going to charge taxes. And second thing, elimination of double taxation happening. That is the purpose of the treaty. Second thing, resident and non-resident discrimination is avoided. India does benefit, a lot of non-resident. If you see, in morning only we understood tax rates. Most of the tax rates were for resident and non-resident were similar only. And even in income tax, we had beneficial tax rate only for non-resident. So resident, non-resident is benefited by tax by this treaty. Dispute resolutions. India has dispute with France, can be resolved by mutual agreement procedure. Assistance in collection of tax. Equity and fairness, same tax rate for different kind of taxpayers. Neutrality, sir, capital import neutrality, export neutrality. What does that mean? For example, India wants to export any country, then our export decisions are not dependent upon tax rates. Or if we are importing from some country, our import decisions are not dependent upon tax rates. And at last, promotion of economic trade, welfare, and investments. There are 7 advantages. I want you all to run 4 only. 3 to 4 mark question it will be asked, not more than that. 4 at least you need to learn. First of all, allocation of taxing rights and elimination of double taxation. Same tax rates for all the class of taxpayers. Non-discrimination between resident and non-resident. Collection of taxes. Then we have dispute resolution, capital import export neutrality, and promotion of economic trade, investment, whatever it is. Economic relation, trade, and investment. Okay. Now, interpretation of treaties. Now, how do we interpret treaty? Whenever you read income tax, how do we interpret income tax? There is a view of interpreting. I will tell you what. Whenever you read now, there is a golden rule and there is a liberal construction. What does that mean? See, whenever you read income tax now, first way of reading is the golden rule, objective interpretation or literal interpretation. All these 3 things mean the same. It is whatever is written, read that. We take the literal meaning of every word. First interpretation is literal meaning only. If something is meant, mean that. And that is the basis of entire taxation. Whatever is written, we assume that. Literal interpretation shall be taken. Literal interpretation. Sir, but what is liberal meaning? Sometimes meaning would not make much sense. Therefore, we have to go for liberal sense as well. We have to go liberal sense as well. Sometimes what happens is now instead of or and is mentioned, or instead of and or is mentioned. But interpretation turns out to be different. So to take out the common meaning, to take out the better meaning, we have to read out the or as and as or. We have to interchangeably meaning. We have to find out the interchangeable meaning. That means we have to do the liberal interpretation in this sense. So literal interpretation or liberal interpretation, these are 2 ways. Second thing is subjective interpretation, and the other one is contemporaneous expositor. Contemporaneous expositor. What these 2 means? Let me change the color. Subjective interpretation and contemporaneous expositor. What does these 2 mean? Subjective interpretation means try to find out the reason for a treatment in a treaty at the time it was signed. For example, India-France treaty was signed in 1950s, example, where most of the taxing rights were given to India because India was a poor country at that time. So if you read treaty today, you will see that there are many benefits given to India, but you are not understanding the reasons because at the time it was signed, India was a poor country, even though it is Vishwaguru right now. But basis came at that point of time where India was poor. So that is why we need to have the interpretation dependent upon the time when treaty was signed. At that time, what geopolitics were going on, we need to understand that. Got it? Contemporaneous exposito. Sometimes what happens is whenever you interpret a treaties, there are certain terms that are given in the treaty which are not relevant today, but which were relevant at that point of time. See, I don't know what you understand, but there is a call 25 paisa. There is a concept of 25 paisa. For example, if in treaty it is written that royalty will be taxed at 25 paisa. 25 paisa. 25 paisa is nothing but 25, 1/4 of a rupee. 1/4 of a rupee, it means 25 paisa. It is mentioned in treaty. Now, 25 paisa, as of now, you might understand as 0.25%. But back then, it was interpreted as 25%. 25 paisa meant 25% at that time, at that point of time. So, contemporaneous exposito says that when treaty was concluded, you can take the meaning of the words at the time of conclusion. Okay? Then we have 2 meanings, that is purposive interpretation. You should read treaty to find out the object of the treaty. Whatever the objects of the treaty are, double taxation avoidance, double non-taxation avoidance, whatever the objects of the treaty, are, that should be fulfilled. Second thing, principle and effectiveness. Whenever you read treaty, it should not become void. So objects fulfilled is purposive, It should be effective. It should not be void. That is effectiveness. Then treaty should be read as a whole and reasonably. These are the interpretation manners of reading a treaty. Okay, out of this, which are important? So golden rule is important, purposive interpretation is important, and contemporaneous exposito is important. Three are important now. Extrinsic aids to read a treaty. Whenever you want to understand a treaty, there are some extrinsic aids to read a treaty. What are extrinsic aids? Understand. First of all, if you want to understand income tax only, you see the judgments, you see the Supreme Court judgment. Similarly, reading the treaty would help. Interpreting a treaty would be done with foreign courts judgment. This is easy way of doing it. Mutual agreement procedure. Any mutual agreement procedure done between the two countries would help understanding treaty. Preamble. See, preamble speaks a lot about treaty. If you see books cover page, books preface talk more about the depth of the book. So cover page, preface, this is the preamble. The opening line of the treaty would tell more about the treaty, so you can read that as well for interpretation purpose. International article, for example, if you are not able to understand some provisions of income tax, you immediately go to Tax Guru, you immediately go to CA Club India to understand more. So there are international articles as well which tell the interpretation of the treaty. Some other treaty, for example, if you are doubtful about India France treaty, so you checked out Germany Australia treaty to understand it better. That is also a way of understanding. If there has been subsequent agreements between the parties for understanding purpose, or if there has been subsequent conducts after the treaty conception, or if there has been some resolutions, if there has been committee reports, or if there has been protocol. What is protocol? See, protocol is nothing but the reference list, the postscript behind the scenes. Okay. After the treaty, some things are given for better understanding of the treaty, how things came behind the scenes. Like in Finance Act, and whenever Finance Act comes, there comes a memorandum of Finance Act which describes as to why changes were made. Similarly, for treaty as well, there are reasons why amendments came now. That amendments are also given in the protocols that should be read as a part of treaty to make a better understanding of the topic. Okay, this is protocol. It is supplementary annex to the treaty, which gives solutions to the pointers beyond the treaty. Preamble, it is a part of the treaty. I mean, it describes the treaty in brief. Then there is most favored nation clause. Let me brief this point out to you. For example, there is a group of 4 or 5 people: India, Russia, China, Brazil, and South Africa. And all of them called each other most favored nations. India became part of MFN on 1st April 2022. This is an arbitrary date. I am telling, this is not the actual date. India became part of most favored nation. Now, what is the most favored nation clause? See, there is an agreement between all of them that whenever anybody would pay interest to each other, interest would be taxed at the rate of 10%. Interest would be taxed at the rate of 10%. This is the implied agreement between all of them. Okay. Implied agreement between all of them. In this case, after 1st April 2023, India entered with USA on 1st April 2023, where India requested USA. Gave a benefit of USA of just a 6% to USA. India notified this in India. Then this is called a violation of MFN clause. What does that mean? What does that mean? What will happen? Understand. See, if any country is a part of most favored nation clause, after becoming part, if it enters into agreement with the third state means other than MFN, whereby it restricts its taxing right with the other state. Yes, from MFN you are charging 10%, but from other you are charging 6%. And you notified that rate in your country as well, then such reduced tax rate shall be given to other nations as well. What did I say? Again, what did I say? If you are a part of most favored nation clause, first step, you entered into agreement after becoming MFN with the third state. Second step. Third step, you restricted your taxing rights with the third state. And fourth step, you notified that in your country. In that case, whatever the taxing benefit you have given to that person, that taxing benefit would be given to the other people as well. And this is called most favored nation clause. Static approach and ambulatory approach. See, what is a static approach? What is ambulatory approach? Try understanding this. Whenever you take out the meaning of a treaty at the time it was signed, it is called static approach. You can also call it contemporaneous exposito. Ambulatory approach, trying out the meaning of the treaty as of now. at the time of interpreting. Which approach to be followed? Both to be followed. Bhai, one cannot be fixed. Both approach to be followed. Now we have VCLT, Vienna Convention Law of Treaty. First of all, is Fanta के साथ Mirinda. Whenever you drink Fanta, you should always drink Fanta with Mirinda. Fanta with Mirinda. Wah, 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 wah. Fanta with Mirinda. Fanta with Mirinda. Wow, sir. Fanta with Mirinda. Focus, 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 focus. It is not Fanta with Mirinda. Okay? It is Pacta Santa Servanda. Sir, the way you teach now, we will always understand the meaning, but maybe we might not remember in exam what you mean to tell. See, Fanta Santa Facta. Wait. Pacta Santa Servanda. Pacta Santa Servanda. Pacta Santa Servanda. What does that mean? You have to drink Fanta with Mirinda. Arey Baba, that is not what it means. Treaty is binding upon the parties and must be followed on good faith. See, if treaty is between India and France, na, people of India and people of France should read the treaty in good faith. They should not try to, they should not have a malified intention while reading the treaty. This is the first thing. Pacta Santa Servanda, that means treaty in good faith. Okay? Then, second thing, local law should not be observance of the treaty. What does that mean? See, while following a treaty, local law shall never be used an excuse for not following the treaty. What does that mean? For example, India and France treaty. India and France treaty says royalty will be taxed at 20%, but local law says 40%. So we denied to follow the treaty, citing the reason that local law says 40%, we have to follow the local laws. Remember, local laws cannot be used as an excuse for not following the treaty. What we are studying Vienna Convention Law of Treaty. This is a law made for treaties. If there are two treaties in two countries, if there is treaty between two countries, treaty will follow these steps. Treaty will have to follow these things. This is Vienna Convention Law of Treaty. Sir, done. Third thing, non-retroactivity of treaty. What does that mean? If you want to change anything in treaties, a treaty cannot be changed retrospectively, always prospectively. Territorial scope of treaty. Sir, treaty will apply to both the states unless otherwise prescribed. At last, general interpretation. Whenever you want to read treaty, sir, it should be read in good faith. Read with relevant rules. If required, read preamble as well. Read subsequent conducts, subsequent agreements, any instrument or any subsequent practices. These are to be read to make treaty more understanding. Supplementary means to treaty. See, whenever any meaning in a treaty leads to vagueness or any of the interpretation leaves the meaning ambiguous, now in that case, you have to read the supplementary meaning. You have to take the additional meaning. For example, royalty meaning is not properly mentioned in treaty. So you can take the supplementary word meaning from your local tax laws, from international articles, from other treaties you can take. Sir, treaty authenticated in two languages. For example, there is India-French treaty. It is written in English and French language. Okay? Later on, some people says, no, this treaty should be in Tamil also. This treaty should be in Malayalam also. This treaty should be in Telugu also. No, this treaty should be in Kannada also. People started arguing, this treaty should be in Marathi as well. People started saying that this treaty should be in other languages also. Lawmakers says allowed. It is absolutely allowed. Treaty can be authenticated in other languages as well, but you have to make sure that whatever the changes in the word that you are making shall correspond to the same words. That means meaning should not be unassigned, meaning should not be ambiguous. It should not be that English meaning is different and Kannada meaning is different, so that interpretation becomes difficult. So authentication is allowed, but with the same language if kept. General rule of third state. Whenever there is treaty between India and France, there is no obligation of the third state. Continuance and the validity. Treaty shall continue to be enforced till the time people want to be enforced. People want them to be enforced. At last, termination and suspension of treaty. What does this mean? Try understanding this. If there is treaty between India and France, this will be terminated if certain conditions are fulfilled. First of all is if there is material breach. For example, France hits a nuclear weapon in India, treaty will breach. If there is material breach of the contract now, if there is a war between the two, that treaty will breach. If there is supervening impossibility. For example, transaction is done in cryptocurrencies. Government has no access to deduct a no access to cryptocurrencies. Government cannot tax this transaction. Therefore, It is not even possible to apply treaty. Then treaty will try and will stand terminated. What did I say? First thing, material breach. Second thing, it is impossible to follow treaty. Third thing, there is fundamental changes in circumstances. For example, today India and Nepal has GTAA. Tomorrow, Nepal was annexed by China. Nepal is annexed by China. China invaded Nepal. Now there is no country named Nepal. So this is fundamental change in circumstances. Now, for example, India and France have DTAA. Tomorrow, Germany annexed France. In that case, there is no France. Treaty would terminate. At last, sir, emergence of new tax law. For example, India abolishes income tax and comes up with a new tax called transaction tax. If there is no income tax in India, no treaty. So there are four reasons when treaty would become suspended. This is the interpretation of tax treaties. At last, latest development international taxation. Just give me 5 minutes. They give me 5 minutes and we'll be done with that. First of all, under BEPS, OECD, again, Mike one. Listen, you poor countries, poor countries. This is what OECD said. Take care. This is what OECD said, if you remember. OECD came up with many action plans. 15 action plans precisely it came up with in 2015. In 2021, OECD again met and came up with two more action plans. Two more action plans. And these two more action plans are nothing but two pillars of inclusive framework. What did I say? Two pillars of inclusive framework. Okay, the language used here is not action plans, but it is two pillars of inclusive framework. Now, what are the two pillars of inclusive framework? Try understanding this. First is reallocation of taxing rights. What does that mean? So, listen very carefully. Only thing that I am telling is only you need to remember. Otherwise, everything you can skip out. Next. If there is a company which is having turnover greater than 20 billion euros and profit is more than 10%, then residual profit shall be given to market jurisdiction into 25%. What does that mean? Understand. Let me tell you. For example, there is a company called Apple, and company has a turnover of say 60 billion euros and profit is say 15 billion euros. See, why euros? Why not dollar? Why not rupees? Why not pound? See, OECD is in Paris. It is a group of European countries, so they have euro. They have decided euro. No questions attached. See, if there is a company who has more than 10, 50, more than 20 billion euro revenue plus profit rate is more than 10%. How much profit rate it is? Sir, 10% profit would amount to 6 billion euros. 10% of profit would amount to 6 billion euros. How much extra it is earning? Sir, how much extra it is earning? It is earning extra 9 billion euros. Out of this extra, this is called residual profit. This is called residual profit. What did I say? Over 10%, whatever you are earning, that is residual profit. Of this, now 25% would be taxed in market jurisdiction. 25% turns out to be 2.25 billion euros would be taxed in market jurisdiction. What is market jurisdiction? Where this company operates other than its state of residence. That means it might work in China, it might be working in Russia, Brazil, wherever it is working now, it shall pay taxes in that country as well. Now, what percentage in what country? Not relevant to us. Not relevant to us. It's the only purpose we need to understand. Over 10%, whatever you are earning, of that residual profit, 25% will be taxed in market jurisdiction. Where, how? Not relevant. We understood what is reallocation of tax side. Second one is globe rules. See, if a company is there, for example, there is a company called Apple. Apple has operations in multiple countries. Globe rule says global minimum alternate tax. Globe rules. What does this say? If there is a company which is having more than 750 million euros revenue So it should pay at least 15% taxes. At least 15% taxes it shall pay. How this shall work out, let me tell. For example, if a company is Apple, India revenue, say 1,000 million, profit 200 million, tax 30%, or I should say tax amounting to 60 million. China, profit, say 100 million, tax 20%, that means 40 million. And Panama, profit 10,000 million, tax zero. If you carefully check how much is the profit, 1,000, sorry, 200, 200 and 10,000. So 10,300 million is the profit. How much taxes it is paying? 60 plus 10, that is 100 million tax only it is paying. How much tax it is effectively paying? 100 divided by 10,300. That means into 0.097% it is only paying taxing, or not 0.09, 0.971% it is paying taxes. Lawmaker says it should minimum pay 15% taxes. Minimum 15% of taxes of their profit they should pay. How they will be paying, in what countries they will be paying, that is not our subject matter. We have STTR rules, how they are going to distribute depending upon their business operations. We have multiple rules. We are not going to argue that thing. That completes our globe rule as well. That completes your latest development international taxation as well. And that completes your entire international taxation right away in just 7 hours. That's all from my side today. You all have been wonderful, 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 lovely students. And I really cannot thank you for sitting this for this long. I was really, I was really doubtful that whether I will be able to make it or not. But same like Hindi, I was able to do it in English as well. And thankfully, very effectively you sat, you understood, and you processed it well. This is an optimum resource for you a day before exam as well. Even if you are worried, you can refer this resource, you can refer this videos any number of times, and you will be able to understand everything. Along with that, if you solve the question answers that I've uploaded, that will be always an icing on the cake. If you have any doubt, please message me out in the comment box. If you have any doubt, message me out in the Telegram channel. If you have any topic you want to understand, message me out. I will again share an audio. I will share a relevant excerpt so that you can understand it well. Apart from this, you don't have to do anything in international taxation. This is sufficient, more than enough. And apart from that, now, last thing, equalization levy is abolished from your syllabus. You can skip that out. Last thing, share it with your friends, subscribe to the channel, and also comment down after the video ends. Now, comment down your experience so that people are able to view that and people are able to watch that as well. See you guys. See you guys tomorrow, of course, not today. Tomorrow we have to meet again. We have to cover 12 topics. If you are as supportive as today, now we will cover 12 topics tomorrow. Naming, appeals, GAR, DRC, miscellaneous, tax audit, BML, clubbing, set off, deductions, ICDS, penalties, IFOS, business trust. These topics 11, 12, 13 more topics we will increase. The more you cooperate, the more cooperation you would do, more number of topics we would increase tomorrow. So tomorrow, same time, same energy, same excitement. See you guys. Bye bye. Have a great day.